The accelerated pace of economic and human development of the last 50 years has imposed unprecedented pressure on the balance of the planet, which has resulted in accelerated environmental degradation. The current climate crises and the loss of ecosystem services confront us with the crossroads of whether the current development trajectory can be sustainable in the future. The latest report from the Intergovernmental Panel on Climate Change ensures that the most likely scenario for the coming years is that the planet's temperature exceeds the objective of a maximum increase of 1.5 degrees Celsius. The Intergovernmental Platform on Biodiversity and Ecosystem Services reports that 75% of the land surface and 66% of the ocean surface have already suffered significant alterations due to human actions. At the same time, the World Economic Forum warns that more than half of the world's gross domestic product depends moderately or largely on the services provided by nature. Therefore, if current trends continue, the negative impacts we experience today are projected to intensify and become widespread around the world. Scientists estimate that the window of time we have to act and limit this damage does not exceed this decade. Countries must implement mitigation and adaptation measures rapidly. This context of urgency has put on the radar of the academic, governmental, and private world the need to develop a better understanding of the potential impacts of environmental degradation on macroeconomic and financial stability. With the idea of contributing to developing this knowledge, the Central Bank of Chile invites you to the 26th Annual Conference, where we will focus on understanding the implications of climate change and ecosystem services degradation for macroeconomic and financial stability. In this meeting, we will address issues related to the physical impacts caused by climate change and the loss of ecosystem services. The transition impacts associate implementation of mitigation and adaptation measures, and we will also see methodologies and instruments that allow incorporating the climate change and nature in general within economic analysis. This November the 27th and 28th in Santiago de Chile. 26th Annual Conference of the Central Bank of Chile.
Thank the team that has worked very hard to make this event possible and that has arranged the magnificent lineup of speakers and discussants that we will have over these 2 days. Over the last years, we have seen dire warnings of the deterioration of nature and its consequences. We have witnessed record temperatures in many countries, reduced river levels, devastating fires, droughts, and extreme weather events. In parallel, we have seen a severe disruption of multiple ecosystems around the world and massive loss of wildlife. In this context, on the one hand, Several scientific publications draw attention to what is happening and predict the outlook to be far from auspicious. The latest reports on climate change and biodiversity by the IPCC and the IBES show that we are running very short on the commitment made to halt the damage to nature, thus risking the crossing of multiple tipping points, which can have consequences on our societies. On the other hand, policymakers, businesses, and households are increasingly taking action to reduce their impact on the nature and driving a transition to a sustainable economy. All these activities and climate change itself has repercussions on the economy, the financial system, and the welfare of society. The natural question that arises is, how is this challenge being addressed by central banks? Not all central banks have the same mandates or economic tools, but there are several common areas in which our institutions should advance and contribute towards a more sustainable economy, always respecting our mandates, objectives, and activities. But it should be mentioned that our role is not to be a climate policy maker. In other words, central banks are not here to provide recommendations or enact policies to safeguard the environment. In fact, at the Central Bank of Chile, we do not have an explicit mandate regarding climate change. Our goals established by law are to look after the stability of the currency and the normal functioning of internal and external payment system. And from my point of view, it is fundamental for an autonomous institution such as ours to be cautious in exercising our attribution to do our job carefully and well. In this sense, to achieve our objectives, we must consider the environment in which we operate. For example, we need to understand the macroeconomic implication of climate change when assessing our economic and financial outlook, highlighting the relevance of developing models that incorporate this aspect into our projections. These, in turn, will allow us to be convinced of the correct internalization of the risk associated with climate change that impact the financial system. Therefore, we must be able to measure well and generate statistics that will enable us to evaluate more good decisions. In other words, we need to know, measure, anticipate, and certainly share that knowledge if the policymaker so requires. Thus, and in line with NGF's commitment, as a central bank, we are taking action by designing a work agenda on these topics. The details of this effort are part of our 5-year planning cycle that began early this year. We stress 3 main lines of actions: macroeconomic analysis, financial risk assessment, and the provision of economic and environmental statistics. The knowledge and the generation of information of the effect of climate change on the economy and the financial sector are central for a correct evaluation of economic policies. The macroeconomic implication of climate change include some well-known elements for monetary policy, such as supply shocks, structural changes, and uncertainty. But in this case, the changes may occur over an extended period beyond what is normal business policy cycle. One of the most immediate challenges for central bank face is factoring into their analysis and projection models the macroeconomic impacts arising from the physical damage related to climate change and environmental degradation, as well as a transition effect associated with mitigation and adaptation policies that might be implemented. Certainly, the analysis of climate change and transition policies poses big challenges, but central banks have a comparative advantage given their expertise accumulated in the last few decades in terms of data-driven structural modeling. Our medium-term research agenda will incorporate climatic and, more broadly, environmental concerns into its standard toolkit for macroeconomic analysis, including the effects of physical and transition risks, as well as new opportunities presented by the green transition. All the above is in line with our commitment with NGFS. These tools will be used mainly to assess the implication of environmental degradation and the green transition on long-run potential growth. Another challenge is safeguarding the long-term stability and resilience of the financial system through two main lines of actions. Incorporating climate change into financial stability assessment to identify and address vulnerabilities in the financial system, and second, enhancing risk management and supervision practices to take into account climate risks. The impact of climate change on the economy exacerbates traditional financial risks. Plus, our function includes the production of key macroeconomic statistics, a comprehensive analysis of the impact of climate change and ecosystem degradation require consistent, comparable, and quality statistics to close data gaps and include nature in the decision-making process of the different actors. We plan to contribute by producing information and analysis for climate risk assessment that complement the effort of and are an input to the financial regulator and can serve as a guide to other financial institutions and businesses. The first step in this line was the exposure analysis to physical and transition risk of climate change published in the Financial Stability Report during the first half of 2022. We also are working on developing methodologies for measuring Chile's natural capital in line with a framework that derived from the United Nations System of Economic and Environmental Accounting. Natural capital can be systematically measured and monitored based on its contribution to production and societal well-being. Additionally, we are working on other climate-related topics, such as the estimation of the carbon footprint of economic activity by using an input-output model, and we are studying the factors influencing its evolution. Besides these initiatives, we have related activities internationally. As an activity member of the Network for Greening the Financial System, NGFS, we are co-chairing the macro modeling group with the work stream of monetary policy and part of the task force for nature-related risks and the research network. We are also chairing a research network including many countries in the Americas on the macroeconomic consequences of the environmental change with the support of the BIS. At home, we are supporting some governmental instances to work on these issues as external advisors. For example, since 2019, we have been part of an advisor to the Green Finance Roundtable and the Preliminary Committee in Green Taxonomy created by the Ministry of Finance. Additionally, we are also a member as an external advisor to the National Capital Committee formed by the Ministry of Environment, the Ministry of Finance, the Ministry of Economy, and the National Council for Science, Technology, Knowledge, and Innovation. This committee is an instance of collaboration between institutions that aims to develop methodologies to measure the real value of the multiple services that our ecosystem provides us every day. Let me speak a little about the conference contents for these 2 days. The fact that our annual conference will be dedicated to addressing issues on this topic this year is proof of our interest in building a better understanding of these phenomena and learn about the challenges and opportunities associated with possible future environmental scenarios and their associated macroeconomic impacts. This conference seeks to answer questions such as, what are the main mechanisms through which nature degradation and climate change can affect long-term growth? How does macroeconomic and financial stability depend on ecosystem services and climate stability? And what methodologies and tools are available to incorporate nature-related risk into standard macro-financial analysis, among others? To answer these questions and shed light on the future, we have gathered a select group of experts. Thus, today we will have two academic sessions with papers studying different aspects of the macroeconomic impacts of climate change and ecosystem services degradation. We will have Philippe Aguillon as keynote speaker, and we will end the day with a discussion panel talking about policy implications. In the first session, James Stock will talk about how both physical and transition impacts related to climate change can be incorporated into macroeconomic models and what insights we can get from these integrated kinds of models. Anthony Smith will talk about how a global economy climate model featuring a high degree of geographic resolution can shed light on the uneven distribution of the climate change impacts around the world. Also, Luigi Duran will discuss how, through international trade, policies implemented in one country can affect the evolution of the natural capital of their countries. This session will have two amazing discussants, Benjamin Garcia and Larry Karp. Today's keynote speaker, Philippe Aguillon, will then tell us about whether it could be possible to achieve a green transition process that reduces CO2 emissions and at the same time enhances economic growth. Then, the second academic session of the day will be started by Steve Polaski, who will talk about to integrate ecosystem services into economic models and the policy implications resulting from such integrated framework. The second speaker of this session is Justin Johnson, who will discuss what are the policy recommendations from an Earth economy model to achieve global sustainability. We will have two professors discussing Steve and Justin's presentation, Francisco Gallego and Andrew Plantinga. We will end this first day with a discussion panel in which we will listen to Marshall Burke, Douglas Arendt, and Eduardo Cavallo about what they consider the relevant macroeconomic implication of environmental degradation that policymakers should be aware of. They will also discuss the opportunities and challenges posed by the investment projects required to achieve the green transition and mitigate the damage that we already experiencing and expect to intensify in the near future. Tomorrow, we will open the discussion with an academic panel focused on the financial implication of environmental degradation. In this session, Hee-Yoon Young, I suppose is correct, will tell us how insurance companies can be exposed to climate-related physical risk through their operation transition risk through their financial asset holdings. Then, Johannes Strobel will discuss how physical and regulatory risks related to biodiversity loss can affect economic activity and asset values. As discussion of this session, we will hear from Catherine Wagner and Mauricio Larraín. Following this, we will have the pleasure of hearing the keynote speaker of this second day, Maximilian of Hammer, who is also a co-organizer of the conference. He will talk about key issues related to the physical and transition impacts on environmental degradation. Then, in the fourth and last academic session of the conference, we will have the privilege to hear from Tama Carleton about new approaches to estimate the social cost of carbon, from Marshall Berg, who will discuss the channels through which climate change can lead to socioeconomic issues affecting economic growth, and from Elias Albagli, who will speak about what the past tells us about the relationship between emigration and climate change, what the present tells us with the current available data, and what we can expect for the future. In this session, we will have Joaquin Vial, Klaus Michievel, and Anuj Misirian as discussants. Finally, we will close the days and this conference with a discussion panel from high-level policymakers as Charlotte Gardens Landolfini, Mauricio Larraín, Marcus Molbach, and Daniel Santabarbara about the impact of climate change on financial stability. Dear guests, all of you, I hope the expertise of the insights of our distinguished speakers and discussants will provide invaluable guidance on how to navigate the very challenging climate and environmental transition that we urgently need to address. I will all of you a fruitful 2 days in this conference. Thank you.
Thank you, President Costa, for your opening remarks. We'll continue with the first session of the conference, titled Macroeconomic Impacts of Climate Change. For this session, the chair will be Pablo Garcia, Vice Governor of the Central Bank of Chile. So we invite Vice Governor Garcia and Professor James Stock, the author of the first paper, to have a seat at the front. Thank you.
So thanks all for being here and welcome to this first session. We have the honor of having James Stock, who needs a little introduction. James is the Vice Provost for Climate and Sustainability. He's Director of the Salata Institute for Climate and Sustainability, the Harold Hitching Burbank Professor of Political Economy in the Faculty of Arts and Sciences, and a member of the Faculty of the Kennedy School, all in Harvard. He has worked in energy and environmental economics with a focus on fuels and the US climate change policy. He is co-author with Mark Watson of a leading undergraduate economic textbook, and he also served as member of President Obama's Council of Economic Advisors. So you will let us know about the implications of, or the macroeconomic implications of climate change. So James, please.
I'm going to do my presentation.
Please. And you have 35 minutes, and then we have a discussion for 15.
That's great. Thank you very much. It's just such a pleasure to be here. I'm delighted. This is a really interesting conference. It's really timely. This is a really exciting moment to be working on macro and climate change. Not only is it an urgent moment, but it's full of changes, and it's full of important intellectual opportunities. I'm especially heartened by the activities that central banks, such as the Central Bank of Chile, and those that are engaged in the NGFS enterprise are doing to make sure that central banks are aware and ready for the challenges of the energy transition and climate change. And in some cases, central banks are also using opportunities to be more of a climate agency as well as a central banking agency, depending upon their mandate. So let me just set the stage. I think this audience is a sophisticated one, and you surely know many of these things, but I'm just going to reiterate the dramatic paces of change that require economists, and especially macroeconomists, to be paying close attention. One of them is the impacts of climate change are worsening. We know that just from the world around us. Here's one quantified way to do it, which is to look at billion-dollar events. This happens to be billion-dollar weather disasters. This happens to be in the United States. And I guess I should say coming from the United States. As sort of typical American, most of my examples are from the United States, so just cut me some slack. Peak fossil fuel demand and changing energy markets. I'm going to come back to this. This is really an interesting change too. So of course it's not a physical consequence of climate change like the previous example, but it's something that's going on in transitioning energy markets. So EIA has forecasted that fossil fuel demand is going to peak around 2030. Those are tough forecasts to make. Who knows? But I think the interesting thing about that is the geopolitical risks that it raises. Not just, it's of course something that we need to have happen as we decarbonize, but it raises important geopolitical risks as we have declines of, as we will see declining petrostates, pressures that are put on. And I'm going to come back to that. And this is just an example. This is a graph of volatility of oil prices and natural gas prices, and I'm going to come back to this plot because it has some, I think, important lessons for us. And I think about the policy situation. You know, the world, I think, is now becoming increasingly aware that everyone in this room is aware that we need to be taking aggressive action to reduce carbon dioxide emissions. The world and politicians are getting there. This is an example. What I have showing here is effects of the Inflation Reduction Act, which is our large climate policy that was passed last year in the United States. And the upper set of projections are from an ensemble of models that integrate the Inflation Reduction Act into a macroeconomic and emissions models. And then the upper set is the counterfactual of what if we didn't have the Inflation Reduction Act, and the lower set is the projections with the Inflation Reduction Act. And you can see that the Inflation Reduction Act reduces emissions by about 10 percentage points in 2030 and 2035, which of course is a very substantial amount. On the other hand, it's only 10 percentage points. So a lot more climate policy has to happen in the United States, and a lot more climate policy has to happen around the world if we're really going to be on target for something like 2050 net zero goals. So there's a lot of climate policy uncertainty. Okay, so what does this paper do? And then this is, I think, one more comment, and I'll come back to this. This is looking at fiscal sides of the Inflation Reduction Act. The upper, I guess for this audience, the chart on the upper left there is the dramatic one, which is the current Congressional Budget Office outlook for the long-term debt to GDP ratio, and you can see that it's really quite a dramatic increase that's being projected. And on top of that, the Inflation Reduction Act and other subsidy-based climate policies are likely to only exacerbate the situation if that's the direction that we go. So a couple of ways to read this, but certainly fiscal policy is imposing some constraints on climate policy, at least in the direction that we've taken it in the U.S. Okay, so what does this paper do? So there's a great deal of new work and a great deal of old work in climate and macroeconomics, and what this paper attempts to do is review all of that, synthesize it, and then try to focus on areas that we have great opportunities for additional work in a pressing and timely way. So there's the urgency of climate change policy, but there's also the urgency of making sure that we understand how traditional monetary authorities and fiscal authorities can anticipate and respond to various risks and challenges associated with climate change and the energy transition. So there's a lot of different dimensions of the existing papers that are out there. Presenting a survey paper would be particularly dull, so I'm not going to present the survey paper piece of this. What I am going to do is I'm going to summarize some main features or some main takeaways. I will apologize to the central bank audience. This is kind of geared towards academic macroeconomists, but that's how we talk to each other, and that's how we make progress. So we're going to organize this. Around the Carney framework of physical risks and transition risks. One thing I would stress is that transition risks sometimes, at least in its initial inception, is framed in a fairly narrow concept having to do with climate policy and climate policy implementation. That, of course, is important, but I think we need to have a much more capacious interpretation of transition risks, where it really looks at implications for financial markets, implications of uncertainty, voluntary activities, geopolitical risks, and basically anything that the human system, political system, human behavior does in response to these very substantial changes that we're going to be that we are beginning to undertake, but for which most of it is in the future. So our organizing principle is the physical risks, and then we break down transition risks into three different categories: mitigation risk, which is really associated with the macroeconomics of mitigation policy and the energy transition; adaptation risk, which is the macroeconomics of climate adaptation; and then implications for fiscal and monetary policy. So I'm not going to march through those in that order because that would be, as I said, rather dull. What I am going to do is I'm going to talk about some of the main conclusions, 6 main takeaways that we have, and then I'm going to try to illustrate that. So at the highest level, we have done a great deal of work, we collectively as macroeconomists, that has really advanced our knowledge of a lot of important areas, interactions of macroeconomics and carbon taxes and other sorts of policies, but there's an awful lot of areas that are nascent and I think we can expect to be increasingly important in the future, such as the macroeconomics of climate adaptation, or to put 2 words that maybe don't necessarily sit well together historically, the development of adaptation policy. I'm not sure that adaptation policy is a thing, but perhaps macroeconomists can help to make it a thing and can try to start to think about this coherently. So I'm going to march through our main conclusions and try to make this a little bit controversial, so we'll put some stuff on the table here. So one conclusion is, if you look at much of the historic literature dating back all the way to Nordhaus in the 1970s, much of the historic literature in macro and climate has focused on estimation of things like the social cost of carbon, which is the monetized net present value of a ton of damages from emission of carbon dioxide, to think about optimal carbon taxation and optimal carbon pricing. My view is that this is a super rich literature. We know a lot about it. There are certainly many things that could be developed further, but my recommendation, it's also been a source of a great deal of controversy, and I'm going to touch on that. My conclusion is that we just declare victory on this, and we can move on to other topics that are arguably much more pressing, that we have good sense of what these challenges are. And so there's a number of key tensions that have forced that have really pushed the there's a number of key tensions that have actually pushed this debate. And I think one basic the discussion of the social cost of carbon, as I think many of you know, has been one that's been quite fraught. It's been fraught within the profession, but it's been especially fraught between the profession and, say, natural scientists and politicians. So underlying the social cost of carbon concept is this nature of equating marginal benefits to marginal costs, so we need to figure out what the marginal benefits of reducing emissions are, the marginal damages of emissions. We need to figure out those marginal damages, and then that's going to give us a framework for thinking about optimal policy in the context of a carbon tax. This has been a fraught concept for a couple of reasons. One is that if you just equate marginal benefits and marginal costs, assuming that marginal abatement curves continue to rise, we're going to be emitting in perpetuity, and so the planet is going to be warming in perpetuity under this framework. And that's one that doesn't sit well with a perspective of taking a precautionary motive where you might want to limit temperature rise to a certain amount, 1.5 degrees, 2 degrees, and so forth. So there's a fundamental tension conceptually between approaching the social cost of carbon and its cost-benefit analysis framework, and then alternatively just imposing some sort of cap. This is, underlying that is a big debate over the value of internal debate to the profession, the value of integrated assessment models. I think this has been a lively debate. It's been an informative one. But as a practical matter, I think we, as I said, just can declare victory. And so what's my argument for that? The most recent round of evidence from the EPA in terms of the social cost of carbon clocks in at a number of around $190 per ton. That number is arguably smaller than the number in much of the literature now. There's the RFF, there's a Resources for the Future team that I was part of that worked on a new estimate, and that came in at $185 per ton. There's a meta-study by Fran Moore, a number of authors, Maurice Drupp, a number of others, which looks at literature only through 2020, not the most recent round of literature, and gets estimates, a median estimate of around $470 a ton. So these are really, really big numbers. There are well understood reasons why the EPA approach probably understates. The EPA approach focuses on a few specific climate damages: mortality, agriculture, labor productivity, sea level rise, and I'm missing one. So it focuses on five main categories. Energy, thank you, Marshall. And of course, it emits a huge number of categories. It emits values of species, conservation, biodiversity, ecosystem services. So many of the topics of this conference and the effects of climate on those are not in there. So there's every reason to think that the EPA number is a lower bound. Okay, so what's the point of this? The point of this is $190 is way above most of the estimates of effective climate policy to make really a very substantial chunk of emissions reductions. Now, maybe when we're down to a very, much reduced emissions levels in, say, 2040, if we're successful globally, then we might be looking at some higher cost estimates. But even I think that this number is probably in the round for decarbonizing aviation, would be my guess based on some reasonable technology projections. So I think that, more debate over this topic, more estimates of the social cost of carbon. I don't think that's the most valuable use of our resources, despite we can say that's the agree to disagree approach here. So here's just a list of a number of different things that you could be putting in. So even the health component only includes mortality, and it doesn't include any morbidity, for example. Okay. I include rights of nature here because I want us as economists to be keeping in the back of our mind that there are lots of different views, not just the economists' views on these matters, and that we need to be cognizant of how those play into the overall sets of debates. Okay, I think. Okay, so this is and the context here is like the second conclusion, which is just we need to remember that GDP doesn't equal welfare. So you will sometimes find out there saying climate change just isn't a big deal. Macroeconomists or the climate economists are forecasting that GDP might be 10% or even 20% lower in 2100 than it otherwise would be, but the thing is we will have quadrupled GDP by then, so it's a really tiny amount and it's something we shouldn't worry about. So there are a couple of things that one could unpack from that, but the main thing that I would unpack from that is that GDP isn't welfare. So that yes, that might be true for GDP, but that doesn't mean it's true for welfare. So the easiest example of that, there are multiple examples of that. An easy example of that is just thinking of storms. So there is debate in the literature about exactly what the GDP effect of storms are, but certainly one set of estimates suggests that when hurricanes land, especially in developed economies, that when hurricanes hit, of course, that has a negative effect on output right away. So you'll see a decline in employment, decline in output, and so forth in the local region. But then you've got this rebuilding boom, and then because of the rebuilding boom, lots of people are back to work, and that goes into GDP. Those are investment figures and employment figures, so output goes up and then it plateaus. And so maybe the net GDP effect of in the medium run of a hurricane is about zero. So that's a plausible, you can bicker with that, and some papers might say it's positive, some papers say it's negative, depends on the circumstances, depend on the granularity. But the point is, that's not to say that hurricanes have no effect. Hurricanes have big effects on dislocation and welfare and physical capital and so forth, but they just might not have an effect in short-run GDP measurements. So that's just one of many, many examples. Another example is heat waves. Heat waves are the most vulnerable are the poor and the elderly. The poor and the elderly don't make much of a contribution to GDP, especially the elderly if they're not working. So mortality among the elderly isn't going to make much of a GDP impact. That doesn't mean that it doesn't have much of a welfare impact. So we just need to keep in mind that GDP and welfare are different objects. Okay, so what is there? There's a huge range of interesting policy opportunities for economists to be thinking about in a proactive way when we're thinking about climate policy. So there's a couple of different ways to think about this. A principled way to think about it is that there's actually quite a few externalities out there. So there's multiple externalities. So that means multiple policies are appropriate, multiple tools are appropriate. A more practical one is that if economists want to stay relevant in the debate, we have to be focused on meeting the political system and political discussion and other parts of the community where they actually are. So I think, if you talk to people who are not economists, you say, well, what do economists think about policy? The answer is, well, they just want to have a carbon tax. Well, of course, that is true. I think we all want to have a carbon tax, but I think it's also a matter of moving beyond a carbon tax as we think about policy design. And of course, one of the ways that, and this is not new, is thinking about innovation policy. Our innovation policy has actually been an incredibly important part of climate policy, often not really called that. But if you think about the policies that have driven down the cost curve for photovoltaics between the Energiewende program in Germany and California Solar Initiative and other places that have forced the purchase or driven the purchase of very expensive photovoltaics, so they've actually really driven down costs in the photovoltaic industry and probably seem to have a big role in the current low cost of PV. So that's something that we've always paid attention to as economists, although perhaps not promoted as being as important as it needs to be. But there's an awful lot of other combination policies that are important to think about, or targeted policies. So I think the current world of policies is one in which one thinks about lots of externalities, some of them being narrow, not at a macroeconomic dimension, some of them being institutional constraints, some of them being other sorts of externalities. So think about network externalities associated with electric vehicles and charging stations, or a network or chicken and egg externality. And those are really important things to be working on as well. So there's a ton of other areas, supply side policies and industrial policies. The number of papers, so our major climate policy in the United States is a supply side industrial policy. Compare the number of papers on supply side industrial policy, green industrial policy, to carbon taxes in the literature. And I think that we'll find out the policies that we've adopted are not the policies that we've studied. So I think there's a lesson there for us. International coordination is really exciting, and this is a success story where I think economists have been thinking, Nordhaus has been thinking out of the box, and then people took that up, and now that actually is being taken up in Congress. I guess I think one of the things that has the most legs in Congress is to say that we should put on a border carbon adjustment because we're being active in climate policy because we're subsidizing green innovation. And if you think about that from the perspective of a traditional trade economist, subsidizing at home and then providing an import tariff somehow doesn't line up exactly with WTO principles, but if what you're trying to do is incentivize climate coordination, then perhaps it does line up. So it's a really interesting set of questions that challenges some of our basic principles of international trade. Absolutely needs to be thought about more and worked on more. There's some really interesting other things that we probably haven't thought about nearly enough, carbon dioxide removal at scale. So I'm super skeptical that in 2050, many of you are sure familiar with the overshoot concept, and then we overshoot CO2 concentrations, but then we reduce them using a variety of different technologies that are going to be having net emissions reductions. So we can call those technologies, broadly speaking, carbon dioxide removal, and they can be direct air capture or burning biomass, and then sequestering the carbon dioxide, other sorts of things like that. I'm super skeptical that we'll ever do that. I mean, for heaven's sakes, we can't even pass You know, in most countries, we can't even pass a $40 carbon tax. So if we can't pass a $40 carbon tax, why do we think that our children and grandchildren are going to fork it out to take carbon dioxide out of the atmosphere? But, you know, maybe we will. There's a lot to be studied there. This is a huge set of, a huge set of questions. Suppose we really were to be taking spending 2 to 3% of GDP on carbon dioxide removal. What does that actually mean for TFP? What does that mean for productive capital allocation? I think there's an awful lot of interesting questions to be paid attention to. I can't think of too many positives from this, but maybe there are. We need to have more thought on that. I'll tell you a really interesting area. Super interesting area is this notion of whether voluntary corporate targets and voluntary corporate behavior can really produce new ideas and real carbon emissions. So there's been some really fascinating work by a small number of accountants and economists thinking about whether or not voluntary corporate targets actually can produce overall economy-wide emissions reductions. There's an awful lot of reasons to be skeptical about that. I mean, I think as economists are trained to be skeptical about people standing up and voluntarily spending an awful lot of money to do something that is not necessarily in their best interest financially in a narrow sense. On the other hand, it is a thing. You know, is it something that we can really look at? So I've just listed a couple of interesting papers here. There's really not a very big literature, but if you look at the corporate behavior, GFANZ, the other sort of entities that are focusing on making corporate disclosures, all the members of SERIs. This is really the World Economic Forum efforts. This is really a major thing in the private sector. Is it greenwashing? Is it really going to reduce emissions? And I guess my worry, why is it's interesting intellectually? My worry, and I don't know whether I'm right to worry about this or not, is that if we sort of say, hey, the corporate sector's got it, we don't really need to be doing any more. Well, is that right? You know, is that going to be enough? I mentioned degrowth. I could go on for degrowth for a long time, and I'm not going to. Okay, so let me raise a few things, a few more things. So the fourth major takeaway is that there's an awful lot we don't know about the implications of the energy transition. The energy transition, you know, we are just beginning. What we need to be building out in wind and solar, of course, but also in the transportation, complete revamping of the technologies of the transportation sector, many aspects of production, the new inventions that are going to be figured out along the way, the vast, many trillions of dollars are going to be spent and redirected. And then, of course, all of the human social implications, declining petrostates, the political economy of changes or declines in the fossil fuel industry, changing geographic locations, migration, and all of the political pressures that is going to create. So I think it's really hard to get away from the fact that over the next 20 or 30 years, we're going to see massive events. So there's a whole bunch of questions that rise from that general observation. I'm going to illustrate just a few of them, and I'm not going to have time to go through these in much detail. But they focus on looking at things, what are from the lens of, well, like, what do we really need to know in terms of macro impacts of all of these issues? So one set of macro impacts, and I think this is interesting, is looking at economic fluctuations implications from policy implementation. So a lot of the policy, so if you go back to the original idea of transition policy uncertainty, it's like what are the macro effects of policy implications and policy changes. So there are I'm just going to give you two papers to think about because I happen to be on one of the teams, and this is our implications of implementation and changes in carbon taxes. So we have a paper in AEJ Macro that just came out that is looking at the effects of carbon tax changes in EU countries. And basically what we find is that if you look at GDP, so the idea is this is a panel VAR, panel local projections identification scheme where we take advantage of the fact that the carbon tax has to be set in advance. So you need to know the tax rate over the course of the coming year. And so as you know the tax rate over the course of the coming year, that gives you leverage in terms of identifying shocks and so forth. So we trace through shocks for changes in carbon tax rates. And we find basically no effect on employment, and we find basically no effect on GDP. We find an emissions effect. These are which is negative. It's not a very big one, but it's completely in line with what you'd expect from the magnitude of the price changes that are going to be implied by this in terms of just tracing through elasticities. Most of these EU carbon taxes cover the transportation sector, so that's pretty inelastic demand, and you wouldn't expect to see too many changes. Okay, so this is a really benign view of at least one efficient climate policy. This contrasts with a paper that I guess is now coming out in the ER by Diego Kanzig of Northwestern University, where what he finds is in a study of the EU ETS, which is a cap and trade system in the EU, that unanticipated changes in the EU ETS price actually have some substantial negative effects. So they're inflationary. They do reduce greenhouse emissions, GHG emissions, but the main channel is because they reduce industrial production, and they actually do have a negative effect. I don't show an employment effect, but they have a negative effect of employment. So they have an effect of a spillover into overall HICP inflation. So this is actually quite a different set of results. So you say, my gosh, this is crazy, because one of these is looking at a carbon tax and the other is looking at price changes in an EU ETS. And I thought we're supposed to think that cap and trade and carbon taxes are kind of the same thing, and carbon pricing and so forth. And one of these has these kind of pretty negative implications for macro stability and short-run macro fluctuations. And the other one is like it's a real shrug of the shoulders and it's great. And so at first, my reaction was that Diego's got to be getting it wrong and that he's sort of messed up in his econometrics, but he's quite good, and so I don't think that's the case. Actually, I think there really is something there. So there's really some very sort of interesting, subtle distinctions between these two in real world. This is important from a macro management, monetary policy, real world fluctuations. And this is just one example. These are both pretty efficient policies. There's no such study of something like the IRA. There's some quick analysis that's done in a recent Brookings paper for the IRA, but there's much more work to be done. Much more work to be done. This is really important, thinking about climate policy. Another related thing is climate policy uncertainty. I'm not going to go through these slides because I don't want to take the time, but there's a small literature looking at climate policy uncertainty. Climate policy uncertainty, of course, you would expect through standard real options approach to investment would be delaying investment, and indeed that actually might be related to the Kanzig result we just looked at. But it also is something that could be, reducing overall economic activity in line with the overall policy uncertainty literature. We take a look at this. There's a paper that I have some slides on here with. I'm going to just skip over all of this. That's with this paper with Diego Kanzig that we're looking at climate policy uncertainty, and it seems to have negative effects on economic activity. Energy security and global energy markets of the future. This is something we don't really know very much about. So there's one view of this, I'll call it the benign view of transition of energy markets, is that many of the economic fluctuations that we've had over the last 50 years have been associated with oil price fluctuations. One view, the benign view, is, well, gosh, we're going to transition off of oil to things like wind and solar. And so there'll be a declining volatility in that area. I think that benign view might be right in 2150. I don't think that benign view is going to be right for the next, 30, 40, 50 years for our professional lifetime. I think that we're in a situation we're going to have continuing, in fact, I would guess, increasing amount of volatility in international fuels markets because we're basically integrating, increasingly going to be integrating international fuels markets. I'm going to give you just one set of slides on this. This is looking at natural gas prices in the United States and the effects of LNG exporting on natural gas prices in the United States. So with the United States, if you look at the orange line, that is the export share of production. The United States is now exporting about 20% of its natural gas production. Over the next few years, that's probably going to go up to 40% of its natural gas production. We have a huge amount of natural gas that's available through fracking, and so we're going to be basically connecting that market to the rest of the world. I would argue it's already connected to the rest of the world. So we do a bunch of price analysis here, and you kind of have to squint at this a little bit. If you look at area 1A, clearly natural gas prices, which are in red, were connected to oil prices, which are in blue. They became disconnected during the fracking revolution. Recently, if you look at the far right, say since 2020, it looks like those prices are moving together. And indeed, if I carried it out further, those prices are moving together, but with a wedge. And that wedge is actually very well approximated by the cost of export of liquefaction, transportation, and regasification, which adds a big chunk to natural gas prices. So if you look at the domestic price and the world oil price, they're essentially reconnected in the United States, but with this transportation, gasification, liquefaction wedge. So that has big implications. I'm going to skip through all the econometrics. That has big implications in terms of thinking about what natural gas prices are going to be in the rest of the world, what natural gas prices are going to be in the U.S., and how that either does or does not expedite the energy transition. So that's something that is going to have implications for macroeconomists as we think about macro fluctuations, and especially implications for looking ahead, long-term energy markets. Many of the things that were being proposed for long-term energy markets, like e-fuels, bio-based SAFs, ammonia, green ammonia, are all liquid fuels or gaseous then liquefied. So these are all in the market competing for oil. So if they're all in the same market competing for oil with various subsidies, you'd expect that price fluctuations are going to be spilling over into the rest of the macroeconomy. I'm going to skip over this one. We know, but I think there's also long-term implications for macro policy parameters that we don't really have a good sense of as well. And that's an area where there's a lot of different work. Macroeconomics of adaptation. So this is a blank page, and it's not really completely a blank page. There's some really exciting, interesting work over the last few years on thinking about what adaptation policy should look like. But I think, but it's an open area that's going to be of increasing importance. And then deep uncertainty. So the final point I want to leave you with is the critical nature of deep uncertainty associated with all of the energy transition broadly defined. And this was this goes back to a lot of the great work that is being done at NGFS in terms of trying to think about what is the role of monetary policy in terms of getting ready for the sorts of shocks that could be occurring, that are occurring, but could be occurring in the future. Some of which we can anticipate, some of which are much harder to figure out. So one framework that I find useful is thinking about risk cascades. So how can climate change, maybe not physical climate change damages, they're not going to be big enough in almost all circumstances to actually be a big macro shock on their own. On the other hand, through various institutional challenges, maybe they can trigger risks that are going to be big enough that would be noticeable. So I'll give you an example of a risk cascade, which is the wildfires in California combined with inflation meant that there had to be a revaluation of prices for homeowners insurance there's a cap on how much you can raise the homeowners insurance by, and so a number of companies decided to pull out of the market. So as homeowners insurance becomes less available in the market, that's going to have implications for the overall price of housing and for potential spillovers. Now, these spillovers didn't happen. This was too small to have any macro footprint, but it is something to bear in mind. And then finally, I'm just going to leave this, and I know that Tone is going to talk about this in his comments after this. But I would also stress that there really is lurking out there very major implications or very major challenges ahead. What are the things that we've missed? We have a history as a profession of doing well on the not very big things and really missing the super big things. And so what are the super big things that we're likely to be missing in this area? Thanks very much.
Thank you. Thank you very much, James, for this great overview and presentation of the research results, and leaving us with, as economists, thinking of the big issues that we may be missing. So we have the pleasure of having Tuan Phan. He is an economist with research focus on climate economics and macroeconomic issues, and he's joining us from the research department of the Richmond Fed, which he joined in 2017.
For having me here. Can you guys all see and hear my presentation okay?
Yes.
Yeah, and sorry for not being able to be there in person. So again, thanks for having me to discuss this much needed work by Jim Androng in providing a synthesis for this rapidly growing literature in climate macroeconomics. And first of all, obviously all the views, my views are not the views of my employer. So let me just begin by latching on some of the very last things that Jim was saying. Look at the history or the epistemology. Struck by one of the things that he wrote in the draft, that the history of macroeconomics is one of being surprised by events that end up having major consequences. And that reminds me a lot of the piece that Larry Cristiano wrote just a few years ago called the Great Recession, a Macroeconomic Earthquake. There he wrote that the idea that financial markets could be ignored in macroeconomic died with the Great Recession. So now macroeconomists are actively thinking about the financial system, how it interacts with the broad economy, and how it should be regulated. And then just look me back to one of the last points that Jim was saying, that one way to think of the financial system as a shock amplifier. And the reason is because a climate-related shock by itself might not impose such big importance, but if you think of the amplification, in this case amplification to the financial system, the shock can have much bigger consequences. So the task, one of the main tasks in my view, is that also I agree with them, is to understand what are the potential amplifiers that could turn a modest shock, like a hurricane shock, or into a threat to the financial system or the macroeconomy. So my focus on this talk is just simply to complement what Jim was talking about, but the focus here will be on the financial side. So I want in this brief presentation, I will try to document three empirical pieces, three pieces of evidence on the effects of climate risk on three pillars of financial amplifiers. So housing prices, next is mortgages and mortgage-backed security, and the last is government-sponsored enterprises. All of these play a big role in the Great Recession. So, but before I do that, let me step back for a second to see, to take a big view, a paranomic view, my view of the current research landscape. I think there are three branches, broadly speaking, are all growing very rapidly, but largely independently. So I would say first, the one thing of climate micro. So that the literature provides very careful estimates of the climate damage elasticities. For example, what are the effects of weather shocks on crops, on productivity, on mortality? So they provide quite useful estimates of the elasticity of adaptation. So how will the weather shocks affect the willingness to migrate or the willingness to take up insurance? I think this estimate is quite helpful for us to build models of adaptation. And I think there's a lot of surveys out there, but I think a very good place to look at this The survey of this literature is coming from the National Climate Assessment chapter. Now, the chapter in economics that was released literally just 2 weeks ago. So I was a part of this team of about 10 economists trying to, in the past 2 years, to try to provide a synthesis of this literature on climate economics, and we provide various different summaries. One of them is actually one table where we put a big table that provides a brief summary of what different kind of estimates the literature has found. So that could be a very useful point of reference. And the second literature is what Jim focused a lot on is the climate macro. So there the main focus is to think about the feedback between climate damages and macro variables and policies like taxes, right? So like Jim was saying, the focus has been, for example, the social cost of carbon. Empirically, they try to estimate the effects of temperature shock, let's say, or disasters on economic growth. Or there's also some work trying to look at energy transition policies and the nascent literature on adaptation. So Jim and Drong will provide one much needed updated synthesis of the latter literature. And finally, I think there's this important literature on climate finance. I know that we have this on the conference. I know Johannes will talk more about this as well. But I think the literature is quite exciting because it's helping us to understand how financial markets are anticipating future climate risk. Right? Keep in mind that most of the climate damage are in the future. So anticipation can play a very important role, right? So the literature has done, I think, it's quite interesting jobs in looking at how, for example, the effects of anticipated future sea level rise related risks, like flooding risks or storm surges, how this anticipated risk would affect housing prices today, or how anticipated transition risk will affect stock price and investment decisions today. So there's some excellent surveys here. So Harrison Hong et al. And also Johannes and his co-authors present some excellent reviews of this literature. So my view is that these three literature has been pretty much largely developing independent of each other. And if you think of them as like vector spaces, what we really need is a direct sum of all of these different literatures together. And I'm gonna focus on the last two, the bringing together of the macro and finance. So to do this, so let me point to some selected recent empirical findings on what are the potential risk amplifiers in the financial system. So let's look at the very, very key pillar of a financial system and financial system amplifier and stability, that is housing prices, right? So there's an active debate in this literature. But I think my takeaway from this is that the evidence has been pointing that housing markets have started to anticipate the long-run effects of climate change risks. So for example, the risk of future sea level rise is being anticipated in the housing market, in coastal housing markets. So the estimates of this effect it's been documented to be negative. However, the estimates vary a lot across the different papers, so the magnitudes vary. And one thing is, I think it's consistent in this set of literature is that the magnitude is being increasing over time. So the degree of anticipation of future, let's say, sea level rise risk being stronger and stronger over time, consistent with the idea that attention about climate change becoming more salient these days compared to say 10, 20 years ago. Furthermore, the magnitudes of this pricing of future risk depend a lot on the belief factors. It's very, very important, right? So the estimates generally point, for example, that in areas where people are more pessimistic about climate change, people are more, more worried about future climate change, the magnitudes of the effects will be stronger. In areas where people are less concerned, are more optimistic about future climate change. For example, in areas that people do not believe that climate change is happening at all, I would think that's very optimistic. Then the magnitude is a lot of times insignificant. There's no effects of future climate risk on housing prices today. So different papers have been documenting this. Overall, when you take, there's other papers also showing that, arguing that current housing prices are underestimating climate risk. And they define various benchmarks for what efficient pricing is. And then under different definitions, the papers tend to find that current housing prices are arguably underpricing the future climate-related risk. And therefore, that leads to potential for repricing events, right? So where some kind of events, news that make people update the belief, for example, can trigger housing price decline. For example, and recently it's documented that so after Hurricane Sandy, the premium of living in a coastal property declined, even in areas that are unaffected by the hurricane itself. So reflecting that example of a repricing event. So that's the first point on housing prices. And then now talking about the second and third points of mortgage-backed securities, mortgages, and the government-sponsored enterprises. I think that that's an interesting several papers in the literature documenting there seem to be evidence of strategic shifting of climate risk in the financial system. So and we think of this as like adaptation to climate change through shifting of risk. So evidence suggesting that home buyers can shift climate-related risk to banks via risky mortgages that they default upon when disaster hits, and that destroys the value of the collateral assets. Right? And then the banks in turn can shift this climate-related risk to the government-sponsored enterprises through the process of securitization. So let me elaborate a bit more on the first point. So in a working paper that I have with Laura Beckerson and Russell Wang, we were surprised to find the following empirical findings in the data. So we use coastal real estate transaction data in the US. We find that all else equal, a property that is more exposed to future sea level rise risk is more likely to be leveraged. So more exposed houses are more likely to be bought with a mortgage. That's the first finding. And then condition having a mortgage, exposed house are more likely to have longer maturity mortgage, more likely to have 30 years than 15 years. And maturity is important, right? Because climate change, like I mentioned, is a long-run risk. So a longer maturity mortgage contract are more likely to expose with more risk than a shorter-term maturity, right? And this pattern is particularly strong when the buyer is more likely to be pessimistic about climate change, and that's based on either belief survey data or based on our own imputation of beliefs based on housing price and transactions. And this, for us, a little bit surprising at first, but then if you think about that, we wrote a model. It's very consistent with the idea if home buyers can potentially shift the climate risk to the lenders with the option to default on a mortgage in the long run when the disaster actually eventually hit. And so, but then you might think, okay, so why are the banks, the lenders, maybe optimistic to willing to give out these loans to these risky loans? And then actually, there's some recent work documenting that the climate securitization mechanism. So banks tend to securitize and offload mortgages, risky mortgages, to properties, loans to properties that are at risk of future climate risk by securitizing them, right? So because the idea here is that the government-sponsored enterprises, the rules reflect historical flood risk, but not forward-looking future flood risk due to face sea level rise. So as a consequence, the government-sponsored enterprises are pretty much optimistic in a sense. They base they not fully take into account climate risk, and as a consequence, climate risks are being shifted to the government-sponsored enterprises. From several works by Amin Ozad and Matt Kahn's been documenting this climate securitization hypothesis. So, and these kind of works, I think, lead to some potential important policy implications. So first of all, kind of interesting is that we usually think of adaptation. In general, we should protect our economy, our homes, our firms from climate-related risk. However, adaptation in the financial market could have an interesting implication. So, in particular, strategic adaptation in financial markets might have adverse effect on financial stability because it might lead to concentration of climate risk in a few systemically important institutions like the government-sponsored enterprises. Also have implication because the concentration of risk, the shifting of climate risk, may make prices of agency MBS, so MBS by the government-sponsored enterprises, sensitive to climate-related risk, right? And let's remind ourselves that the agency MBS are commonly used as collateral in the repo market, so that some movements in MBS pricing might have implications for financial stability. However, to be clear here, right? These are potential implications. Much more work is needed to estimate the degree of concentration in of climate risk in the GSEs, and much more work is needed to estimate the MBS sensitivity to climate-related news shocks. These are, I think, the wide open questions for future researcher. And then Another implications, and that's relevant for us, the audience in here today in the central banking world, because we tend to think of things in the medium term, 5-10 years, not 50 years down the road, right? So because the literature has pointed at the fact that even though climate risks are long run, but climate-related news or belief or salient shocks are not long run. They're well within the business cycle's frequency, right? And therefore they're relevant for policymakers and central bankers. Again, back to example that $1 billion disaster, like most of them hurricanes, which happening pretty much every year now, very high frequency now. This $1 billion hurricane can lead to repricing in the coastal housing prices that I mentioned to you earlier, and also can and this event can increase the climate securitization of conforming loans that are exposed to higher future sea level climate risk, and also lead to reallocation of loan portfolios in banks. I have another working paper. We found that after the big hurricane, large banks actually reallocating their portfolios of home equity loans to adjust to adapt to future flood risk. So this disaster can provide news that trigger changes in the financial markets. And then one of the last slides I'm going to show you here is that it has implication for the modeling. So the current climate macro models, I think they're not yet useful to guide policy discussions on climate change and financial stability, and largely because they don't have the financial accelerator, right? So, so I think we can do this by simply, I think we can augment an existing, say, DICE model with a financial accelerator, either think through a Bernanke-Gilchrist or Kiyotaki and Moore kind of framework. And also that's one side to the amplifier, but also we need to incorporate shocks to beliefs about the long-run risk, right? So, for example, I have in mind is that a prototype of a climate macro finance model could be something like this. A model where the shocks to climate belief coming through news, so a new IPCC report, new national climate assessment reports, learn news disasters, or that lead to belief updating and learning. So shocks to climate beliefs that affect how prices collateralize assets, in particular housing, and then through the financial friction and acceleration, that's one known in the literature, that can lead to discernible impacts on macro variables that we all care about. Right? So I think that's a very exciting opportunity for us to build this kind of climate macro finance models to think about these important policy questions. So let me just conclude here. I think it's really exciting time to be a climate economist, and I will really hope to see the literature converging, the three different silos of the literature converge together to get a grand unifying theory that combines both the climate macro that provides good empirical, reliable empirical estimates of elasticities with the climate finance literature that provides good insight into how asset prices and risk management are anticipating future long-run climate risk. And with the climate macro literature, I've been thinking a lot about social cost of carbon, tax and policies, and I think a new nascent little field of macroprudential climate policies. So let me just end here. Thank you.
So now we have some minutes for questions from the audience. If you are in the first rows with a microphone, a set microphone, please, you need to turn it on and also turn it off for getting next questions. And also we'll have a microphone for the rest of the audience if you want to raise any questions for James. Elias.
Thank you, Professor, for that great overview. And I thought the discussion was also a very good complement to some of the ideas that you discussed. I wanted to make a comment, really, perhaps a challenge on some of the issues that you mentioned. I thought it was a very relevant point you made about the fact that all the models out there find really small, direct macroeconomic effects of climate change. So, for example, I've looked into this issue using the NGFS models, which tend to find large effects. And those effects are 10% of GDP towards the end of the century. But as you will say, you take the central shared socioeconomic pathway of the IPCC, and GDP is expected to actually increase fivefold. So, 10% of fivefold, this doesn't look so bad. So it's a small effect. And I thought your point of, maybe things that have a direct small effect can be amplified. And I thought that the discussant also touched upon this with a particular view on the financial system. But I want to challenge the view on the direct effects. I mean, those effects of the 10% loss of GDP are simulated on scenarios where the temperature increases by 4 or 5 degrees. I mean, these are catastrophic scenarios. And to think that we are going to have 4 times the current GDP in a world that has 5 degrees Celsius is just telling us that our models are wrong by orders of magnitude. I'm not sure where they are wrong. I mean, that's kind of the work that we're trying to do at the NGFS, but I think that there is a consensus that at least the physical impact models are getting it wrong, but wrong in orders of magnitude. So let me just offer an idea, and I think maybe Justin Johnson will speak about this when he touches upon broader aspects of nature that are involved in the environmental crisis, because this is not a climate crisis, it's really an environmental crisis that touches upon many dimensions that I think are well captured by the research on planetary boundaries. So climate change is one of the dimensions. You have many dimensions, and the key aspect is that they interact and mutually amplify each other, right? And we just finished a review on macro modeling on these topics, and I would say roughly 90–95% of the models that you review basically have one environmental stressor, typically temperature increase. That's it. And there's a discussion on what the elasticity is of increasing 1 degree on the damage function and so on. But in reality, there are multiple stressors. And when one gets worse, it worsens all the others, and pretty soon you get an amplification that makes this problem highly nonlinear. I mean, each dimension is nonlinear in itself, but the interaction between them further amplifies this nonlinearity. And we are not, at least in my reading of the literature, we are not even close at being, using models that capture this well. But I think as we make advances on this topic, we will soon find that the direct effects are pretty large. But that's just a hypothesis at this point. So that would be my comment. Thank you.
Thank you, Elias. Any other questions? Yes.
So I got interested in the difference you showed between the carbon tax and the cap and trade system. And I wondered, I mean, I have an intuition, but I wondered if there is a narrative behind this. I mean, intuitively, I would say that a cap and trade system is going to generate more uncertainty for the firms who have to make investment decisions. And on top of that, the cap and trade system implies that during economic booms, supposedly with a cap, the price is going to also boom, and it occurs at the moment where maybe the firms are more willing to generate investments. And these probably also parallel, the vision of environmental quality regulations in general, where when you delegate more actions to the agents who are burdened by the policy, generally there is a larger cost. But maybe there is another narrative, and that's why I'm asking. Thank you.
Thank you. Yes.
Thank you very much. Very interesting presentation and discussion. I have 2 questions. First, you mentioned the results from your paper on carbon taxes and how they are different from the results from the other paper from Diego's on the cap and trade and so on. You said it's not econometrics. I trust you if you say so. I wonder what in your view, if you can elaborate, what might be driving the difference in the results, because they were surprising. No, I mean, as you said, we tend to think of carbon pricing as this thing with several instruments, and and conceptually at least, they seem to be quite substitutable, but then you show results like the ones you show, and you're surprised. And then the second question I have is on your blank slide on the economics of adaptation. So I wonder, in your view, what are the elements that the academic community should be focusing on to fill that blank page on that dimension? What are the areas in which you would like to see more research on the macroeconomics of adaptation? Thank you very much.
Thank you. So, Jim, a lot of things to address now.
Okay, good, great. These are really great questions. Yeah, I think this question about what, are these, do we really think this 10% on a factor of 4 or a factor of 5 is a plausible thing? And you're right that some of those are for like a 4-degree world. So no, that just doesn't sound right. That doesn't sound right. But I mean, as you start to parse that, you really just get into this science fiction stuff. Like, well, what if we move a bunch of our production underground, or, change the way, and we could still have GDP living underground, and there are parts of the world that, have sort of, you outside at night and not during the day. But I think that just goes back to the problem that GDP is just an incredibly poor measure of overall welfare. And if you think about planetary boundaries, part of that is effects on human welfare, but part of it is actually just taking what are the effects on ecosystems and treating that as having direct value. So I think that goes back to the second part of this conference. So I don't actually disagree at a really high level with you. I would actually just interpret that as, well, I would interpret that as a problem with the GDP, but you might interpret it as a problem with the models, but this is all, but I do actually go back to my point, which is that why don't we just declare victory? $190 is big enough for us to get on with the job, and we should just get on the job of the decarbonization enterprise, and then thinking about the implications for monetary policy. This question on carbon taxes and cap and trade. Yeah, so there's two big things. One, the fluctuations in the cap and trade system are these unpredictable ones, and they're fairly high frequency. And so that has two features. The unpredictable part means that you don't have the incentive for investment in that, so you're going to have a discouraged amount of investment in transition to green power. Second is, if it's high frequency, then you're just stuck with short-term, there's another way to say it, but you're stuck with short-term elasticities. And we know that demand for electricity and demand for steel and so forth, short-term elasticity is really, really small because you've just got those things locked in. And where you have time to adjust is when you say, gosh, this is going to be with us for a long time, and then we can be playing off of the long-term elasticities and smoother transitions. So I actually think this is really speaking in an important way to what we often think of as two different flavors of carbon pricing, is actually having very, very different implications because of the fluctuations and pricing fluctuations. Now that's speculation, but it's consistent with these results, and it'd be great to get more evidence on that. On the economics of adaptation, we're going to hear a little bit about this, I think, from Tony, talking about international aspects and regional effects. And I know there's I'll plug a paper that is joint by my co-author Adrian Bilal and Esteban Rossi Hansberg, where they look at adaptation. They do a pretty complicated model. It's quite granular within the United States, and so they look at the effect of sea level rise on migration from impacted coastal communities to other communities, and then what are different policies that you might have. Should you go back and you rebuild in the coast? What if there are frictions on migration? So starting to ask the questions of what are the right sets of policies? Should we provide incentives for people to move? What if people get stuck and capital moves? So providing a modeling framework that allows us to ask counterfactual questions about adaptation policy at a granular level, and then be able to talk about welfare. that seems to me that seems to be like a great research agenda. I'm not saying this paper isn't the end of that agenda, and the work of Tony and Per is important in this area too, but that's an example of one important adaptation mechanism, which is just moving and abandoning certain types of areas. But there's lots of other, aspects of adaptation policy. I think Matt Kahn has really interesting work along different aspects of adaptation policy. That's more at a micro than thinking about the macro consequences, but thinking about some of that in GEQ is probably an interesting set of things to do too.
Thanks, James. And I think with this, we wrap up a very good start of our conference. Please give a round of applause to James and our discussants.
Thank you, Professor Stock and Mr. Fan. We'll interrupt the first session now to have a coffee break, but first let's take a look at a short video about today's program. So we'll have our break now, and let's be back here at 10:50.
Okay, thank you. Thank you for coming back. We are continuing with the second presentation in this first session. We have the pleasure of having Tony Smith. He is a professor of economics at Yale University, and he also served as chair of the Department of Economics since 2019. He has extensive experience on a number of areas of research in macroeconomics, and his most recent research takes place at the intersection of macro and environmental economics, where he's constructing global economic climate models with high geographic resolution. Benjamin Garcia from the Central Bank, he will discuss, and Tony, the floor is yours.
Thank you very much for inviting me to this conference. I think it's a wonderful program. And since I've been working on, for a number of years now on an interaction between macro and climate change, I've been invited to many of these conferences where I get to meet economists and physical scientists from all different disciplines, which I find really useful. All right, so today I'm presenting a paper called Climate Change Around the World, joint with Per Krusell. And the goal of the paper is to construct a global, dynamic, general equilibrium model of interactions between the economy, climate, and weather at a degree of resolution geographically that's very high, so 1 degree by 1 degree regions. You can view the model as extending Nordhaus's DICE and RICE models, where RICE stands for Regional Integrated Climate Economy Model, which have very little or no regional detail, to a dynamic, modern general equilibrium setting with many regions. And then we want to use the model as a laboratory to quantify the distributional effects of climate change and climate policy. So the new elements here are many, many regions and looking at distribution across space. And the long-range goal, which I might get to a little bit at the end, is to eventually couple the Norwegian Earth System model, or NORI-SM2, I'm working with 2 climate scientists in Norway, with this high-resolution economic model, so then we can actually talk about not just average temperature or climate, but can talk about variations around that path and include weather variables like wind and extreme temperatures and precipitation. That's ongoing work. If I have time at the end, I might have a couple slides on where we're going. But for today's paper, there's no weather, it's just simply economy and climate, viewed as average temperature. This is part of a growing literature on spatial models of climate change, allowing for adaptation across space, which I think is an important aspect of adaptation, not the only one, but one important one. And here's a partial list of references that I won't go over today, but you can see the list is, every time I present the paper, I'm adding another paper there. So this is just meant to illustrate that there's a lot of work working in this space right now. All right, so let me start with a picture of average temperature, annual average temperature in centigrade, the early part of the 20th century. And there are 19,000 1 degree by 1 degree regions here that make up this picture. And those 1 degree by 1 degree regions are the unit of analysis, or the agents in my economic model, and they're going to interact through financial system and through emissions. All right, so we're starting off there, and you can see there's huge heterogeneity in average temperatures. Now let me show you the log of GDP, or gross regional product, in each of these 1 degree by 1 degree cells. This is from Nordhaus's GEcon database. So again, there's large differences, heterogeneity in space and GDP across regions. All right, so let me plunge. So that's just to give you a warm-up. I've tried to put the whole model here on one long slide with no equations. So the idea is that we are, like in the DICE model, we're going to emphasize capital accumulation and consumption savings decisions, along with an explicit model of energy use. So in each region, you can view there as being a representative consumer, but then we have 19,000 heterogeneous these consumer entrepreneurs interacted around the globe. So we have forward-looking consumers and firms in each region who make consumption, savings, and energy use decisions. There's no migration in this model, but there is movement of capital, or differing patterns of capital accumulation, physical capital accumulation around the world. We have new classical technologies for producing final goods and energy, and these use capital, labor, and energy as inputs. We're going to think of energy as coal, so non-exhaustible, produced according to this production function that we specified in the second point there. We're not worrying about hoteling rents on, say, limited supplies of oil. Now, the key part of the way the model works is that regional TFP, total factor productivity, is going to be the product of an exogenous component, which is capturing those huge differences across gross domestic product across regions, plus, or times, another component that we're going to assume varies with regional average temperature. All right, so there are going to be local impacts of climate change coming through regional average temperature, and I'll be much more explicit about exactly how that works shortly. In this model, as I said, there's no migration, but there is movements of capital. All right, so we're going to look at two polar cases. One is autarky, where actually there is no movement of capital, so each region is on its own, but still connected through global emissions, through the climate system. And another extreme case of unrestricted borrowing and lending. And I'll get back to that later, why we look at those two cases. So in a summary, this looks a bit like an Iagari-Angelettos model, which is where I come from, actually. Some of my earlier work was studying heterogeneous macro models with heterogeneity across households. Here we're bringing that machinery, or that set of tools, into the climate literature. There are no shocks here, so there is no weather, as I said, although we're working on that, and they can be easily added. So we do have adaptation here of a certain form. One is consumption smoothing, so regions can save and consume in response to how they view climate change affecting their productivity in the future. That's present in the DICE model as well. But what's new here, when we're not in autarky, is capital mobility, which also allows for leakage. So if different regions have different climate policies, which we can also handle in this framework, then capital can flow in response to that. All right, so so that's the economics part. As far as the climate system and the carbon cycle, we have a very simple setup where global average temperature varies with the global stock of atmospheric carbon, and then the stock of carbon obeys the linear law of motion driven by global emissions of carbon. All right, so in the economic model, regions are emitting, they're all small, emitting carbon in the atmosphere. That carbon in the atmosphere, as we know well, affects the stock of carbon, which then affects global temperature. There's another way to model this, is the global temperature varying linearly with cumulative emissions since the Industrial Revolution. We use the first two, but you can alternatively use the third, and we're going to use that in the later work with the climate scientists. And then locally, how do things work? So regional average temperature drives total factor productivity in that region. And we're going to let it vary linearly with the global temperature being what's called a pattern scaling or statistical downscaling relationship with region-specific slope coefficients, which we have asked climate scientists to compute for us. And these are all reasonable simplifications of the dynamics of Earth system models. Okay, so you tell climate scientists what we're doing here, they think it looks reasonable. It's not capturing the full complexity of an Earth system model, but it's a reasonable approximation. All right, so let me show you these coefficients I mentioned, which govern how regional temperature varies with global temperature. So imagine that the global temperature increases by 1 degree in centigrade. By how much, say, would northern Russia or, say, Chile, according to this map, by how much would its temperature change locally? And you can see there's huge heterogeneity. This is well known by now, and it just comes right out of data and climate models. But so the northern regions of Russia are going to warm by much more than is Chile or other parts of the world. So there's big heterogeneity. So we have sort of 3 dimensions of heterogeneity. We have different initial temperatures, all right? And then we have different levels of GDP in all the different regions. And then we have this heterogeneity and sensitivity to how your local temperature varies with the global temperature. All right. So later I'm going to have a model which, and first I'm going to get some water. Excuse me. Sorry about that. So later we're going to have a model in which we run out the global economy at this high degree of resolution, and then you'll see precisely this map reappearing. I won't show it today, but just remember it. When the globe warms by 1 degree, that shows exactly how much the different parts of the globe are going to warm. Okay, so we have a global equilibrium here. So I just want to make an aside too. This is like the diametric opposite of Jim's fantastic overview earlier. I'm presenting a very specific paper here, but I think has some provocative findings about spatial aspects of climate change, which I think have been corroborated or seen in other types of work too, people in this room even. So, okay, so just to talk about equilibrium conditions, so the idea is that we have these forward-looking consumers. So each region sort of makes optimal decisions on consumption savings and energy use, taking as given a path of the global temperature, which then determines their regional temperature, which is what they care about, and the interest rate when we have financial markets. And then, given these decision rules, you can run the model forwards, and I'll show you one short simulation later. So then the implied path of global emissions must generate the path for global temperature. That's a perfect foresight assumption here. And the global bond market clears in every period. That's the interest rate adjusting to do that. So with free capital mobility, one thing we quite like about this model, in a way, it's just a short step away from the DICE model or the Golosov, Hassler, Kusel, and Savinsky model in econometrica that is sort of the modern macro counterpart of the DICE model. With free capital mobility, the model aggregates. So we only need to solve the problem of a global stand-in consumer taking the global temperature as given. That makes that model quite easy to solve. And there's a sense in which it exactly nests the DICE model then. It really is, if we calibrate it as the DICE model is calibrated, then it really is the DICE model. Or in a more modern parlance, it's the Golosov model because it aggregates. But in autarky, it doesn't aggregate. And so then we need to solve 19,000 dynamic programs, one for each region. They each have a different path of their productivity going into the future. So that leads them to solve different problems. Remember, they have a different initial temperature and a different sensitivity to that global temperature change. So they all have differing paths of productivity. But this is not too hard to do on a parallel computer. All right. So now, what about our damage specification? So there's a lot of work here, and this may probably, as everyone in this room knows, is the weakest part, I would say, of the economy climate literature. What we're going to do is take a somewhat different approach, is we're going to imagine that the damages in region I, okay, let me back up. That's not the different approach. We are assuming that the damages in region I depend only on their local temperature. I've already alluded to that. So total factor productivity in region I is a function, D, of local temperature. And that function is going to be common across all regions. And it's going to have an inverse U shape, which varies between 0 and 1. So you can imagine its variation relative to the exogenous component of regional TFP. And when the temperature changes, you have a varying productivity relative to that. And here's the new part. We're going to reverse engineer this. So rather than do a top-down estimation or a bottom-up estimation, I applaud all those efforts, we're going to instead do something different. We're going to reverse engineer this U shape so that the high-resolution model generates aggregate damages from changes in the global temperature that match, say, what comes out of Nordhaus's dice damage function or some other aggregate damage function. We're using Nordhaus's today. That's probably a bit low relative to the literature now. We could use a different one. But the point is that the idea of doing this, the methodology doesn't depend on matching Nordhaus's dice function. It's more the idea of doing reverse engineering. So I guess the view there is we might trust somehow these aggregate damage curves as being reasonable, and then we want to come up with a local damage function that's kind of consistent with that, all right? And if someone were to present us with a different aggregate damage function, we'd be happy to use that and plug that in here. In some sense, all these models have to have that kind of consistency, and we're just reverse engineering. All right, so let me just show you. So remember, so it's all a drag on TFP, and I'll take the points from earlier that GDP is not welfare. Here we look at consumption, but even consumption isn't welfare. So, but nonetheless, that's our assumption throughout. Here is then our calibrated regional U-shaped damage function, the function D. And the idea is that there's an optimal point at which to operate. So we look only at level effects here, not growth effects as in some of Marshall's work I know, so sitting right in front of me. But we look only at level effects here, although Marshall kind of gets curves that don't look so different from this in some sense. So, and there's a different methodology. So we calibrate this, right, to match these aggregate damage curves so we get the right convex shape. And so it comes out in the calibration that, so the model generates this so that there's an optimal temperature to operate at 12 degrees centigrade annual average temperature. And then you see that if you fall away from that optimal temperature, your productivity relative to your exogenous component of your TFP, in which there's huge variation, as I mentioned earlier, changes. It falls off from there. All right. So the way to think about this, imagine that there's, a region in Russia at 0 degrees today. So its productivity is 0.5 relative to its exogenous component. And then maybe the globe warms by 2 degrees, and that part in Russia warms by 8 degrees. Or 6 degrees, which is quite conceivable, then it would move from 0 to 6 in this picture, and its productivity would change from 0.5 to maybe 0.75. And that would lead it to accumulate capital differently. When they're international capital markets, it also attract capital from elsewhere, places that are declining in productivity. All right, so this is an important curve. Let me try and suggest to you that it seems reasonable. So here's a picture which we then looked at to see whether it seemed reasonable, whether this passes the smell test. So you can see here that the highest productivity region, so 100 means you're near the peak, are exactly kind of where you'd expect them to be. It goes through New York, a good chunk of Europe, through Tokyo, Beijing, Australia, the southern part of South America. So, and then the low productivity areas are, say, northern Russia, where it's super cold, or the Sahara, where it's super hot. All right, so this picture kind of seems to be reasonable, and note we didn't calibrate to that picture. That was like, okay, we're done with the calibration. What does the picture look like? And we think it seems reasonable. All right. Let me. It's important here for the welfare effects to note that, and again, it's another check on this, is that most of GDP, 22% of world GDP in 1990 is taking place like near the optimum. So it'd be a little odd if that weren't the case. It'd be a strange calibration. And then not much GDP is happening, not much output is happening at places with lower regional TFPs, either because they're very hot or very cold. All right, but importantly, a large share of the global population is living in places with regional GDP that's quite low. And so this will actually drive some of the welfare results, as you see shortly, and it kind of gets at some of these inequalities, ideas of global inequality and how it relates to climate change. All right, so because many of those people living at low regional TFP are living in hot places. And you can see that if you live in a hot place, going back to this picture, if you live in a hot place, then you don't want to get hotter. It drives you down. If you live in a cold place, you might not mind getting a little warmer, all right? So there's heterogeneity here, and that's what we're trying to study. So let me just make a few comments on the model. All right, just to kind of review a little bit. So at the aggregate level, this spatial model with free capital mobility nests the DICE model. Agents make forward-looking decisions anticipating future climate change, so just as in the DICE model. Regional damages are assumed to have an inverse U-shape calibrated to match aggregate damages, in this case coming from the DICE model. Spatial adaptation takes place through differing patterns of capital accumulation across regions. And here I want to get back to something that Jim said when discussing, say, models of adaptation, that we think it's quite important to write down, this is what the macroeconomists can bring, I think, is to write down a fully specified microfounded model that permits quantitative analysis of behavioral equilibrium responses to counterfactual changes in climate policy. So we have a handbook paper in the Handbook of Macro and Environment and Macro, where we kind of make this point that measuring the marginal externality damage of carbon emissions, say, keeping behavior constant in a given allocation, is not the same thing as the optimal social cost of carbon, right? So those are two different ideas. And so you need a model that's going to allow for these behavioral responses. All right, and then we built one that allows for some aspects of adaptation, but not others. All right, so let me talk about the experiments we're going to do. And I'm actually going to come back to this first point about free capital mobility here and autarky. We got a surprising result there. All right, so experiments, we're going to do some laissez-faire experiments, so no carbon policy. And then we're just going to have a policy experiment where every region imposes a common path for carbon taxes, and we view it as financed locally. So there are no interregional transfers, that the revenues are just rebated locally. And throughout, we're mainly going to focus on relative effects, not aggregates, because by design, the model's kind of supposed to look like other representative agent or one consumer models. So at the aggregate level, not much is happening. Where things are happening is in the relatives. So here are the main findings. I could just stop there, I suppose, but I'll flesh this out a little bit. But this is important. So this is what we find, that climate change affects regions very differently. The stakes are big at a regional level. Now, when we first started doing this too many years ago, I think that was a little bit provocative. I think now more and more estimates from different approaches are finding, in fact, that regional heterogeneity is large. And this is like another take from a different methodology that kind of confirms some of those findings. So, for example, although an optimal tax on carbon, here, what I mean by optimal is what would be optimal in the DICE model. So if you have free capital mobility, you can aggregate this model up to a representative global consumer and imagine, and don't worry about distributional issues, find a global tax that maximizes that welfare of the stand-in consumer. So it's probably a little bit lower of a carbon tax than what is standard in the literature now. In any case, what we find is large disparity of views. Many regions gain, many lose, all right? The average consumer gains, but there's heterogeneity across regions. We also find that the findings are very close for two extreme market structures. So actually, it turns out it didn't make a whole lot of difference. And the reason here is that regions can respond optimally to how they perceive their productivity changing in the future, and they have a high elasticity of substitution between today and tomorrow. So they're quite willing to shift capital around, and it turns out that they end up in an allocation that pretty much equates marginal products of capital across regions. So there are some differences, but they weren't very pronounced. So given our calibration, and also given that climate change is happening relatively slowly here, you have time to adapt through consumption smoothing. So it turns out those two market structures didn't give a very good different answer, which was nice for us because then we didn't have to think about so much like how do you do an intermediate case and what are the frictions that might impede financial markets. So we're going to look pretty much just the rest of the talk on free capital mobility. Climate change leads to large increases in global inequality in GDP per capita is another finding, so we can use the model. And the tax on carbon mitigates these increases only to a small degree. So I'll show some of these pictures. First, let me show just one global picture. This is showing global emissions of atmospheric carbon in gigatons. The top line is with no taxes. And remember back from my slide, and maybe I didn't even say it about how the model works, we imagine we don't want to, we're pushing in the spatial heterogeneity dimension, we're not pushing in any other dimension. We just imagine that there's a green transition happening exogenously. So eventually things become green, we're not modeling that, but we think it's important to calibrate to something like that. So eventually all emissions through whatever technologies become green, or there are no emissions. That's why there's a hump shape there at a certain point. And then with a carbon tax, you see that you reduce emissions dramatically, and eventually they all go to zero through a green or backstop technology that eventually comes online. All right, so these pictures look exactly like what would come out of a similarly calibrated DICE model. All right, so now we'll get to some pictures. So I'll just show one set of pictures here. If you want to see a whole set of movies, you can go to my website. Normally I would click on that link, but I'm afraid it wouldn't work, so let's just, we'll just click through it. So I'll click through an example that kind of results, and I actually find these pictures very instructive because it's a lot going on. It's hard to get your mind around a big matrix of numbers, as we were just discussing earlier. So here is showing 10 years out, according to the model, GDP relative to a long-run growth path of 1% assumed here, so no growth rate effects, just level effects. So relative to that path, is your GDP lower or higher than it would have been? And here you can see that 10 years out, some regions have gained in productivity and so are gaining in GDP, and some are losing slowly, not quite yet, but we'll click through this, and then you can see that, not surprisingly, Russia, now you can already see Russia's gaining a lot. It's getting warmer there. That makes it more productive according to our model. So more capital is going to flow there or be accumulated there, and GDP is going to grow there relative to the trend path. Whereas a hot place like the Amazon or the outback in Australia or parts of Indonesia or Sahara are losing because their productivity is declining because they're already hot. All right, so you see this big heterogeneity, and then you can click this out a number of periods, and now we're getting to the point where emissions have peaked, and emissions are going to slowly decline, and so the temperature is going to come back down a little bit. Some of the emissions are assumed to last forever, so the temperature asymptotes at a new higher level, and I didn't want to go to that picture yet. All right, so that's the final resting point 300 years out boldly. So the idea there's this huge heterogeneity, and it kind of mirrors the picture that we saw for temperature and for sensitivity. All right, so now, okay, so that's an example. You can see more examples of other variables, so we can play out this economy and see how it goes. Now, welfare gains from taxation, so this picture looks kind of the same too. So now, because we have a fully microfounded model, we can ask, okay, we impose this carbon tax uniformly across all regions, it's rebated locally, who gains and who loses? You can see that Russia actually loses from a carbon tax here. It loses because the carbon tax slows down warming, and they actually like warming there. They'd like to warm a bit. There was even a Putin quote at one point along these lines that I no longer include in my talk, but that was suggesting that from a conference many years ago. Meanwhile, say, Sahara is very much in favor of the carbon tax because it slows down warming, and they're already hot and losing productivity. There's huge heterogeneity then, and I wanted to go back actually to this final picture too. You can see here that here the GDP changes, some of them are quite large. It's not 10%. Regionally, there's way more at stake here. It's not 10%, it could be 30% or 50%, either direction. So there's big changes regionally that kind of dwarf the global changes. All right, you can also do this, you can also add up welfare changes in different ways. So how do you aggregate up to a globe? So if each region gets one vote, as I said, 56% gain. If each person gets one vote, it's 84%. It's because many people are living in hot places. You could do this different ways. You could say $1 gets 1 vote. You could take the average gain weighted by regional GDP or by regional population. I don't know quite the right way to aggregate this, but the point is that there's a distributional effects. And so policymakers would need to think about those distributional effects as well. And I'm not, some people I know have worked on how to do that. I'm not doing that in this paper, how to aggregate up and maybe account for inequality. One final picture is you could aggregate to countries. So this is, again, this is percentage of consumption again. I just want to go, if I go back to this picture here, just reiterating, these numbers on the right-hand side, I should have said that, are percentages of consumption per period. So you can see that when you're gaining or losing, it's by pretty big numbers, but a macroeconomist view as pretty big numbers. So permanent changes in consumption of 4% per year are not uncommon across the globe. All right, that's in consumption per year. All right. So, so you could aggregate this up to countries, and again, you see huge heterogeneity. It's not so dissimilar from the previous picture as well. All right, so let me, okay, moving right along here, I will still have a few minutes left, so let me show another set of results, then some caveats, and then maybe mention a little bit about what I'm doing in the next stage of the work. So here we can look at inequality. So we're looking at per capita GDP by country using the 90-10 percentile as a measure of inequality. So that starts out at about 32 in 1990, and the top line with the triangles is with laissez-faire, so no types of policy at all. There is green technology coming online, but there's no policy designed to accelerate that. So, inequality increases to 46 by this ratio. So large an increase in inequality. And you can't really get that number without having a full-fledged model, a macro model of how the macroeconomy is going to evolve under climate change. And surprisingly here, although the optimal tax has a big effect on emissions, it doesn't really have, and on regional heterogeneity, it doesn't affect inequality though, so somehow. So there's regional heterogeneity, people feel differently about the carbon tax for sure, but inequality doesn't really change that much, all right? So these are the kinds of counterfactual experiments that one would like to use a model for. So takeaways. So climate change in this model is about relative effects much more than average effects. Admittedly, those may be somewhat small here because we're using the dice damage function and ignoring maybe other factors that might matter, as Jim was saying earlier. There are large disagreements on climate policy, and there's a methodological insight that is a quantitative point, but a useful one here, because it's not a general point. You can think of models where it won't work, and I explained some of the mechanisms earlier, but we thought the market structure, because it emits more or less adaptation, would be important for the results, but it isn't. All right, so building on the platform, we really view this as a long-range project, and there are, papers. There are many papers, more and more papers, studying different aspects of spatial adaptation, some with trade, some with migration, not so many with focusing on capital accumulation, but even there's some work. So in any case, we view this as a platform we can build on, and we think it's nice that it makes a sort of tight connection to the classic macro models of climate change. We're kind of like not moving too far away at once from that classic models, Nordhaus's Nobel Prize-winning model. All right, so there's a sense in which the damages are too local here. So I know that this conference is partly about effects of climate change on ecosystems. I don't have that in this paper at all. It's all very local, unless the ecosystem is a very local ecosystem, but we think of ecosystems as involving whole regions of countries, not just small 1 degree by 1 degree cells. So we don't have that in the model now. We don't have enough heterogeneity and regional damages. You would imagine maybe some regions are poor is a possibility, or maybe there's rural versus urban, or at different types of production. Maybe they're affected differently with different U-shapes. We don't allow for migration, which is a hard problem, but we also think it's important that when you study migration that you retain forward-looking consumption savings decisions. I mean, that margin of adaptation is quite important here, so how do you merge those? But what I'll spend the last 3 minutes on here is just weather as well as climate. So climate is a probability distribution over weather outcomes. And weather can be, even global temperature is a very stochastic process. In other words, it's a lot of randomness, even the global temperature, even more so at the regional level. And then weather is really maybe more what we care about. We don't care maybe necessarily about average temperature. We may care about extreme weather events, extreme temperatures or floods or high winds. And so we want to bring in weather here into this type of model. Bilal and Rossi Hensberg, I think, are doing that. Jim mentioned this paper earlier. One of the few papers I know that's bringing that in, looking at detailed model of the U.S. economy by county. So, so one advantage of doing this is you can bring in these rich set of stochastic weather variables. Also, there's then no need to simplify the geophysics. There's some literature on economists capturing the geophysics of these Earth system models properly or not. We're just going to use an actual Earth system model. And then, what's useful here, why have a model with these climate risks here viewed as weather? So weather shocks are a climate risk. Does a hurricane hit this region and not that region? Do extreme temperatures, do they happen in one location or not another? Maybe they happen for several years, but then not for several years. So there's a lot of risk there coming through weather. And then we can use the model then to sort of study institutions for sharing these climate-related risks, because the model's all set up to do that. Maybe national governments can share climate risk somehow, coming through stochastic weather variation. So I'll say, so here's just a picture. All right, so I did get to this. So this is a picture showing an error 1 coefficient for regional temperature coming out of these climate models. So it's showing so we're going to model local temperature not as a smoothly, continuously. So the average temperature in each region is going up smoothly, but around that there's some variation, these shocks to weather, and then it turns out that there's differing persistence. So the blue is very low persistence. So their annual average temperature has very little persistence from year to year. There's still this trend, remember, but now we're talking about variations around the trend. In other places, say parts of China, it seems, is very high persistence. So heterogeneity in weather and the persistence of weather shocks, and this is showing standard deviation of the shocks. So you can see, and these is in centigrade here, so these standard deviations measured in centigrade. So some regions have very high volatility of shocks, some have very low volatility. So we want to bring in, as a first pass, just bring in that set of stochastic processes for local weather into the model. And in my last I love having the time right here, my last 42 seconds, my last slide. So computing equilibrium with weather is a challenging project. So that's where I'm headed now. So I'm glad I got a chance to kind of say where the project is going. This is really where our focus of our research now with the 2 climate scientists in Norway. So you can't embed an Earth system model into this macro model. It's just too high dimensional. So our idea, and I'd be happy to get feedback on this, is agents will form expectations of future weather using an approximation of the dynamics in NORI-SM2. Then we'll iterate backwards in the usual way to get decision rules based on the approximate expectations. But then when we simulate forwards, we'll use those decision rules and the actual dynamics of NORI-SM. And then we'll find a fixed point, as usual, in these macro models. But now it's not in the correct expectations, but in these approximate expectations, which seems quite reasonable because I don't doubt agents are using the full dimensionality of an Earth system model to make their projections. So there are a couple methodological challenges. One is that these Earth system models have no shocks in them, which comes as a surprise to economists. Instead, they have nonlinear chaotic dynamics. It's all coming through changes in initial conditions and nonlinearity. It's quite surprising when you see it in practice. I knew this, but seeing it in practice is something else. So how can we use stochastic shocks to capture nonlinear dynamics? Also, there's a timing issue. When we run the model forwards, we have to link them, but the economic model runs on an annual time step, maybe at best monthly, whereas NORI-SM actually runs at a half-hourly time step. So that's where we're headed next. We've got some prototypes going, and please stay tuned. Thank you very much.
Thank you very much, Tony. Now we have Benjamin Garcia. He will be the discussant. Benjamin is from the Central Bank of Chile.
Okay, so first of all, thanks the organizing committee to allow me to comment on this paper. That is very insightful and very interesting in terms of acknowledging that the world is not just one world, it's a bunch of different regions that everybody has different endowments, everybody has different weather relationships, and that heterogeneity matters, and they show that matters a lot. So what are they trying to convince us? They're trying to convince us that they show a bunch of plots like that, where they show us that temperature, they have GDP, they have sensitivity from temperature to GDP. It's different across regions, it's different across time. And they're trying to convince us, and they do, and they are very convincing in doing that, in their job, that taking the world as a whole may be losing a lot of the dynamics, and a lot of the effects of climate change come not from the aggregate, that is still very important if you think as a global ecosystem, but the heterogeneity and the distributional effect of climate change can be of first order. So what does the paper do? They build a global general equilibrium model with high degree of geographical resolution. They have 19,000 regions. I don't know what kind of computer they used to solve that, but that's what it is. They have heterogeneity across region, across time, on temperature, on productivity, on the elasticities between temperature and productivity. And basically the idea is that energy production leads to carbon emissions. Carbon emission leads to increases in temperature. And then changes in regional temperature are linked to change in productivity with an inverted U shape that, as he showed just before, means that in Siberia, they pretty much like to be have a little more sun, but probably in Brazil, they have enough hot already, and they heat it already, and they will probably get less productive the higher the temperature. Then they show that carbon taxes are needed for agents to internalize the effect that production has in global temperature, in global warming, and then how that affects to their productivity. Okay, so what are the main insights from the paper? First of all, is that heterogeneity matters, and it matters a lot. Okay, so that's probably the main insight of the paper, and that the effects of temperature rising are very different across regions, and also that the effects that a common global carbon tax have big disparity in their effects. Some region could face like 30% in consumption equivalent losses, while other region can actually have 10% gains in consumption equivalent. And that, of course, if you are trying to negotiate one global tax, poses a lot of issues. So what are the taxes if some people are going to lose, some people are going to gain? And overall, the idea of the paper, they show us that climate change leads to big increase in global inequality. And perhaps more interesting, because we're always shown that capital mobility matters and change everything, here it apparently doesn't change much. That if are intra-regional there, you can invest, it's no different than if you could flew capital from one country to another. So now I'm going to say that, as I say, they make the big point that heterogeneity matters. Now, what I'm going to show that maybe different dimension of heterogeneity also matters. And the first one is something that is discussed a lot in Chile, that the effect of endowments, green energy transition, and input complementarities. So we can see at the left, we have a map where different countries has show their proven oil reserves, and at the right we have the lithium reserve, where lithium is generally acknowledged to be a big winner in the green transition because they are needed to store electricity in batteries, and all the green transition it's very complementary to building batteries. So, for example, well, in Chile we have no oil, and we have a lot of lithium. So probably a green transition, it will be a net gain for us in this dimension. And then you see Venezuela, it's the opposite. You have a black there, a black dot at the north of South America. They have a lot of oil, but if you you see the right plot, they have no lithium. So for them, it's probably a really painful transition to green energy, where they're gonna have to probably import a lot, probably don't have much to do with their exports. And that could, of course, increase the change when our assessment of who are the winners and who are the losers. We probably could have a similar plus where you can see that average sun per day in different countries is probably very heterogeneous. Average wind and stability of the wind is probably pretty heterogeneous across countries. And there's a lot of heterogeneities that I want to put the point that if we are moving in a transition towards a greener energy, the complementarities of each country's endowments could be a big factor in determining who are the overall winners and overall losers from the transition that apparently is something that is going to happen. Okay? Yeah. So in the base model, this psi t, I think it's the x, it's a reduced form variable that shows how green is the prevailing energy bundle. And importantly, it does not affect the cost and efficiency of energy production. Now, if this assumption holds or not on average may not be of great importance for the overall conclusions of the paper. But however, the fact that the transition toward green energy may affect countries heterogeneously, depending on their endowments, being commodities, being wind, being solar availability, can have relevant implications in the distribution of who's the winners and who's the losers of going green. The good thing is that the implementation should be straightforward. That's like the energy technology function that they come from the paper. And the blue thing, the Z, is a technology that you could add that basically say that the prevailing energy bundle, the greenness of the prevailing energy bundle, could have a different complementarity with the endowments that the country already has. So some countries like Venezuela could have that as we move to higher greener energy, the complementarity with their natural endowments goes down. Maybe Chile, that has a lot of place for wind, has a lot of place for solar, has a lot of lithium to make batteries, who have a higher complementarity between their endowments and the costs and benefits of going green and be part of having a greener energy. So that's one of the things that I think will offer a lot who's the winners or who's the loser. I mean, here we have like Russia that is big in oil. We already have the heterogeneity that comes from temperature with all the northern part. But okay, this could have another dimension. Okay, maybe Russia will be not so good with a green transition because, well, their main commodity is now not of so high demand. And well, of course, you have the US that, as always, has a bunch of everything, so I don't know if they're going to be better or worse with this dimension. But so that's a point. Another kind of like heterogeneity is related to biases and learning. So this is a nice map that I got from a paper from Lee and co-authors from 2015 that basically plots survey answers about the awareness of climate change. And not only the awareness of climate change, but the people that are aware that climate is a thing. It's an important thing. It's something that we should be care about. And one, not everybody thinks the same. And second, the people that actually think it's a zero threat is disappointingly low, in my opinion. I mean, this is 2015. Maybe now it's a bit better. So an important thing is like if you see the US, for example, you see India, you see China, you have three big countries with a lot of population, a lot of political power, and they don't seem to care too much about climate change. So on the one hand, you have the US and you have China, where there's plenty of people that think, agree that climate change is a thing, but if you move to the right part of the chart, they don't really think that is something that we should be worried about. On the other hand, we have India, that very few people think that climate change is even a thing, but at least those that think about it, you can see that it's very, very dark red in the red line. At least those that think that climate change exists, they think it's a zero threat. So, but overall, you have a lot of big countries with a lot of political power, with a lot of people that are not really sure that this is a thing. So, like within the framework of the model, the perception of existence and dangers of climate change might be biased. And if elected politicians or policymakers don't fully internalize the consequences of climate change, that in this reduced form, I'm saying that maybe the perceived elasticity from carbon to temperature and from temperature to productivity may be biased, it is likely that the prescribed tax that they would like to have will deviate from optimal. Now, hopefully, there's a learning process where D hat and T hat converge to D and T. And of course, in a simple signal extraction problem, you could evaluate something like that. And then geographical difference in the signal-to-noise ratio could lead to this heterogeneity. So maybe countries that have high volatility in temperature find it harder to assess the difference that comes from this shock. But maybe it's not that easy. Maybe people, especially with things that climate change, don't behave like an optimal structure signal extraction agents, and behave some more like, the 5 stages of grief. Maybe they start with denial, they slowly go through anger, say why this is happening, who's guilty of this, and then go back and forth and eventually get to acceptance that this is a deal. Of course, those non-linearity in a person are hard to predict, but on average, a regional prediction could be made, and you could think that this could be predicted with a simple linear regression where you think, okay, maybe countries that are bound to get good news with the green transition are more likely to accept the existence of climate change, and I don't know. So, concluding, I have 10 seconds. This is a compelling paper on the quantitative importance of climate change and welfare, but even more important is a very compelling paper on the importance of regional heterogeneity. And what I'm proposing is that incorporating some additional sources of heterogeneity may improve the model predictions. And I propose 2 such possible extensions that I think would be a good way to improve on the model prediction. Thank you.
Thank you very much, Benjamin. So now we have some time for questions from the audience. Yes, Jim.
Great. This is really terrific work. I'd love to hear a little bit more. So this U-shape curve of TFP as a function of temperature is obviously sort of a key piece that's driving this. I'd love to hear a little bit more about the micro evidence for that. So productivity, that makes a lot of sense, and agricultural productivity, that makes sense, and labor outdoors and so forth. But TFP, sort of think about knowledge spillovers and inventions. You think of, I think of that as being sort of fairly mobile, and you can imagine that being more mobile going forward. And then there's a question of what sort of you focus on inventions doing, and those might well be the areas that are actually the most stressed. So you think about the innovations in crops during the Dust Bowl and post in response to climate. A lot of that was driven on, like, where are the real problems in agriculture, and so where do we need to do the innovation in new varieties. So so I guess a little more evidence on the U-shaped curve would be interesting.
Thank you. I have a question, taking the moderator's prerogative. So we have some results tomorrow in joint work with Elias that shows migration actually responds to climate events. And you have an assumption that migration is not a variable in your model. But if it was, how would you change the analysis on inequality? Because once you allow people to move, then there's a difference between the inequality at the regional level and inequality at the personal level. So maybe the inequality results are a bit sensitive to the existence or not of migration. Yes.
Thank you so much for a great presentation here. I had a question on one of the things you raised in the last couple of slides you had about some of the next steps. And you mentioned when linking with Earth systems models, one of the challenges is that these are chaotic, nonlinear dynamic systems, and that this can, I'm assuming, would lead to challenges in the solution method of the linked economic models. I was wondering if you could just first off, provide any more thoughts that you might have on that, unless it's too new. But secondly, I'm curious if there is a thought here, a good, reasonable, reasoned, principled approach to answering, what do you do if the Earth systems model cannot solve? Do we still report the results of that in our economics model, or do we actually have a risk that we would run here of only having ourselves look at model runs from the Earth systems models that do successfully solve? Could that potentially introduce some sort of bias in our analysis? Thank you.
Thanks for that. Any other questions?
So,
Yes, Luigi.
I have a comment. So, of course, this is a comment which applies to most climate models, and the one I will present to. And is the fact that, of course, productivity, temperature has an impact on productivity, but let's not forget that institutions matter a lot. And you could take the example of the California and Mexico, where they have very similar temperature, and yet they have completely different institutions, and to some extent there are also differences in economic performance. And I mean, there might be examples which are, of course, more extremes, but I think that's a point I want to make, and of course it fits into the popular debate with Acemoglu on one side and Diamond on the other on whether whether climate is in the end a driver of economic growth or not.
Okay, thanks. Tony, plenty of questions.
All right, can everyone hear me? All right, well, thanks for the great comments and the great questions. I'm not sure I can answer them all right now, but let me first say to my discussant that there's two dimensions of heterogeneity that I hadn't considered before, and I think that they're certainly very doable in this framework. So we do view it as a platform, and we can handle a lot of heterogeneity. Even in autarky, we can solve a lot of different dynamic programs allowing for full heterogeneity on a parallel computer. So I think the allowing the energy production function to vary by region seems very valuable. We've done a little bit of that in a new version. We're working on it. And then recognizing that there are different endowment. I think there's two separate points. One, there's a different endowments as well. So lithium might be traded then as oil is traded, and that might affect regions as well. So I think those are things that we can incorporate for sure in the model, I think, without difficulty. And then awareness of climate change, that's another interesting point. And again, it's something one could do here. Is a question, I suppose, of how many different dimensions of heterogeneity one might want to study, but maybe that's the point of the research, is to try them out. And the learning, having different signal-to-noise ratios in different regions fits right in with my last couple slides where we showed temperature shocks of very different processes in different regions. So if you're just looking locally to figure out what's going on, say with damages as a function of regional temperature, it might take you longer or shorter to figure this out. So that's good. Yeah, the question that Jim raised, a harder one, I think we are pretty much sticking with the Nordhaus tradition, which one can criticize. It's just like bundling everything into TFP. So that's kind of what we're doing here. And I don't think that's fully satisfactory in the end. I think we need to unbundle that. And we don't have a lot to say there. Certainly there's micro evidence on if you look at the risk of mortality, this Greenstone et al. Paper, they add everything up and they get a nice convex curve. It doesn't look that different from a Nordhaus damage function, but only coming from mortality risk. Or for things like that, maybe agriculture, and then that's an aggregate, but also they show U-shapes by region for mortality, depending on what your starting temperature is. So it's not so different from what we're doing. But whether we should bundle innovation, into TFP, probably not, I think. So I don't have a great answer there. I think you need a richer framework to study these things. I think some of Cruz and Rossi-Hensberg work allows for endogenous growth. I suppose that maybe then there could be some responses from climate policy or climate change to endogenous growth. I don't think it's quite on innovation in agriculture, but they do allow some feedbacks there. I think it's a great question, and it just goes at how measuring damage is hard work. And we kind of punted on that a little bit. We want to be consistent with these aggregate numbers. And come up with a regional detail, I think is consistent with the aggregate numbers, but then we should push way harder on these damage functions. That's on my last slide too, to some extent too. Yeah, I think migration is very important, and this is a very good point on, I guess it's a general point of how you measure inequality. Do we measure it across countries, or do we lump everyone in the world together? Inequality across countries seems to have gone up some maybe, but inequality across peoples maybe gone down because China and India have grown so much over the past 40 years. We don't have migration, but it'd be awesome to calculate that calculation. To do that calculation when we get there, we can study migration pressures in our model. So we can calculate how much would you gain if you could move, and these are large numbers. We've also thought about allowing for full mobility within a country, but not across countries. I think that we can solve and still retain forward-looking consumption savings behavior. But I think it's a great question. Interacting chaotic systems with macro models. So our idea is that the agents in the model, and this is a great question, and we're still working on this, so it's more speculative, but our idea is that we're going to represent these chaotic dynamics by linear systems or nonlinear systems even with shocks. So the agents just think they're just random shocks out there. And that's the way they form their expectations. And then we can solve this using these approximate expectations. We still have some fixed point iteration to do between the two models, because we have to confirm that when you solve the model forwards using the actual dynamics of NOR-ESM. Now, it takes a while to run, but I think it's feasible to do, actually. We don't have to do so many iterations back and forth. So then you'd have to confirm that the approximate expectations based on shocks kind of are reasonable. But there's some level at which the agents are never getting it right, because I don't know how to put chaos into a nonlinear, into a dynamic macro model with forward-looking behavior. And in fact, when you first see these pictures, I thought it's like, okay, you're making a mistake, because yesterday you showed me a picture with the temperature a year from now is like 2 degrees lower than it is now, and the climatologist said, well, we just changed the initial condition by a little bit, and so it led to a big change a year from now. It's like, okay, that is amazing. So I guess I should have known that, but seeing it in practice is quite interesting. So I think we can solve it. It's just a question of whether you buy into our scheme of using approximate expectations. And then finally, institutions mattering for productivity. So remember, in the model, we do have an exogenous component of productivity that's designed to capture institutions. So we can match the distribution of GDP across countries initially. But the question might be more, maybe those institutions affect how you respond to climate change as well. And there we're making kind of identifying assumption that that different countries can respond just as, that the institutions, your education system or your political system don't interact with how you respond to a change in your temperature. And that's probably not a great assumption either. One can imagine allowing for heterogeneity and the ability to respond to shocks. Not quite sure how to do that, but it's another dimension of heterogeneity that might be important to incorporate that we haven't yet. All right, but thanks for all the great comments and great discussion.
Thank you very much, Tony. Let's close with a round of applause for Tony and his discussion. So now we move on to the third paper in this session, and we have Luigi Duran. Luigi is a senior economist at the Macroeconomic Analysis Department of the Central Bank of Chile. He has a PhD in Johns Hopkins University, and he has worked previously at the Independent Evaluation Office of the IMF, the Fiscal Affairs Department of the IMF, and the DG Economics of the European Central Bank. Luigi, the floor is yours.
Okay, great. Hi, everyone. So this is a joint work with Nicoletta Battini at the Riksbank. Of course, the usual disclaimers apply. The views are ours. They do not necessarily reflect those of our respective institutions. So in terms of policy relevance, we live in a world characterized by rapid decline in biodiversity, and this is a problem for the environment. It's also a problem for us as a society, since we rely on the ecosystem services that derives from the stock of nature. And so this begs the question on how to try to integrate nature, which we are going to call natural capital, or KN, into fairly standard macroeconomic models, and what are the implications of doing so, and also trying to understand the role of green policies in terms of welfare. So this is a project which has a first go in this direction. Briefly, traditional growth models, starting from the solo model, don't have a role for the material foundations of production. Of course, over the years, things have changed. Large energy shocks, rising pollution have increased the interest toward model that tries to understand the role of energy and renewable and non-renewable resources. As of today, there is a very interesting literature that looks actually at the political economy aspects of how to manage natural resources. And on the policy arena, more recently, Das Gupta prepared a report for the UK government where it was made pretty clear the importance of accounting for natural capital, both as a stock needed for society, but also as a stock producing flows which generate ecosystem services. So in this work, our contributions are to model this variable Kn as a bounded factor input in the supply side of a macro model, and we want to link its value not only to its exploitation, but also to its economic value when conserved. And then we want to derive some green policies. And we are going to show that when an economy starts with a large endowment of natural assets, it's optimal to deplete some, but to conserve some. And of course, if the dynamics of nature are characterized by some tipping point, the conservation should be higher. And in particular, if a tipping point exists in the dynamics of nature, it's optimal from a social planner standpoint to initially lower the level of output, consumption, macroeconomic variables, which will then allow for having a stronger sustainable growth. And then we are going to do a fairly simple exercise in which we assume that nature can have some TFP externalities, and we are going to see how this affects welfare. I won't go into the equations of the model, apart from the one describing natural capital. So this is just to give an overview of the fairly simple model we have in mind. There are two blocks. On the right-hand side, there is the foreign block, where you have households, and then a final consumption good firm, which we call F firm, which is using both capital and foreign labor together with an intermediate input. This intermediate input is in turn an aggregate of two inputs, which we call green and brown input, which are not produced by the foreign economy. And then we have on the left the home economy, which is to some extent symmetric to the foreign economy with households and consumption good firm, which are called the YH. And these firms are, again, using an aggregate intermediate input. The difference is that now the home economy has also an endowment of nature, which appears here in the green triangle, and this endowment of nature functions as an input in the production of green and brown technologies, which are essentially producing the intermediate goods, which are also exported to the foreign economy. We are going to simplify the macro side, so we are going to assume complete markets, full labor mobility within a block, and no unbiased in consumption. So I will just describe the natural capital and the brown production and green production structures. By brown production, what we actually mean is any technical process that uses the stock of nature as an input and does so in an unsustainable way, meaning that it affects negatively the way in which nature accumulates. The green production can be seen as having two interpretations. The first one is, again, any technical process that relies on the stock of nature, but it does so in a sustainable way, meaning that when we look at nature intertemporally from one period to the next, we shouldn't see any impact of this type of production on the rate at which nature accumulates. And the other interpretation is perhaps more direct, is that of environmental offsets, which are quite in vogue nowadays. So this is the equation we have when we think about the stock of nature evolution, which is quite standard in the environmental literature. The evolution of nature is going to depend on KNB and KNG, so the exploited and conserved amount of nature, and then on three exogenous common and fixed parameter, Rn, Cc, and Ct. And Rn is what we call the intrinsic regeneration rate, which is essentially drives the accumulation process. Cc is a carrying capacity level, which is an upper limit toward which nature converges if it accumulates sustainably. And then Ct is what is also commonly referred as a tipping point. We are going to focus on two specifications which are quite extreme in their characterization. They are, however, useful for us to describe a range of possibilities and to distill some properties that we want to highlight. The first specification doesn't assume actually that there is a tipping point, and so we will have this logistic function, which is going to depend only on the carrying capacity and the amount of exploited nature every period. And we are going to call AN the accumulation rate. The other specification is the opposite. And now we introduce a critical threshold. The critical threshold is such that once Kn falls below this level, the accumulation rate essentially turns negative and the stock of nature converges to zero. So it's, of course, extreme again. It's less common. It's the specification emphasized by Dasgupta, and we think it's useful to think about these themes. Graphically speaking, these are the accumulation rates into two specifications. The dashed one is the model without critical threshold. It's always positive. It has a peak around 0.5, and the other one is the accumulation rate with a critical threshold. We are going to focus, of course, on the region which is above the critical threshold, which, of course, is restricted, and here it starts at 0.7, which is the value we're selecting. And changing the parameters is going to affect this accumulation rate. Here I'm increasing the critical threshold to show you how this restricts the region which is sustainable, and also the intrinsic generation rate is going to pull up the accumulation. Because it's hard to understand and to quantify how much nature regenerates through time, we're also allowing for some shock, which is going to affect the extent of regeneration. Our main analysis is going to focus on a social planner type of problem, so very, very standard. Social planner is maximizing global welfare of the home and foreign economy. We are going to assume standard utility functions, and this is essentially the resource constraints that the social planner is facing. The first four on the left-hand side essentially are the output, or you should see the output of foreign on consumption and brown and green goods, and then on the right-hand side you have the users of this output, and the last two equations are simply the equation that I just described about nature. Here, kappa is a cost function which is going to be increasing the amount of exploited nature, and that's we follow the environmental literature on that. The only further condition I want to mention is the one associated with the amount of conserved nature, which of course gives rise to a shadow price, which is going to be determined by a wedge between the marginal cost in conserving more nature, which of course cannot be used for the production of the brown inputs, and the marginal benefit in conserving more nature, which is going to be, which is going to translate in more production of the green goods. And of course, we also have an intertemporal condition, which is going to characterize the accumulation or decumulation of the stock of nature. This mimics the traditional Euler condition in macro model. On the right-hand side, you see the expected benefits of having a larger stock of nature. The difference is that now the first term on the right-hand side is also going to take into account the way in which changing nature today is going to affect the accumulation rate of nature itself tomorrow. The second term is simply the impact on the stock of nature on brown production. So in terms of calibration, we are going to assume that one period corresponds to 5 years. This is in line with the macro literature, with the climate macro literature. And we are going to try to align parameter values with what we found in prior empirical evidence. And for the nature side, we have to experiment because we have a model which is quite parsimonious, and there are no clear also at the same time priors on how to connect our model to the growing and perhaps not yet available evidence on these dynamics. And so overall, we should think of this as a numerical exploration, which still tries to be close to reality. Yet, I want to just emphasize 2 parameters for the macro size which are important. The first one is the intertemporal elasticity of substitution that we assume between the green and the brown input. We are going to assume as substitution above 1. It's in the range of what the literature has found. There is a large variety. But we want to allow for some substitution. And the second one is the shares in the specification of the aggregate intermediate input, which has a CES specific functional form. And here we are going to take the stand that the green share is low. And we do that because we want to reflect our current economic structures, which are, as of today, heavily reliant on production systems which affect nature. To set the critical threshold and the carrying capacity, we are going to look at some studies. There is variety here. Some agreements suggest that reducing an original stock of nature below 70% of its initial mass may have permanent impacts, and that's the value we set. And for the intrinsic regeneration rate, we are going to look at some studies on forests and how they have regenerated through time. So we are going to set it in such a way that our dynamics of natural capital in both specification is consistent with the timing that was observed in these studies about forests. Okay, in terms of model dynamics, we want to study essentially how would a social planner efficiently manage the stock of nature when the economy starts with different endowments or different value of the state variable of nature. And we are going to look at 4 scenarios. In the first one, we assume that the world starts with initially abundant stock of nature, and in the third and the fourth scenario, we are going to look at the case where nature is critically depleted, meaning close to a critical threshold value. And then after that, so up to now, we are not going to look at TFP. Then we are going to compare our results with a simple exercise where we have actually an exogenous TFP growth. So before looking at the dynamics, let me just point out how the economy look like at T0 when they start, because they are depending on whether we assume a critical threshold or not, because of course they are going to be radically different, and this is going to help in also analyzing and understanding the dynamics later on. Particularly, having a critical threshold generates an equilibrium values which are significantly more compressed. You can see it on consumption and output in general, with the exception of the green production and the labor which is allocated to the green production. Now, In terms of model dynamics of nature, so this is a standard figure I will show several times under different contexts. The top left and top right show the stock of nature and the accumulation rates, and then at the bottom we have the exploited nature and conserved nature. So what we see is that starting with a high level of nature, it's not optimal to keep that high level of nature intact. Well, that's because some of it needs to be used for brown production, and the trade-off is particularly stark when you are originally allocating much of it to conservation, and when you have a high stock of nature. And so what we see is that essentially the economy or the stock of nature eventually converges to lower levels, which are going to be different. The solid line here refers to the case with a critical threshold, and so the economy is essentially going to converge to a higher level of nature. In terms of macrodynamics, we see that there is a smooth decline in brown production as the economy readjusts. Physical investment also decline. And the model generates some kind of bump in consumption initially, because the way in which physical disinvestment happen compared to how output declines. And importantly, when there is a critical threshold, actually there is no decline in green output. And this is possible because actually the economy is moving toward an equilibrium where there is a larger amount of labor. And this figure, I forgot to mention, they show the level of the variable throw times compared to time zero in percentage terms. So we use this kind of apparatus to understand where the economies are evolving in percentage terms. And then we want to move to the critically depleted initial stock of nature. Again, before the dynamics, let's look at T0, how this economy compare when the economy has initially lower stock of nature. Of course, macro variables are more compressed. And here, again, when we have the critical threshold, we see higher levels in green output and green labor. Now, this figure mimics the one I showed before. For the dashed lines, which is the case without critical threshold, the dynamics remain coherent with what I've shown. When there is a critical threshold, now we see a different direction. Now it is optimal actually to accumulate nature. The accumulation rate of nature in this case is going to be pretty low compared to the dashed line case, and that's because when we are close to the critical threshold, the ability of nature to recuperate itself is compromised, and so it's going to take time for the economy to go back. But what's important is that as the economy moves toward a state with higher nature, the accumulation rate also is going up, and so this creates a kind of virtuous cycle where it's possible to end up in an equilibrium where both conserved capital and exploited capital can increase, and that's the bottom lines. The black bottom lines of the figure. And then in terms of macro dynamics, well, the dashed line, they're going to reflect the dynamics that are shown in the abundant case, that is the model without critical threshold. But now in the case where we have a critical threshold, we can see that brown output can expand while green output declines as the economy moves away from the critical threshold. And this happens because with Cayenne close to its critical threshold, initially it is optimal to allocate a lot of resources to the green sector. This is costly given our current economic structure where much of production passes through brown system of extractions. And so as the economy moves away from the dangerous equilibrium, there is a decline in green output. And that's the main message of this slide. Next, we try to play with the model and say what happens if we have some exogenous TFP process, and we are going to follow here some TFP specification from a paper from Barrage and Ordhaus and calibrate it. And we are going to assume that after 15 periods, the economy reaches a steady growth rate. The figure shows that, and then from period 20, essentially, we are going to assume a stationary solution, which we revert to a naive approach where policy functions essentially are stationary. Okay, so this is the slide. Again, the color coding is the same. The gray lines show the comparison with the case without growth. We are going to focus on the relevant scenario where we have critically depleted nature. And the main message here is that, of course, having higher technological growth increases the right-hand side of the Hotelling equation. So it increases the marginal value of stock of nature. And so optimally, for the social planner, it makes sense to increase the shadow price, the mu-t today. And so this translates in the end in slower accumulation of nature, which appears in the black lines on top, or more rapid accumulation of nature when we look at the dashed line on top. And so in terms of dynamic, we look also at growth rates. Here it's growth rate T to T, time to time, period by period. They remain pretty coherent with the scenario without technological growth. What's interesting and we want to highlight is the third row where we have the case with the black lines that now what's happening essentially it is optimal to contain the accumulation of physical capital, is to invest less initially during the first period compared to a scenario without a critical threshold. And in fact, even the current calibration, we see that domestic capital accumulates less on average in the range of -4%, -4, -5% per year over the course of the next 10 years. But eventually the growth rates pick up and they actually go above those from the model without critical thresholds. Okay, so that's the overview I wanted to give, just to have a sense of how these two models generate very different dynamics. And I hope I made the point that it's important to take into account both of these type of wars to start to think about nature and its interaction with the economy. Now I want to have again a pretty simple exercise. We want to allow for part of TFP to be driven by the amount of conserved nature. So we kind of split, for instance, AG and AB, which are the TFP, by allowing for some elasticity to the stock of conserved nature. And as expected, now when we compare the social planner economy with an economy which is a competitive equilibrium economy where the agents are not internalizing this, we see that there is, it is optimal to accumulate more nature, and in particular, in both cases, as it's shown in the top right, there is a kind of front loading in the speed of accumulation or decumulation, depending on the cases, which is happening during the first period, and this is shown by this non-monotonic evolution of the percentage difference in the accumulation rates. Okay, then we study the case. We study the case of a tax authority in the home country that establishes a lump sum finance subsidy, which is offered to the intermediate goods firms on the stock of conserved nature. And we are going to make a bit the climate literature, so we could say that it's expressed in nominal units. And of course, in our case, the relevant measure is the unit of nature, and you could think of it as the stock of forest, stock of fishing populations, and so on. And while you can align very directly the social planning solution with that from a competitive equilibrium, but setting a subsidy which is equal essentially to the marginal value that the conserved nature has on the brown and green technologies. And this is what the proposition says. So this is what the optimal green subsidy would look like in terms of GDP. So it's higher during the first period, which is coherent with where most of the actions in terms of dynamics of nature happen, and then it stabilizes over time. Now, it's important to understand that the subsidy, what the subsidy is doing, of course, is generating an equilibrium where there is more conserved nature today or in the present, and this clearly determines a decline in consumption compared to a competitive equilibrium without a subsidy. Eventually, however, this higher stock of nature is going to allow for more production because the economy is able to stabilize at an equilibrium where there is a higher stock, and so both more brown and green productions are possible. And that's what the figure is essentially showing. It's showing the percentage change in consumption in an economy with a subsidy and an economy without a subsidy. And then in terms of welfare, we are going to follow the macroeconomic tradition in computing a kind of welfare equivalent measure of that. And so we're going to assume that all realization of the shocks are set to 0. We're going to assume that the elasticity of output to nature is the same in the brown and the green sector. And so the first stark result that emerged, which perhaps is unsurprising after seeing the other slides, is that the welfare gains are close to 0, essentially, when there is a critical threshold. And I mean, the reason here is that essentially there is no much room for maneuver for the social planner or for a tax authority because the amount of regeneration of the accumulation rate of nature is extremely low. And anyway, the economy is already dedicating most of its resources to the green sector. In the other case, which is the case with only a carrying capacity, welfare gains can be substantial depending on the elasticity that is assumed. In our calibration, they go up to 1% of consumption equivalent. Now, we also did another experiment. And in this experiment, we looked at a global tax on intermediate inputs. So even though a direct subsidy on nature represents a first best policy intervention, and even though there are some cases around the world that go in this direction, it might be less practical than the case of global taxes applied on goods that, on trades that already exist. And this essentially goes in the direction of trying to reduce the amount of brown production. So we set a tax such that in equilibrium the relative demand of brown inputs to green inputs reflect the allocation that arises under a social planner. And however, with this tax, essentially what we found is that only a small share of the original externality is resolved, and that welfare gains are quite contained. And the reason is that this tax is going not to affect directly, the shadow value of nature, but only indirectly through the labor markets. And so, of course, this tax is going to regenerate a shift from the brown to the green sector. But overall, the stock of nature doesn't change much. I had some details, but I don't think I can access them. So you have to believe me on this one. So yeah, I had some figures. I will conclude, therefore, with a little bit of time still, that what we did is we enriched a standard stochastic two-block growth model with natural capital, alongside with man-made capital. We put natural capital as an input in production in both blocks, but only one block is endowed with it to reflect real-world asymmetries in the use of nature. And we highlighted how depletion of natural capital for production reduces its ability to regenerate itself, like in the real natural world. We traced different the efficient dynamics for nature and economic variables by comparing a world still rich in nature and a world in which these assets have been critically depleted, and then we incorporated an externality in the model and derived optimal policy. Of course, our analysis opened the doors for further, more rich policy exercises and application, especially given that we are using a time inhomogeneous policy function, which allows to account or take into account, the uncertainty and the future changes in the economic structure that could arise, such as, greening the production structure, where the shares of green input might increase through time, or changes in the elasticity of substitutions, and so on and so forth. So I think I'm 5 minutes earlier. That's not a bad thing, I guess. So I'll stop here, and thank you for listening.
Thank you very much, Luigi. Now, we have the pleasure of having as discussant Larry Karp. Larry Karp is a distinguished professor at UC Berkeley in the Department of Agriculture and Resource Economics. He holds a PhD in agricultural economics at UC Davis and has published in numerous academic journals on these topics. So Larry, welcome to the conference, and we look forward to your discussion.
Can you see my screen now?
We can see you.
Are you able to see the screen that I'm sharing?
Yes.
Oh, okay, great, thanks. Well, thank you very much for the opportunity to participate in this conference and to discuss this paper. So the paper sets out to study the role of natural capital in a growth model. It shows that it's optimal to use natural capital provided that the initial stock is sufficiently abundant, and the existence of a tipping point typically reduces the optimal exploitation. Under some circumstances, it's optimal to subsidize the conservation of natural resources. So it's certainly an ambitious paper. It attacks a problem that everybody, at least everybody in this conference, would recognize as being important, and it's also very challenging. I think the most effective integrated assessment models in the climate setting are those that have something to say about the magnitude of something that's interesting to us. For example, the social cost of carbon, or the way in which some type of uncertainty or ambiguity or discounting might affect the magnitude of this variable. And this paper it really makes a great attempt to calibrate the model, but in its current state, I don't think that the qualitative results are directly usable for guiding policy. And I don't really mean that as a criticism. This is an ambitious paper, and I think it provides a platform for thinking about natural capital in a growth setting, and I expect more to come out of it in the future. So I'm going to talk a bit about some of the aspects of the model that struck me. It has two regions. Home has a stock of natural capital and F doesn't, and home uses both green and brown natural capital and labor to produce these two types of intermediate goods, and the two intermediate goods aggregate to a single intermediate good. And total natural capital is the sum of perfectly fungible green and brown natural capital. This aspect of the modeling surprised me a little bit. Green natural capital is a stock, but brown natural capital, it's actually a flow, and that just means that any brown capital that's used in a period vanishes. As I read the paper, I thought it helpful to think about the fishery context, and actually this paper lines up pretty directly with a standard fishery model. You can think of the fish stock as being the green national capital, and the fish harvest is the brown national capital. So you can take fish out of the stock and use it up, and that's like using brown national capital. Now, both regions produce a final good using non-traded labor and capital and the intermediate good, and these goods are traded. So in some respects, this paper is part of a much larger tradition, because of course, just about every integrated assessment model used in the climate setting does use natural capital. So this paper is different because it focuses on different aspects of natural capital. It's not the natural capital per se that's distinctive, but the precise way in which it's modeled. And there are two models of the evolution of natural capital. And again, I think that the fishing analogy is pretty useful. At least it helped me understand it. The first model uses what's in the fishery literature is known as a logistic growth model. And this is parameterized using just two parameters, a carrying capacity and a natural growth rate. And the natural growth rate is the approximate growth rate for small stocks. And the second model uses what's known in the fishing literature as critical depensation, in which growth is negative for stocks below a critical level. I think that it would actually be useful for, at least for readers coming from resource economics, not so much from the macro side, but for resource economics to draw out this connection with the fishing literature. Now, one of the features of the model with critical depensation, what the paper refers to as a tipping point, is that the model it's non-convex. So there's the growth equation is convex over some region and it's concave over another region. And in this respect, it's a special sort of an extreme case of what's referred to as the shallow lake problem. And in these sorts of problems, there's a unstable steady state that lies between two stable steady states. And in some of these problems, there's a skiba point, which is just some level of the stock such that if you begin above that level, you move toward one steady state, and if you begin below it, you move to another steady state. And these problems are kind of complicated because the skiba point does not coincide with the unstable steady state. So it's not always straightforward to identify the skiba point. And the reason I bring this up is because the paper doesn't talk about these aspects at all. But I wondered whether the non-convexity created any issues with the numerical solution. And just sort of more generally, it might have been more natural to have started with a model that more closely resembles the shallow lake setting rather than the critical depensation setting, because the critical depensation that's the case where the growth is zero when the stock falls below a certain point. That's, as I say, kind of an extreme situation. I was puzzled by the role of uncertainty in this model. So we're told early on that the growth rate of natural capital is subject to a multiplicative shock, and you see expectations operators both in the statement of the problem and in the first order condition. So in this case, of course, because this is an AR1 process, the lag state variable is a state variable, or rather the lag shock is a state variable. And I was curious how the problem is solved, and the only hint that I could see was a reference to two papers. And at least one of these papers I know uses dynamic programming. So I assumed that that's what this paper was doing. But then I couldn't understand how to interpret the trajectories these are shown in section 4.3, but there are also lots of examples of them in the slides that we just saw. I mean, the problem, of course, is that when you have a stochastic problem, you don't know what you don't know what the stock is going to be in the future. You can graph the expectation of the stock or something else. And I'm not exactly sure how to interpret these. Now, at some point in the talk, we were told that the expectation, we were told that the random variables were, or the realizations of the random variables were set to zero, their expected value. And perhaps that's what it's doing, but then I don't really know what the role of uncertainty in the model is. And so I think that's something that it'd be interesting to describe more thoroughly. one of the reasons why this seems important to me is that when you have uncertainty and critical depensation, then I ask what prevents all trajectories from leading to resource exhaustion. It just seems that you could have a succession of really unfortunate shocks that would cause the stock to fall below the critical level. And over time, the probability of getting such a succession of bad shocks seems very high. So I just found that part of the paper unclear, but that might have been the fault of the reader, me. So when I began the paper, I thought that the emphasis was going to be on the externality, and the motivating examples certainly do involve a very important externality. And the paper talks about the loss of biodiversity. That's, I think, the example that would occur to most of us immediately. And that's obviously an externality. The paper begins by using World Bank statistics to calibrate natural capital. And I wondered whether these statistics involve resources for which there are actual prices. I think that that's the case, but again, I'm not sure. But my point is that I think that the reason that we really care about the role of natural capital in this sort of setting is because the property rights are so weak, and because the externality is really the most salient, or one of the most salient features of the problem. Much of the paper deals with the situation where the competitive equilibrium is optimal, and so there's no role for policy. Towards the end of the paper, the authors introduce the externality, and the presentation we just saw described how that occurs through TFP. And here, of course, there is a role for policy. I would suggest de-emphasizing the case of perfect property rights, because that's not why we're interested in this problem, I think. But certainly the problem with missing property rights is very important, and introducing the market failure through TFP is pretty much the standard way of doing things in this setting. So I just have a few minor points that I'll conclude with. Most of these are just comments to the authors that might help in making things clear. I guess the only point that I'll talk about is that Frances Moore and her co-authors they have some papers that introduce non-standard types of natural capital into climate-related integrated assessment models. I think that those papers, her work and her co-authors' work, might be relevant because of the way that she does think about natural capital in a manner that's not completely standard. So I think my 10 minutes are up, maybe even more than 10 minutes. So I apologize if I went over time, but I'll conclude here.
Thank you, Larry, and you were within the time allocated, so no problem on that front. Any questions from the audience? We have a few minutes. Okay, so I guess we can come back to Luigi.
Yes. So thanks a lot for the comments. They're all very insightful. I think they'll help improve the paper. So for the solution of the model, what we are doing is assuming that the shocks are small, they might amplify the regeneration, the accumulation rate, or slightly reduce the accumulation rate, and we are doing that with a kind of a quadrature approximation. And so when we solve the algorithm, we are never tipping to the scenario where you'd fall into the negative accumulation rate. So this is perhaps a bit of a shortcut, but that's the best way we thought about having both the accumulation rate of nature allowing for a critical threshold and also at the same time some kind of uncertainty. And the idea is that essentially here all the simulations are generated such that, as you mentioned, the shocks are zero, and so the parameter or the exogenous variable z, which is multiplied to the accumulation rate, is equal to 1. And so there is, even though the agents are incorporating as an expectation that the accumulation rate tomorrow might be higher or lower than today, in practice, when we simulate the model, there is no such effects happening. And in terms of property right, I agree. It's a very important aspect. Even though there are throughout the world there are social arrangements where natural capital is well managed, even though there are no clear or standard property rights set in place. There might be simply social norms and other systems of managing resources in a collective way. So, I mean, it's not as stark as it might seem initially, and also part of the idea of having these shocks to the accumulation rate was also to have a specification where these shocks, while not having a predefined narrative, they could reflect also to some extent the fact that in some countries you may have more uncertainty regarding how much nature you will end up tomorrow, because perhaps there are some poachers, which of course we're not modeling, but there might be some actions that happen and that might make your stock of nature less abundant tomorrow. So I think these were the main points raised by Professor Karp. So yeah, I'll end up here.
Thank you, Luigi. And I would like to close with a round of applause to everybody, because we're on time for lunch, and I think that's also always good news.
Thank you, Vice Governor Garcia, and thank you to everyone, to all the presenters and discussants in session 1. We'll go to lunch now and come back at 2 p.m. for our keynote address. so we can continue with our keynote address. We have the chair for the keynote address will be Luis Felipe Céspedes, board member of the Central Bank of Chile, and our keynote speaker will be Felipe Agion.
Thank you very much. It is an honor for us to have this afternoon in our conference, in our annual conference, to Professor Philippe Agion. Philippe Agion is Professor of Economics at the College of France and at the London School of Economics. Professor Agion is one of the most influential economists of his generation. His groundbreaking research on growth and innovation shows how the creative destruction mechanism plays a crucial role to generate increasing in our standard of living. In his presentation today, he will discuss how can we generate green growth. He will discuss the role that firms, the civil society, and the state, the ladies in particular, have to generate green innovation. Professor Agion, it's a pleasure, it's an honor to have you here with us, and the floor is yours. I think that you need to unmute the Zoom. Okay.
Oh, I need to unzoom. Okay.
No,
Okay.
now we can hear you. We can hear you
Okay.
now.
Okay, okay. Very
Thank
good.
you.
Voilà, and then, okay, I do this. Okay, so thank you so much. So let me start with so here is a picture of young Schumpeter, and Schumpeter is known for having put forward the notion of creative destruction, the process whereby new innovations displace old technologies. For example, in his book, Capitalism, Social Democracy, Schumpeter tried to spell out, what he means by creative destruction. But in fact, when I studied growth economics in my youth, there was no model of Schumpeterian growth economics. The leading paradigm was a neoclassical paradigm, the Solow model, where growth is primarily driven by capital accumulation, and under reasonable assumptions of decreasing returns to capital accumulation, there can be no long-run growth under capital accumulation alone. So Solow would point that technical progress is required to generate long-run growth. But Solow would not tell you where technical progress comes from. And but there was this guy, Schumpeter, who talks about innovation and creative destruction. But there was no model embodying the notion of creative destruction. And there was no empirics either. So with Peter Howitt in 1987, in the fall of 1987, we, from scratch, we wrote a model of growth that embodies the notion of creative destruction. And this model revolves around three main ideas. The first idea is that long-run growth is driven by a cumulative process of innovation. The second idea, where each innovator builds upon previous innovations. We will see that later on, the importance of the cumulative nature of innovation. Second idea is that innovations result from entrepreneurial activities motivated by the prospect of innovation rents. If I find a new product or a cheaper way to produce, then I get some rents, monopoly rents for a while until I am superseded, until I'm imitated or whatever. And it's the prospect of those rents that encourage me as an entrepreneur to invest in R&D and other type of innovative activities to generate innovation. Okay, and the third idea is creative destruction. New innovations displace old technologies. New innovations make old technologies obsolete. And you see, at the heart of the Schumpeterian paradigm, there is a contradiction, because on the one hand, you need monopoly rents, you need the prospect of innovation rents to induce innovative activities. But on the other hand, yesterday's innovators are tempted to use those rents to prevent subsequent innovations and subsequent entry because they don't want themselves to be subject to creative destruction. And regulating capitalism is largely about how to manage this contradiction, the fact that you need rents to generate innovation, but on the other hand, these rents will be used ex post by yesterday's innovators to prevent future innovation. So now, why this Schumpeterian paradigm changed the landscape? It changed the landscape first because it gives center stage to cross-firm heterogeneity between incumbents and entrants, between leaders and followers, between small firms and large firms. So that's new. Previous growth models, there were no sense, the notion of entry and incumbents, leader, followers, small and large. This is the first model where it is at the heart of the model, okay? And this paradigm also gives center stage to firm dynamics. For example, typically, if we follow Clété and Kortub, which is a Schumpeterian model in 2004, you can think of a firm, here it's a firm with 4 lines. How do you expand? Because you do creative destruction on another line. For example, firm F innovates upon the current line of someone else, and then firm F goes from being a 4-line to a 5-line. How firm F shrinks is because someone else will innovate upon one of firm F's current lines, and then firm F in that case shrinks from being a 4-line firm to a 3-line firm. And so that's a model that accommodates, and expansion of firms, contraction of firms, entry. You are nobody, you innovate upon somebody, you enter, you exit because you have one line and someone innovates upon you and you exit. So you see you have firm size, firm dynamics very naturally in a Schumpeterian framework, okay? And now this framework generates various predictions. Let me stress 2 distinctive predictions. A first prediction is that growth is positively correlated with firm turnover. And the second one is more intense competition enhances innovation in frontier firms for leaders, but discourages in non-frontier firms for what I call followers. So the first one, you can do cross-country or cross-region, and you can put on the horizontal axis a measure of creative destruction. It could be the job turnover, the Davis-Alty-Wanger type of measure of job turnover. It can be firm churning, entry and exit of firms. So you put that on the horizontal axis, and on the vertical axis, put growth in per capita GDP, for example, and you will tend to find always a positive correlation between the rate of creative destruction on the horizontal axis and per capita GDP growth on the vertical axis, okay? That's typically a prediction that other growth models would not generate. Another one, and so let me just move on. Another prediction is more intense competition enhances innovation in frontier firms, but discourages in non-frontier firms. So typically, I always tell my students, imagine that you are a classroom. Some of you are better than others. You have the top of the class and the bottom of the class. You open the door and you let in a brilliant student. What will happen? The top of the class will work harder to remain the top of the class, but the bottom of the class, which is already discouraged, will be even more discouraged when I open the door and let a good student in. It's exactly the same for firms. Here, this is drawn from work with Blondel, Griffith, Prantl, and Howitt. And the blue line is based on UK data, but you could reproduce that in pretty much every country. The blue line is the frontier firms. And on the horizontal axis, I have a measure of product market competition, for example, the Lerner index. And on the vertical, I would have the growth rate of firms or the innovation rate of firms, whatever. And what you see is that the frontier firms, they react positively indeed to competition. They innovate more, they grow more. But the orange firms are the firms far below the frontier indicator, and they react negatively to competition. Okay, so that's something to bear in mind when for what I will tell later. Okay, so this is an introduction, but I'm supposed here now to talk about innovation, growth, and climate. So in France, we've been very much, and I think it's true in other countries, having to argue with advocates of degrowth. So the way, according to them, the way to fight climate change and is to go for negative growth. Okay, and I will argue against that. In fact, But in fact, before I argue against them, I want to give them some credit. It's true that if you look at history, temperature, here I show the long-run evolution of temperature, okay? And you see that temperature remains essentially constant, and it starts rising sharply, worldwide temperature, in the mid-19th century, exactly at the time you have the takeoff of growth. If I draw the well-known Madison curve that draws the evolution of per capita GDP worldwide, you would find pretty much the same shape of curve, very much flat until early 19th century, and then in growth with the Industrial Revolution. And it's exactly the same. And had the Industrial Revolution not occurred, on the right-hand side, you would have the counterfactual where temperature would have remained constant. So it's true that historically, the global warming has everything to do with growth, everything. And it's also true more recently. If you look at the CO2 emissions of China in yellow, orange, and India in blue, you see that there is a takeoff in CO2 emissions of these two countries precisely at the time where growth took off in these two countries, okay? So that's true. Now, does it mean that you want to have negative growth and go back to pre-1820? No, because growth has given us a lot. Life expectancy has gone up. We also live in better health. We also, work is less harmful. There is less hardship at work because now a lot of, hard tasks are being automated. And so now, work as much and we don't work to need as hard in terms of physical pain, involved in work. I mean, there is less of that. And that's all that is thanks to growth and innovation. So we don't want to go back. And also, we had an experience of negative growth. It was with the first lockdown. Before we had the COVID vaccine, we had in France, for example, but that was true everywhere, between March 2020 and May, June 2020, we had degrowth. In France, for example, GDP went down by 35% between March and May, June. And CO2 emissions went down by 8%. Now, the IPCC tells you that if you want to, to fight climate change efficiently, you should have a CO2 emission averaging at 8% per year. That means that we should be permanently in the first lockdown. But we don't want to do that because we know that the first lockdown, we had to do it. We had no vaccine at the time, but it had, it harmed the youth in particular. It was a painful experience. We had no choice in such conditions permanently. So the alternative to negative growth is to have green innovation. So now I want to talk about implications of introducing endogenous and directed innovations aimed at green technologies. And I want to look at how introducing endogenous and directed green innovation affects the climate debate. Now, the first remark is that firms do not spontaneously innovate in green technologies. In fact, in work that I've done with Van Reenen, David Emus, Antoine de Chez-le-Prêtre, and John Van Reenen, and Ralph Martin in the JPE 2016, we looked at the automotive industry, and we looked at the incentive of automotive firms to innovate green or not. So we used patent data. We had access to World Patent Statistical Database, PatStat, and we focused on patents which were at the European Patent Office over the period 1978-2005. And we looked at patents filed in 80 patent offices in the world, okay? But that were also registered at the European Patent Office. So we focused, in fact, in triadic patents. So triadic patents are patents that are registered not only in the European Patent Office, but also in the US Patent Office, the USPTO, and also the Japanese Patent Office. So those are the good patents. And from these, and we focus on automotive industry, all triadic patents filed in 80 patent offices worldwide, and we extracted all patents pertaining to clean and those pertaining to dirty technologies in automotive industry, okay, following the OECD IPC definition. And also what's interesting is that for each patent applicant, you know the past history of their patenting. You know whether they patented green or dirty innovations in the past. So here is the classification of the type of innovation in automotive. So when you are at the top, it's very much relative to electric vehicles. And the more you move down this slide, the more you go into combustion engines. So you could say that the innovations that pertain to the categories at the top of the slide are cleaner innovations, whereas innovations that pertain to the rows at the bottom of this slide are more like dirty innovations, okay? And because they are more into combustion engines vehicles, okay? So now what we did is to say, well, you know what we will do? We take a firm I in a certain year T, and we look at the flow of clean patents by that firm in that year. And it depends, for example, first on the FPIT, the fuel price that this firm faces. Alors, how you calculate the fuel price faced by a firm that sells in various places worldwide, where it's a weighted average of the various countries that firms sells to, with weights equal to the exposures of that firm in these countries, okay? And then you construct a firm level measure of fuel price exposure. That's the FPIT that you have here, okay? And then you have other measures that what we were particularly interested was this KD and the KC. The KD is the stock of past dirty patents by that firm, by time T. And KD is the stock of clean patents by that firm at time T. And what we find first that, of course, if a firm faces a higher fuel price, the firm is more likely to innovate clean and less likely to innovate dirty. So that's reconforting that, of course, a carbon tax, for example, anything that increases the fuel price will, of course, tend to redirect innovation towards clean technologies because it becomes less profitable in a market that will shrink due to the increase in fuel price, okay? But what's more interesting is to look at the effect of the stock of clean and dirty. You can see in that row on the left that having a higher stock of clean makes you innovate clean more. That's the 0.303 with 3 stars, okay? So you have a significant and important effect of your past stock of clean into your current flow of clean, okay? And now if you go into the stock of dirty, it's true that you have some positive spillovers between past dirty innovation and current flow of clean, but you can see that that's the 0.139, but you see that the effect of the stock of dirty is much bigger on the current flow of dirty. That's the 0.542. So if I was looking at the first column minus the second column, which would be the propensity to innovate clean rather than dirty, you can see then that higher stock of clean increases my propensity to innovate clean rather than dirty, whereas a higher stock of dirty increases my propensity to innovate dirty more than clean, you see? And that's the path dependence. And why is that a problem? Because it implies that if you start from a situation where firms innovated mainly in dirty technologies and there is less effect, then spontaneously firms will continue innovating in dirty technologies. And therefore, the economy as a result may get stuck with dirty technologies and may fall into environmental disaster. So the problem is that green innovation does not occur spontaneously. Firms spontaneously tend to keep the bad habits. If they innovated dirty in the past, they tend to innovate dirty in the future. The good news is that government can avoid disaster by redirecting innovation towards clean technologies. And we saw that already with the fuel price. The fuel price is one instrument whereby you can redirect firms' innovation towards clean innovation. Okay, now I would like to look at further implications of having this endogenous directed innovation by firms, okay? And so I can continue. Can you hear me well? Is that okay? Can you hear me?
Yeah.
Okay, very good. So, so further implications. First is that creative destruction will help you. Why? Because we know that there is this path dependence. But who faces path dependence? Not the firms that just entered. The new entrants, they don't have the problem of bad habits. So if any policy that would favor nowadays creative destruction, that means more entry of new firms, helps you because those firms are less prone to innovate dirty. They will right away go into clean technologies because they don't have to pay a transition cost from dirty to clean. They start in itself. It's good to foster green innovation. I will get back to this point later on when I talk about finance. Okay, so that's the first implication of having endogenous directed. Another one is that you should act now. There has been a big debate. Between, you know, Nordhaus and Nick Stern. Nordhaus thought that we should not put carbon tax too high right away because it would impose a high cost on current generations. But because Nordhaus had a discount rate which was higher, that means that Nordhaus would give more weight to the current, whereas Nick Stern would have a discount rate that gives more weight to the future generations, and therefore Nick Stern would advocate acting right away. But this debate between Nick Stern and Nordhaus, the Nick Stern report and Nordhaus DICE model, was done entirely in a model of growth with capital accumulation. There was no innovation there. Innovation played no role in these models, okay? Now, what happens if you introduce endogenous directed? Well, first conclusion is that even with the Nordhaus discount rate, you want to act right away. Why is that? Because without immediate intervention, innovation will spontaneously be directed by firms towards dirty technologies. Therefore, the gap between the clean and the dirty technology will widen. Already, you are better at the dirty than at the clean technology. Of course, because you innovate essentially in the dirty and not at the clean. The gap between the dirty and the clean will widen. And the cost of intervention, which is reduced growth as long as clean technologies catch up with dirty, that's the cost of forcing firms to move from what they do very well, which is dirty technology, to clean technologies. That's costly because you force someone to move from something she was doing very well to something she's not doing so well. That, of course, if you delay intervention, the gap between the dirty will widen up. That means that when you will have to intervene tomorrow, it will have to be a deeper and longer intervention. So you will have a deeper and more prolonged period of reduced growth. And that's why even with the Nordhaus discount rate, you want to act right away. It's like the dentist. If you wait, you have a cavity, and you wait to go to the dentist, the cavity will deepen, and you will need more drilling with the dentist to cure the cavity. It's exactly the same here. Okay, and we see here, that's based on my work with Acemoglu, Emus, and Verstein, and we see that the 1% is the Nick Stern discount rate. Of course, if you delay intervention, the loss of welfare, and I express the loss of welfare in per year consumption equivalent, you have substantial loss of welfare in consumption equivalent. But even if you with a discount rate of 1.5%, which is a Nordhaus discount rate. So implication, the first one is creative destruction is good. The second one is act now, even with the Nordhaus discount rate. You can see here, by the way, you see the green curve is the evolution of per capita GDP. And you see the per capita GDP grows, but of course, if you delay, you will have a higher level, it will be the red curve, you have a higher level of per capita GDP because in fact, you let firms do what they do very well for grow faster, but you see eventually the red curve falls below the green curve. So you want to act right away, okay? Because with the red strategy, you waited and therefore you need to have a more prolonged and deeper period of reduced growth. Okay, another implication of endogenous directed innovation is that you want two instruments, not only one. Why? Because you have at least two externalities. You have the environmental externality, I pollute, but you also have the path dependence externality, the knowledge externality that I just spelled out. So because you have knowledge externality and environmental externality, we know in public economics that when you have two externalities, you need at least two instruments. And here it means that you need not only carbon tax, but also green other instruments. So the other thing is what I would call green industrial policy, IRA, for example, in the US, or I call that subsidies to green innovation. But you need both. You need the two legs, the carbon tax and the green subsidies, and more generally, the green industrial policy, okay? So that's the second thing. And here I look at what would happen if you only rely on carbon tax. Well, if you only rely on carbon tax to fight climate change, you need a much higher carbon tax. And of course, it will hurt particularly current generations. And I show you the loss of welfare in per period of using only the carbon tax, which would mean that you would need a 15 times higher carbon tax during the first 5 years and 12 times higher carbon tax during the following 5 years. Well, overall, that's the loss of welfare that it would entail, respectively, with the 1% discount rate of Nixon and 1.5% discount rate of Nordhaus, okay? So that's another. Alors, reinforcing the case for green subsidies, what I want to do here is I want to talk, I will complicate a bit the framework, and I will introduce an intermediate source of energy. Think of shale gas, but it could be nuclear fission in France. And the question is, when you, how should you design the energy transition strategy? How should you deal with the intermediate source of energy? So the intermediate source is less polluting than coal, but it's more polluting than the renewable energy or other source that you want to have in the long run, okay? How do you deal with this intermediate source of energy, okay? So that's very much based on work that I did with Acemoglu, Barrage, and Emus, okay? And in fact, what you can see in the US, this is the fraction of fuel. The red curve is the share of fuel in electricity generation that comes from coal. And the blue curve is the share of fuel in electricity generation that comes from natural gas. And you see that natural gas became increasingly important and coal became increasingly less important in the US, with an acceleration of this in around 2008, 2010, okay? Now, what we can do is to analyze, suppose that there is an exogenous improvement in extraction technology. For example, you have the shale gas revolution in the US, okay? And that's what we could call a shale gas boom. What would be the effect on aggregate pollution in the short run and the long run? So the short run effect is that absent innovation, so in the short run, you abstract from the effect of the shale gas boom on the direction of innovation. There are two opposite effects of the shale gas boom. On the one hand, you substitute gas for coal. That will reduce CO2 emissions. But on the other hand, when you have the shale gas boom revolution, energy as a whole becomes cheaper. And because energy becomes cheaper, consumption of energy will increase. And that's what I call the scale effect. It turns out that the substitution effect, of course, will dominate if the gas is sufficiently cleaner than coal. Okay? That's obvious, in fact. But what's interesting is that we calibrated our model, and our calibration very much matches the reality. We look at various scenarios of increase in the technology for extracting natural gas in the US, okay? And you see first that, of course, when you increase the BS0 is the productivity in extraction of gas. When it goes up, you see that the per unit of electricity produced, there is, of course, you lower emission intensity of CO2. But on the other hand, energy consumption, that's the substitution effect. That's the first column. The second column is that, of course, because you have the scale effect, because energy becomes cheaper, energy consumption will go up. That's this column. But overall, what's interesting is that the combination of the two is that overall CO2 emissions still go down in the short run. And that's the third column. okay, even though the consumption goes up, because the reduction in intensity is so big that it more than counteracts the increase in consumption. The substitution effect more than counteracts the scale effect. And we see that, you know, that's the US. So if you look at CO2 intensity, it was essentially constant up to the shale gas revolution, and intensity falls down quickly. Now, if you look at emission, they were increasing up to the shale gas revolution, but since the shale gas revolution, at least in the short run, CO2 emissions also have gone down. So in the short run, the shale gas revolution has been a good thing in the US with regard to CO2 emission. But now there is a long-term problem, and the long-term problem now we reintroduce endogenous directed innovation, okay? We look that, the idea is that you can have innovations on power plants that use coal, you can have innovations on power plants that use gas, and you can have green innovation. And they're all endogenous, of course. It's firms that decide upon them. Now, what will happen is that the shale gas boom, in fact, will direct innovation away from both coal and clean production technologies into gas production technologies. You will direct innovation away from innovating on plants that process coal, but you will also direct research resources away from green innovation. Okay, all that for innovating on plants that process gas. And the problem with that is that therefore the shale gas boom may move the economy from a path where prior to the shale gas boom, you had declining CO2 emissions in the long run, into a path where you end up increasing CO2 emissions. And in fact, exactly what's happening. We see first that the ratio of green to total patents in the US, but elsewhere, has gone down since 2010. That's not a proof, but what's more important is this. I look here at the effects of the shale gas boom, and I look at the on a non-managed increase in shale gas revolution. Okay, so I suppose that I just have a shale gas and no policy from the government except to allow for the shale gas boom. What happens? The share of scientists into green technologies on the left falls when you have the boom. You see, in gray, it was the evolution of the share of scientists into green without the boom, and with the boom, it goes down, okay? Now, the emissions, they initially go down, and that's the short run. But the short run is very short run, and you see that both the emissions and the energy consumption, you see, so the emission will go down, but then they will go up again, and they go up the long run, and very quickly they start going up. This represents 20 years. So there is a 20 years period where the short-run effects dominate, but quickly the long-run effect, which is to divert resources away from green, will lead to increased emissions. And because emissions go up, output net of damages will go down. You see, and that's the right-hand side figure. So you see that this long-term effect is very important. If you have a non-managed shale gas boom, you move from a good trajectory to a bad trajectory. Okay, so now what is the optimal policy? Well, here is the optimal policy with and without the boom. Without the boom, you would have this share of scientists in green. Now that you have the boom, you need to compensate for the boom by being even much more voluntary and to put more scientists in green. And you see that's the optimum under the laissez-faire is there, and the optimum under the boom is that you want to go much higher. You see, the laissez-faire was doing this, and you want to go much more. And here I compare the optimal green research technology with and without the boom here. And you can see that when you have the boom, you want to increase a lot green research subsidies, because to counteract this tendency for researchers to divert their efforts the intermediate source. To compensate for that, you need to reinforce the subsidies to green research. And that's why green research is important. The carbon tax doesn't change much, but you see that the subsidies to green research go up a lot. You see, that's with boom, it's here. Without boom, it was here. So it's way above with boom than without boom. You see? So therefore, the idea is that a non-managed shale gas boom can be very dangerous because it can derail the transition away from a virtuous transition towards green technologies. But if you manage it, if together with the, you reinforce the subsidies to green innovation, get the best of both worlds. That means you can get the good aspect of the shale gas boom, which is a reduction in CO2 emissions in the short run, but at the same time without impairing, without going against the long-term future, without compromettre the long-term future. Okay, so that's what I wanted to make. So my conclusion so far, when you have endogenous directed innovation, creative disruption is important. You want to act now even with the Nordhaus discount rate. You want two instruments, carbon tax and subsidy to green innovation, even more when you have an intermediate source of energy. That's where I am for the moment. The last important conclusion is that the civil society, not only the state, civil society has also a role to play, okay? And so here, I would like to tell you about consumers and social values, okay? So that's based on work I did with Roland Benabou, Ralph Martin, Alexandra Houlet, which is published now in AR Insight, okay? And what we do there is that we look at how consumers, at the effect on firms' innovation of consumer valuation for the environment. You know, through the world survey, you can get information on consumers' willingness to be taxed for green, or consumers' motivation for green, and that's the World Value Survey, okay? And you know that for various countries. And what you can show is that first, firms innovate green to cater to their consumers' demand for green. And that's again, I go back to the automotive industry, except that now we don't stop at 2005, we go all the way to 2019. And I look at the propensity to innovate clean rather than dirty, that's my left-hand side variable. And values, the first row, is the extent to which a firm is exposed to countries where consumers value the environment. So how you construct that at firm level, exactly as I did before for the fuel price, I sell in Germany and in the US, 2/3 in the US, 1/3 in Germany. Well, my exposure to values is 2/3 US plus 1/3 Germany values. You see what I mean? And that's how I construct a firm level valuation for green. And you see, when you are confronted with consumers on average that are more concerned by the environment, you innovate more clean than dirty. That's the first rule. But now there is another effect, it's competition. If you introduce more competition, it has two effects. Competition, of course, will lower prices, and because it lowers prices, people will consume more and produce more, and that, of course, has a scale effect, whereby you increase emissions. So competition has a bad static effect, because it makes the product cheaper, there is more demand for the product, and therefore you produce more. I could call that the Chinese effect. When China expands and poverty goes down in China, which is a very good thing, pollution goes up at the same time, okay? But there is another effect on competition, which is a virtuous effect. And the virtuous effect is the innovation effect. If consumers value the environment, then more competition induces more green innovation. The story is as follows. Luis is virtuous, and I'm not virtuous. And we are in an environment where consumers value the environment, okay? And in an economy where consumers value the environment. First case, Luis is not there. I'm on my own. Okay, I want to cater to my consumer, but not crazy, because anyway, I'm the monopolist. So I know that consumers have no choice but purchasing from me. I may still have some incentive to innovate green, but I won't have huge incentive to innovate green. Now, Luis comes in. And Luis is virtuous. Luis wants to innovate green. Then, even if I am not virtuous, I will innovate green to escape competition with Luis. You see, remember the escape competition effect. You know that the blue firms, you know, react positively to competition by innovating more because they innovate to escape competition with a new entrant, very good student. Here, in that case, more competition with Luis, even if I am not virtuous, induces me to innovate greener, because that's the way to escape competition with Luis. And now when you look back at the table, you look at the third row shows the interaction between competition and values. So you see that this interaction is always positive. So, together is that when you face as a firm that are more where consumers value the environment, that you want to innovate greener. That's the first rule. But all the more when there is more competition, and that's the third rule. You see, all the more when you face more competition on average. And that's very interesting because you can see that the carbon tax is an instrument, but the combination of educating consumers and product market competition together, this is as important as a huge increase in carbon price. And you know, in France, we had the Yellow Vest movement in 2018, but to know that you have other instruments besides the carbon tax, which is very important, it's not the only one. We have the industrial policy, but we also have the combination between values, which you can modify by education, and competition. This pair, values and competition, is a very big driver of green innovation. Now let me conclude. First conclusion is that innovation-based model of climate suggests that laissez-faire leads to disaster, to the past dependence in the direction of innovation. Second conclusion is that one must act now, and multiple instruments might be used, not just the carbon tax. Third conclusion, there is this triangle between firms, the state, and civil society. Firms innovate, so we need them, but they don't spontaneously innovate in clean technologies. We need the state to redirect firms' innovation towards clean technologies. Carbon tax, industrial policy, green, it's a competition policy. But the civil society, as we just saw, has also a role to play. Consumers also are there to discipline firms. And civil society is not just consumers, it's the media to denounce scandals, unions, associations, all that is very important. You see, that's my conclusion. The second one, conclusion is that there is a role, as I said, for green industrial policy. Now you could say maybe just a role for green subsidies. But in current work with David Emus and Ernest Liu from Princeton, we look at the transition to green technology, to a green economy along the value chain. So you have a chain of input-output, a bit like in Fari-Bakae type of models, where you have a chain of each level is an input to the more downstream. So the most upstream is the most input, and you go down and you go more downstream, okay? So now complementarities, you have therefore complementarities across multiple layers, and that complementarity typically leads to multiple equilibria, where with either clean technologies are adopted or they are not adopted. And there is a role of industrial policy to coordinate all sectors towards moving to electrification, for example. With the Pigouvian tax alone, you will not remove the multiplicity of equilibria. And if you have only subsidy, uniform subsidy, it would have to be a huge subsidy, which would be very costly. And so you want sector-specific subsidies and a sequence of sector-specific subsidies, and that's what you call industrial policy. And in a model like that, you can't do without truly industrial policy, okay? There is also, I would like to say something about the role of finance. That in current work with Bergeau, De Ridder, and Van Reenen. And I will just show you the effect of the exposure. We look at the role of finance. Some people talk about green finance, but I just want to say that finance is good. The bottom line I want to tell you is that finance is particularly helpful to finance new firms. I told you before that an implication of the endogenous directed innovation is that creative destruction is very important. You want to favor the entry of new firms that do not face the path dependence problem as much as older firms do. So how you do that? The idea is that finance, anything that will ease the entry of new firms, will help. So for example, here we look at the exposure of the German banking crisis, the effect it had on green innovation. So in fact, you had some firms in Germany that were exposed to Commerzbank in their lending, borrowed a lot from Commerzbank, and other firms that were identical, but they were not exposed to Commerzbank. And what happened is that during the crisis, Commerzbank had to cut lending after losses to international trading portfolios. So then I do a difference in difference. I look before versus after the crisis, and at firms that relied on Commerzbank lending versus identical firms that did not rely on Commerzbank lending, okay? And here is what you have. On overall patenting, being a Commerzbank firm versus a treated firm, which is a Commerzbank firm, versus a control firm, which is a non-Commerzbank firm, makes no difference. But on the right-hand side, you can see that it makes a difference on green patenting. So following the Commerzbank crisis, green patents goes down for firms that are exposed to Commerzbank. That's the first thing. Second thing, it's particularly true for young firms, and in fact, it's the most true for young and small firms. So what's very interesting is that those who suffer the most, are the young and small. And we know that it's the young and small that carry the energy transition because they're the most prone to innovate green, but provided they can afford it, provided they can finance the green innovation. And the problem is that when you have a credit crunch, you are particularly harming the small and young, which were the leaders. They are supposed to be the leaders of the green transition. And therefore, whenever you have a credit crunch, you slow down the transition to green innovation. So that's very important because it also has implications for macro policy. If you raise interest rate too much, you will, of course, particularly hurt the financing of small and therefore you will slow down the transition to low carbon economy. Very important thing. That's on the monetary policy side. On the budgetary policy side, I would like just to draw your attention on how you manage public debt. You might say, I want to reduce my public debt, therefore I renounce getting involved in any kind of investment or public investment, including investment in green technologies, including any kind of green subsidies public subsidies to green innovation. But if you do that, the problem is that we know that firms spontaneously will continue to innovate dirty because of the path dependence, and therefore it will be much more costly for the state to intervene tomorrow. So it means that when you usually when you think of public debt, we think of current versus future generations. You don't want to leave high level of public debt to the future generation. But you have to look at the two debts. You have the true public debt and you have the environmental debt. Not to leave public debt tomorrow, to leave a much higher environmental debt tomorrow. You have to arbitrage these two debts. And so that's factoring in. So you see, so the first point on interest rate means that you need to factor in green transition into monetary policy design. And the second is that you have to factor in green transition into budgetary policy and management of public debt policy. You see? Finally, I would like my last slide is that there are different types of innovation. There are innovations that mitigate the okay? They are called mitigation innovations. So for example, discovering new source of energy, producing with less energy, all those are great innovations, but they tend to slow down the rise in temperature, okay? They are innovation of mitigation. But then you have what we call innovation of adaptation. For example, dikes or air conditioning are innovations that help you adapt to the global warming. And then you also have now innovation of amelioration innovation that cool down the make the air colder. And now you said that's very much experimental, but I have to mention that to you. In Harvard's physics department, you have what we call geoengineering. Researchers, physicists work on the technology of geoengineering to lower the temperature. And how you do that? Well, you take note of the fact that whenever you have a volcanic eruption, then the air cools down. Why? Because the sulfur particles in the air screen out, you see, the sun. You see what I mean? And that's why it cools down the atmosphere. The idea is to see, well, can we dominate this technology? Can we master this technology in order to can we harness this technology in order to lead to cooling down the air? There is another technology which is the shades, the space shades. You put some kind of big shades in space, and that's what. Of course, those are still very experimental, and I can call that Plan B innovation. And now I just want to make one remark on that. Sometime when I mention those, people tell me, no, that's very bad, because those are, let's call them Plan B innovations. We need to do Plan A first. And if you mention Plan B, you will discourage A innovation, and that is kind of very bad moral. But I don't read the same way, because I believe that it's not the same countries that will implement A, Plan B. Plan B, I can well imagine China or India down the road don't do that for plan A, that temperature will become so unbearable, people will die, so many people will die, that in China who are very much exposed to global warming and still cannot be innovation, will unilaterally implement plan B. And so anticipating that, we should do more plan A. So I think the possibility of plan B should encourage us to do more plan A today. So I turned the moral hazard argument back on its feet. You see what I mean? I think that it's not the same countries that will pursue the plan A innovation and the plan B. Anticipating that if we don't do enough plan A, India, China will implement plan B innovation should induce us to do more plan A innovations today. Okay, so that's what I think I'm done there. Thank you very much.
Thank you very much, Professor Aguillon. We have time for questions. So I'm going to ask you to raise your hand in order to make question. Elias, the first question. And we're going to take, if it's okay for you, if we take 2 questions and then we'll continue?
Yeah.
Okay,
yes,
let's
yes,
go that way.
Perfect.
Elias.
Hi, Professor Aguillon. First, let me thank you for an excellent presentation.
Thank you.
Which I would characterize as getting many angles right about what is the optimal policy or optimal set of policies when you have endogenous growth, innovation, interactions with the consumer values and other elements. But I think that the issue we face is that many of these optimal policies are very, they hit a wall of political economy realities. So I wanted to push you a little bit on that direction. So in particular, you touch on two issues. First is I like your first discussion on having 2 instruments for 2 externalities. So not only taxes but also subsidies. But we know that of those 2, there is one that is much more likely to pass through Congress, which are the subsidies, right? That's basically what the US has done and other countries. And the tax part is not so lucky, and therefore we are naturally facing an imbalance of potentially very large proportions in government budgets. Another example of the political economy involved in your analysis is what you, I think, touch upon towards the end on consumer values. I mean, I think this is of enormous value to understand that this has a significant effect on competition, on innovation. But I am very surprised to go to a supermarket and try to figure out what is the carbon footprint, or more generally the environmental footprint of anything that I want to buy, and there is just no information about this. So I wonder if that's the case because it's too hard to come to a measure, or there's a political pressure from groups, from firms that they don't want to be exposed because they have a very high carbon footprint. So in other words, what are your thoughts on how to overcome the political economy barriers that are basically preventing policies to be implemented in the optimal way that you so eloquently describe? Thanks.
Yeah, thanks so much for this question. Very well. To do justice to it, we take a long answer. I think you're right. I mean, we face the political problem in France with the Yellow Vest movement very sharply. So that's why I believe that you need a combination of policies. For example, typically, if you combine carbon tax with smart industrial policy, green, you can have a much lower carbon tax. You don't need to have it as high. So I think that you can increase carbon tax. You can do it also in a way which doesn't hurt some categories like the poorest or those who are. In France, for example, the carbon tax was very badly received because there are many people who live in suburbs with connection to the center. You see what I mean? And therefore, when there had no alternative but use gas oil cars, and therefore when the government decided to increase a lot the carbon tax, these guys were trapped because they said, God, we have no alternative. Had you had investments to build S-Bahn systems, you know, kind of suburban trains and all, you would have been enough to increase the riser tax, the carbon tax. So that's why the two policies are complementary. You see what I mean? It helps a lot. In Switzerland, there is no problem with the carbon tax because you have trams everywhere. In Germany, you have a very good S-Bahn system. So not in France. So that's why you need both sides. You see, it's a very important. Now you raise also another problem, another thing with you know, that how you know that good the composition. That's why you have some organism, like for example B Corp. B Corp gives a grade to a firm. So what you could look just is to have a grade with B Corp. So what is the B Corp grade? Like you have, for example, alcohol. Now when you buy goods, you know the you know or whatever, or the nicotine. Well, you know when you buy cigarettes how much nicotine there is, or how much or grease. You know, we know how fat there is. You know, we know that now. You buy a product, you know, on the you know, on the emballage, on the whatever. You have the fat rates. You see what I mean? You could imagine a B Corp. You could say CO2 tax. You see what I mean? And you have now some organizations, some companies that are in charge of doing this kind of thing. So we could imagine improvement there to compute the B Corp. Alors, the difficulty is to, of course, have the complete, to look at input-output matrix of a firm and say, well, that's your B Corp. But, and of course, one issue could be lobbying. You could lobby grade. But that's where, you know, of course, anything can be, any policy can be perverted when you have lobbies. But still, you need those policies. So I think there are ways to move ahead. I think there are ways forward.
Hi, Philippe, Jim Stock. That was really terrific. I really enjoyed that. And I think that it's wonderful that you've been carrying the flag for R&D policy, innovation policy, and it's proven to be incredibly important. You know, I do worry a little bit, and I'd love to have you hear your thoughts about green industrial policy. The moment you say green industrial policy, it just opens the floodgates for different possibilities. Some of them surely are much more effective and efficient in terms of innovation, driving innovation in green than others. And I wonder if you could say a little bit that would get more granular in terms of what is actually effective. And if we think about the IRA, or if we think about European policies like the green hydrogen policy or the IRA, has hydrogen, it has fuels tax credits, it has a whole bunch of stuff, has battery incentives. You know, where is it that the research suggests that we're going to have the most effective policies?
Yeah. No, Jim, thanks so much for your very kind words and for your encouragement. And the question is, of course, very relevant. Of course, there is always a danger, Jim, with industrial policy, that you may go against competition. I stressed in this presentation the importance of competition. You need to have competition to innovate. It's a huge incentive to innovate green, to have competition. And of course, a danger could be that industrial policy could in fact get in the way of competition policy. So you need to think of the governance of industrial policy, or maybe to have subsidies that are not subject to, you know, that are not there to privilege some incumbent firms, to be at the expense of potential entrants. You want to have pro-competition industrial policy. Alors, in my view, but you know much better than I do, that the DARPA, the Defense Advanced Research Project Agency type of governance, with all, you know, and DARPA has improved over the years. Work by John Van Reenen and others have shown positive evolutions in the governance of the DARPA. And has, for me, I had the feeling that it had the virtue of having a top-down and a bottom-up component. The top-down is that money comes from the ministry, you have team leaders, and they elicit competing projects. I thought DARPA had to do with that, at least some aspects of DARPA, and the BARDA, which was the equivalent of DARPA for biotech, the Biomedical Advanced Research and Development Authority in the US, but you had many labs competing for BARDA financing. And so I had the feeling that in the US, they found a way with the BARDA and DARPA to reconcile competition, industrial policy with competition to some extent. But of course, that's a difficulty. And you want to have an industrial policy that is not going against entrants, that does not privilege incumbents at the expense of entrants. So you're right. It's that's why, for example, Anne Kruger and others in the 1980s were against any form of industrial policy because they thought that that eventually you would always end up undoing competition. So that's a huge debate, and the whole challenge is to be able to design a pro-competition, pro-entry industrial policy.
Thank you very much, Professor Aguillon. I think we don't have more time for questions. That's what the clock said there. So let's give a new round of applause to Professor Aguillon.
Thank you. Thanks so much.
Thank you very much again for your great presentation.
And Luis, it was a great surprise to see you, very nice surprise to see you and Jim as well. Thanks so much, Jim. And thanks so much, all of you. Thank you.
Thank you.
Bye-bye.
Bye.
Bye.
Thank you, Luis Felipe and Professor Aguillon. We'll continue with session 2, titled Macroeconomic Impacts of Ecosystem Services Degradation. The chair for this session will be Sofia Bauduco, Manager of Economic Studies at the Central Bank of Chile. So we invite Sofia and Professor Steve Polaski, the author of the first paper of the session, to have a seat at the front.
Thank you for being here. So this next session is on integrating ecosystem modeling into economic models with applications to efficiency analysis, gross ecosystem product, and policy analysis. So the speaker of this presentation is Steve Polaski. He's Regents Professor, Fester Lambert Professor of Ecological and Environmental Economics at the University of Minnesota. He holds a PhD in economics from the University of Michigan, and his research focuses on issues at the intersection of ecology and economics, and include the impacts of land use and land management on the provision and value of ecosystem services and natural capital, biodiversity conservation, sustainability, environmental regulation, renewable energy, and common property resources. So please, the floor is yours.
Great, thank you. Thank you for inviting me to this conference, and also thanks to the organizers for doing this conference. This is an important time, integrating climate, but beyond climate, integrating nature into macroeconomic models and finance. I am not a macroeconomist. As you heard, I'm an environmental resource economist. But I will do my best to get to macro. But I'll tell you a little bit about my background. So at the University of Minnesota, I have a joint appointment between ecology and economics. I also work on something called the Natural Capital Project, which is has economists, but more it has ecologists and hydrologists and climate people. So it's working on that. It's a lot of translation between economics and the natural sciences. We've had great success in being able to integrate economics and natural sciences in the world of ecosystem services and natural capital. To date, it's been more on the microeconomic side, so I think there's a bit more translation that's needed to get to the macro models, but I will get us part of the way there. But then the next talk, my colleague Justin Johnson will talk about models which are much closer to macro. So you can view me as the warm-up act for Justin's talk. Okay, so being macro, I thought I'd start off big. So I just want to make a basic point, which is that we live in the biosphere, and the biosphere is this thin layer above and below, slightly below the surface of the Earth, where life exists. We depend upon the biosphere. Think about, I don't know if any of you have seen or read the book The Martian, but life is pretty tough outside of the biosphere. There was, it's fair to say the biosphere is our life support system. Some of you may be aware of a paper that was published in the 1990s in Nature that said, basically the biosphere or nature is worth $33 trillion annually, to which economist Mike Thoman said, that's a serious underestimate of infinity. So, but many people, including the opening slides this morning, or the opening kind of monologue this morning, have talked about that we are in a new era. Geologists call this the Anthropocene, and basically what the Anthropocene means is that humans are now the driving force of change within the biosphere. It could be climate change, but it's also land use change, change in nutrient flows, and so forth. So if we're and this actually is a slide that comes from work of Will Steffen and colleagues. They termed this the Great Acceleration. So the impact of human activities in almost any dimension that you want to think about has increased greatly within the last 100 years, really since the end of World War II. So it's not just climate change, it's a whole range of things. We've modified the nitrogen cycle, for example, much more than we've modified the carbon cycle. Put another way, a little bit more poetically, I have a colleague in China who shows this picture. There's an artist in China. So the thing on the left, the picture on the left is actually a famous Chinese painting from the 12th century showing beautiful nature. The interpretation in the 21st century on the right shows trees transformed into construction cranes and mountains transformed into high-rises. So back a few years ago, I partook in IPBES, which stands for the Intergovernmental Science Policy Platform on Biodiversity and Ecosystem Services. It's quite a mouthful. Just IPBES from now on. There was a global assessment, and in that global assessment, summarized some useful facts and figures. We have, as I said, we live in the Anthropocene. We have deeply configured, changed the oceans, the atmosphere, and the land. Here are just some statistics. Actually, this was in the opening montage this morning. So 75% of land area is significantly altered. 85% of wetlands over the last 2 centuries have been lost. You can also look at this in terms of species extinction. So here are what's known about what's critically endangered, vulnerable, and so forth. Global extinction rates are far higher than they have been over the last 10 million years, and you can see, and in fact, again, that rate is accelerating as we come closer in time to the present. Well, it's not just about species. So, sometimes when people use the term biodiversity, I think they're talking about, we're worried about polar bears and panda bears and so forth. But this is not just about nature, it's also about humans. And so there's the term ecosystem services, or nature's contributions to people, but work within the IPBES summarizing the status and trends of what's going on with ecosystem services. So this is too small to read, but what I really want you to take from this is If it's orange, it means that the global trend has been downward over time over the last 50 years globally. If it's blue, it has been upward. This chart is dominated by orange. So what nature is contributing to people has been declining, especially on the left-hand side. That's the potential of nature, so the supply that nature can give to us. I think a clearer way, I want to draw one more lesson out of this. So the earlier version of the IPBES global assessment was something called the Millennium Ecosystem Assessment. It was published in 2005. It made the, it was going to be, again, about ecology, ecosystems, biology, but they made the point, in fact, titled it Ecosystems and Human Well-Being, right? That this is important for our own welfare. Again, this is too small probably to read, but maybe you can pick out that there are upward-facing triangles and downward-facing triangles, and those are services which are increasing if they're upward and decreasing if they're downward. There's an interesting pattern in this if you look carefully, which is that there are, first of all, very few upward ones, but the ones that are upwards are almost all private goods, right? So it's crops, it's livestock, it's aquaculture. Almost all the rest of these are public goods, right? So we know with public goods that the difference between what's profitable for a firm or a household for that matter, and what is socially optimal, there's going to be a divergence. And so we would not expect there to be an optimal amount of provision of natural capital or ecosystem services. And in fact, almost all the public goods we have seen drop through time. So one way of sort of summarizing this first part is that we have the previous geologic age was called the Holocene. We all grew up in the Holocene, but we are now in the Anthropocene. But we have sort of a holdover of Holocene institutions for what is now a brave new era. So in this new era, we vitally need to incorporate the values of nature and bring these into economic incentives, bring these into macro models and finance. So I'm going to present just a way of thinking about how I've and colleagues have been integrating ecosystems, ecosystem services, natural capital into an economic framework. What we're really after, we're really interested in thinking about how do we change people's decisions? How do we influence things? So in particular, policy decisions that are made, those are going to affect the incentives made by individuals and firms that take actions that affect ecosystems. Okay, so a lot of environmental science is in fact kind of stuck on that second arrow. Well, what happens, what's the consequence of land use change? How much land did we lose? How much, what was the wetland loss figure that I quoted? And that's fine, but to translate this into economics, we need to go further. So we and a number of other people have been working on what we call ecological production functions. So as a function of the structure and condition and functions of ecosystems, what do they provide? What are the set of ecosystem services, or now called also nature's contributions to people? What's being provided? Okay, and again, we could stop here and think about, if we have more farmland and we have less wetland, we will have more crops, but we'll have perhaps degraded water quality, less habitat for certain species. We can think about the biophysical trade-offs. We're part of the way there, right? We didn't stop just at what was happening to ecosystems. We translated this into what is it that's benefiting people. But as economists, okay, sorry, I actually, I meant to slip there. Okay, so again, one could stop here, but I actually want to pause here for a moment and talk about this first step of ecological production functions. Just mention, again, I mentioned the Natural Capital Project at the beginning. Within that project, we've worked on something called INVEST, which stands for the Integrated Evaluation of Ecosystem Services and Trade-offs. This is available software. You can download it. And it's meant to actually do this ecological production function. So what are the provision of various ecosystem services as a function of what either currently is, or hypothetically, if you made a change to land use and land management or resource use, what would it be predicted to be under those changes? So one of the features of these ecological production functions is that they are very spatially explicit, sometimes very fine detail in terms of location. So one of the models that Invest does is what's called the sediment retention model. So you can think about various land uses. They are going to cause a certain amount of nutrient or sediment load to flow downhill. So if we have a corn field, there's going to be a lot of nitrogen, potentially sediment and phosphorus. They're going to flow downhill. Now, some of that is going to get taken up by downstream forests or downhill forests, for example. But some also, they may contribute further to this. So they're going to retain some of this. There's also going to be additional export, and then we track this all the way down to the stream. So you can see this is a very spatially explicit process, so our models of it have to be quite spatially explicit as well. Just another simple example, water yield. So how much water gets into a stream or a river. So from this sample pixel, we can look at the upstream pixels. We can also look at the downstream pixels, and then the amount that that sample pixel is going to be sending downstream is a function of precipitation minus the amount that either evaporates into the air or goes down into the groundwater, and then you can track the surface flows. Again, it's very spatially explicit. Okay, so let me pick up the story. I wanted to do that kind of focus on ecological production functions for a moment. But as economists, we don't want to just stop at the biophysical. We would like to talk about the benefits and costs, so we can use economic valuation methods, both market and non-market, in order to get the benefits and the costs, and then think about what are the net benefits. So we think about economic efficiency. And of course, there are other considerations that go into this as well. We might be concerned about equity or process and so forth. But you see how this fits together. This is really an economics framework. We're interested in thinking about optimal policies, but optimal policies feed through to ecosystems, what ecosystems provide, which come back to benefits and costs, and ultimately thinking about what those trade-offs in the benefits and costs are. Okay, so I want to just run you through several examples of applying this framework. The first is kind of a standard benefit cost approach. So this is work that we did now back over 10 years ago in the state of Minnesota, where we were looking at alternative land uses. And so we thought about, well, what would the decision be if we ignored the ecosystem service values? And what would the decisions be if we considered the ecosystem service values? And we considered various alternatives. So I'm not going to go into detail about these, but you can see we limited agriculture expansion, or we had agriculture expand into basically all highly productive soils across the state, and so on. Okay, we were interested in the following. So in terms of ecosystem services, this was back now 12 years ago. So this was a fairly limited set at that time of ecosystem services that we really could quantify. So we looked at carbon, we looked at water quality, and particularly phosphorus, which is the primary pollutant within Minnesota. We looked at biodiversity. We did not quantify the value of biodiversity, but we just tracked the impacts. And we looked at returns to landowners. So what would the farmers get, or timber operations? We also had land in urban and suburban development. Okay, so under the scenarios, we're comparing here to what was happening at the beginning of this time period, which was 1992, to the end. So the baseline is if we didn't make any policy changes, The other 5 categories are what happens if we what happens if we change the policy. So here for carbon sequestration, you can see that new agriculture is really bad for that. No agricultural expansion and conservation are good. We tend to sequester more carbon in the soil or above ground. We do similarly for phosphorus exports, for grassland birds. Actually, grassland birds actually like agriculture as opposed to forest. Forest birds, it's the opposite. Anyway, you get the idea. We did this also for values of agriculture, forestry, which are minuscule in Minnesota, and urban development. So just the bottom line is, so you can go through that exercise. You can do the ecological production functions and get quantities of the various services like carbon sequestration, phosphorus exports. You can get to values either by using, for example, a social cost of carbon. We actually had studies in Minnesota valuing water quality, so we used those. We did not for biodiversity, so that was kind of off to the side. But anyway, if you look again at this major question about how did incorporating ecosystem services change what we want to do, well, first of all, if you look at what you want to do with ecosystem services, it looks like the no agricultural expansion is the best. If you ignored ecosystem services, it's agricultural expansion. The diametric opposite is the highest. And in fact, it's the lowest when you consider ecosystem services. So here's a case where the ecosystem services themselves don't dominate the values. I mean, the farm values, for example, or urban development values are higher. But on the margin, the decision is actually definitely changes when you consider ecosystem services in the mix. Okay, I want to consider a second example of the application of this approach of integrating ecosystem services and economics. This is work that we undertook with the World Bank, looking at what we call nature's frontiers. Now, most economists know from Econ 101 about production possibility frontiers. So this is work that actually is to drive what we call efficiency frontiers, including ecosystem services as well as other goods and services like the value of crops and grazing and timber. So the question here really was, can we simultaneously achieve biodiversity, climate goals, and sustainable development goals, right? As Professor Aghion said, you can, if you have the pandemic and you shut things down, you can improve on climate, but we don't want to do that. We want to have it all. So how do we do that? Well, we're going to have to improve upon current performance in order to be able to do that. So that's the motivation for this work. So the focus here in this work is on land use. So we're going to consider alternative ways that we can utilize land. So it could be crops, it could be for grazing, forestry, or natural areas. Again, we're going to account for multiple benefits. Here it's income, carbon, and biodiversity. The point here is accounting for multiple benefits at the same time rather than being siloed. You can improve in multiple dimensions. So just very briefly on the how did we do this. So there's a bunch of input data, mostly biophysical input data, like what is the precipitation, where does the, where's the flow of the water going, what is the habitat, and so forth. We consider the choice variable here is landscape alternatives. How are you using the land? We run this through INVEST and other models in order to get outcomes that we care about, again, on those either income, biodiversity, or carbon. And we also use an optimization approach that says, how do we get to the frontier? How do we, for any given level of, let's say, income and biodiversity, how do we maximize carbon storage? Okay. So we can, by using that optimization, we can actually trace out this efficiency frontier. That's what the blue dots are. We also can use the models to tell us where we are currently. So this is for Paraguay. You can see Paraguay according to our analysis, is well inside the efficiency frontier. We can trace out how much carbon you could sequester or biodiversity you could increase, or how much you could increase income without reducing those. So what are the Pareto moves in this space? So it's not only tells you sort of how much you could get, but also what are the kinds of moves that you would have to make, what are the land use or land management changes in order to get you to the frontier. Okay, so we did this actually for 146 countries around the world. It was a massive data collection operation. I was working with a large team of people who specialize in biodiversity, people who's, we had also water people, even though that's not in here, carbon, and so forth. So if you, this is just 4 sample countries out of the 146, but I picked them to kind of illustrate a point, each one. So up on the far left is Haiti. Haiti is extremely far from the frontier. A lot of land is degraded, so they do not do very well both in the economics as well as the environment space. So Haiti originally had lots of forest. If you could restore forest land, you could do far better in the environment. You could restore some of the forest land as well as then improve the agricultural lands, and you can do better on both. Okay. Some countries it's not possible, so Iceland, basically Iceland, if you've ever been there, I mean, you can either graze or you cannot graze. So the question is, how much grazing do you want to do? And that just moves you along that frontier. There are other countries like many in Latin America or sub-Saharan Africa that are lightly populated, have a lot of their original forest cover. They do very well in terms of carbon and biodiversity, not so well in terms of their maximum that they could do in terms of agriculture or grazing or timber values. Opposite a highly developed country like Japan, you see is in the lower right. You can also then sum up across the countries, so the question on this Pareto move, if you move straight up, and this is just for carbon, how many more tons of carbon could you sequester in terrestrial ecosystems without adverse effects on the economy? So we calculated of 233 billion metric tons. It's a lot, but it's not, it's not the energy sector. I mean, I think this was 4 years or so of global emissions, so it's something, but it's not a permanent fix. Or you could move to the right and increase agricultural and timber and grazing values by 300 or 400 billion without loss of biodiversity and greenhouse gas sequestration. I'm going to skip this in time. I will mention this one. So again, going back to Paraguay, you can also ask the question, well, how do you get from here to there? How do you go from the current landscape, which is inefficient, to a more efficient one? And so we looked at the paths that one would get. The good news on this is there are a few very important changes that you can make. So here it just says, like, if you take 30% of the changes, these 3 transition steps, you get almost 2/3 of the benefits. Okay, I want to switch gears a little bit and talk about one other application. This is work that we have done with colleagues from the Chinese Academy of Sciences. A lot of work in this area in China. It's called Gross Ecosystem Product, or GEP, right? We all know about GDP, but what about GEP? So why is China doing this? So it's trying to develop a new measure of like what is nature contributing. They want to be able to use this in parallel with GDP. So it's not replacing GDP, it's a new metric. And so the idea here is that that government officials, for example, would be evaluated both on how did GDP do as well as how GEP did. So what GEP aims to do is to reveal the contributions of nature or ecosystems to the economy, show how those, show the connections in these ecosystem services among regions, provide the basis for payments for ecosystem services, and as I said before, serve as a performance metric for government officials. So it reported alongside of GDP. Okay, so GEP, what it is the how much, what is the monetary value of the flow of ecosystem services. So it's what is nature contributing to the economy. And this is just a simple chart. There is obviously overlap between GEP and GDP. I mean, think about agriculture. Some of it is contributed by nature, but some of it is contributed by human labor, farm machinery, and so forth. And so there's overlap, but there also are some things that are left out of GDP altogether that are important. So things which, people's aesthetic appreciation of the environment, or flood protection. Well, some of that comes into GDP because it would be reducing built capital. But as you can see, there is overlap, but there's also, this is different information and presented in a different way. It's really what is nature contributing both to marketed and non-marketed goods and services. I'll skip this, but Jim Stock made the point earlier today of, well, all right, I guess I'm going to say it after all. So these are not welfare measures, and so GEP suffers from the same problems that GDP suffers from. So in particular, I've had to explain this to very puzzled ecologists and said, you can, if you have inelastic demand, have a fall in the supply of an ecosystem service and the value of that service increase. Now, of course, we all know what that is as an economist, but again, the point here is this is not a measure of surplus or of welfare. It's a box, right? It's price times quantity. Okay, the other thing that's important to mention on this is it's not a measure of sustainability, right? We really want to talk about wealth measures. So, if we coupled this with a measure of the value of natural capital and said that the value of all capital stocks, including natural capital, would be non-decreasing, as Arrow and others have said, that's a good measure of sustainability. This is a flow measure, an income measure, so it itself is not a sustainability measure. Okay, so how do we go about measuring GEP? Well, there's 4 steps, and many of it parallels what I've talked about for some of the earlier examples. So the first is actually here to track the stock of natural capital. So natural capital is what produces the flow of ecosystem services. We need to use the ecological production functions to go from the conditions of ecosystems to the flow of ecosystem goods and services. We need to be able to price them, right? So this is the valuation step. And then finally aggregate this up into GEP. So you see, the steps that I talked about before. Step 2 is the ecological production function. Step 3 is the valuation step. And then we're putting this into a different format to get it into GEP as opposed to putting it into benefit cost analysis like I did in the first example. Okay, so in China, we had a huge advantage. So every 5 years, China does a China ecosystem assessment. So we used the China ecosystem assessment in the year 2000 and the year 2015 as the basis for our analysis. We used the INVEST models in order to translate this into ecosystem services. We'd actually published an earlier paper on this work on sort of where were ecosystem services produced in China. We then combine this with valuation. So in environmental economics, a lot of work has been done on pricing non-marketed ecosystem services. I'm not going to go into detail here other than to say, like within environmental economics, people will talk about, oh, we want to do hedonic property price approach, or we want to do travel costs for recreation. In this world, in ecosystem services, there is a lot of what it's called imputed values, so like pollinators. The way you can figure out the value of pollinators is to do the ecology and figure out how pollinators contribute to increased quantity or quality of crops. And then you use market prices to tell you, well, what is that worth? So actually the hard part there is not on the economic side, but on the ecology side. There are other things, however, that are much harder on the economic side. So thinking about what are called non-material services. We used to call them cultural services, so it's things like experience or aesthetics of looking at nature, or tourism, or spiritual values. Okay, and then the last step is aggregating this into GEP. Okay, so you want to avoid double counting, but you also want complete coverage of at least the important ecosystem goods and services. Okay, so just tell you quickly about an application. This is in Qinghai province, which is in western China, high up on the Tibetan Plateau. It's known as the Water Tower of Asia because it's the headwaters of the Mekong River, the Yangtze River, and the Yellow River. Again, too small to read, but what each of these rows is this is an ecosystem service grouped either by, is it a provisioning service? Is it producing something like crops or grazing? Is it a regulatory service? Is it modulating, like, is it filtering out air and water pollution? Is it a new one that I learned in China? Does it prevent dust storms? That's important. Or is it a non-material service like tourism? And that is, in fact, the only non-material service that we have. It's not the only non-material service, but it's the only one that we could actually reasonably measure. So we added that up. We got values for it. The values for that are not so important, but again, you can spatially look at where are these services being produced or provided, and then the ones on the right, the maps are by province, where are these services being, where are they generating benefits? So is it downriver, as in water-related ecosystem services, downwind, as in preventing dust storms, or for recreation, where are the people coming from to Qinghai? So let me just sum up. I want to leave you with a couple of concluding thoughts. So first is that economic activity is causing rapid changes in the biosphere, right? We are changing the surface of the Earth, we're changing the atmosphere, we're changing the oceans. There is a research policy agenda for which economics, I think, plays an incredibly central role. And I hope that we can make progress on more accurate accounting of the provision of ecosystem services and their values. This is work that's done in concert with natural scientists in order to get to the provision. But the value part of this is something that economists contribute almost all on their own. But then the second step, which I'm not going to talk, I haven't talked much about or won't in this talk, but how do we link this to the policy mechanisms to provide economic incentives to maintain the natural capital and the flow of ecosystem services? There is a lot of work that has been done on that. We've talked, I think the comparison to climate change is good here. Of course, we have done a lot of work on accounting of carbon stocks and flows. We've already mentioned social cost of carbon. People have talked about carbon taxes, carbon cap and trade, innovation policy, and so forth. So there's no shortage here of things to do. And in fact, here's just sort of, living in the US, we sometimes get jaded and think we can't do any carbon policy, but there are a number of applications around the world. Now, ecosystem services are slightly different than carbon. First, there are many ecosystem services as opposed to one carbon budget. And secondly, that, I envy the people on carbon. There is a global carbon budget. Ecosystem services, location, location, location. So the analysis actually has to be spatially explicit. So in that sense, ecosystem services and bringing ecosystem services into a macro model is necessarily going to be somewhat messier. But despite the difficulties, as I hope those examples show, we know more than enough to get started with this. And I think it's vitally important, given the rate at which we are changing the Earth, that we get on with this. So I'm going to end with a final thought. This is, if you travel in China and you work in the environment area, everywhere, every talk starts with the following quote from Xi Jinping: "Lucid water and lush mountains are invaluable assets." Sometimes called green and gold, or green is gold. But drawing the parallel back to economics, and actually back to, like, when did GDP arise? So in the Great Depression in the 1930s, there was the realization that we didn't know what was going on in the economy. We needed better statistics. We needed to have better information in order to help guide economic policy. Well, I think now, one could say we're undergoing the great degradation of natural capital, and we urgently need, just as we needed GDP back then, we need GEP or its equivalents in order to help know what's happening with ecosystem services and natural capital to help guide sustainable development. So with that, I thank you very much for your attention.
Thank you, Professor Pulaski, for a very interesting presentation. So we won't have a discussant, so we will switch directly to the questions from the public. So if you want to ask a question, please raise your hand. Yes.
I have a commentary, because so when I think about the topics you mentioned, of course, the one challenge compared to carbon, and you mentioned, is that ecosystem services have a much more localized impact. And therefore, in terms of policy, perhaps there is less space for international coordination, which could be, which could make things easier or not, depending on the context. I'm wondering if there are examples of localized approaches, and I'm sure there are. So you could mention some example of localized approaches which still, take into account these dynamics at a national scale. So of course there must be, I guess, some integration between regional administrations and national administration. And I suppose China could be an example, even though China is quite dramatically degrading its environment in certain regions. So, but yeah, I'll leave it to that.
Yes. Can we take a couple more? Yeah, Gonzalo.
Hi, Professor Pulaski. Gonzalo Garcia Trujillo from the Central Bank of Chile. So thank you very much for an amazing presentation. I enjoyed it a lot. And I was thinking about, because this is a huge framework, right? It's a really complicated framework because we are linking an economic model with ecosystem services models, not just one model, it's a suite of models, right? One model for each ecosystem service that we want to incorporate. So usually what we do, or at least this is my understanding, and please correct me if I'm wrong, but the usual exercise is that you take a baseline, for instance, in terms of, economic performance. You assess, and for instance, if you want to assess the impact of a policy, you are going to try to evaluate the land use change, and that is going to be the input for the ecosystem services models, and then you are going to get changes in the provision of those ecosystem services, right? And that's great because we know what we are losing in terms of ecosystem services, but also we can get like a second round in terms of the iteration and see how the economy is going to be affected because you are losing some part of those ecosystem services. But at the end of the day, there is another interesting question that is, okay, so if we continue growing at the pace that we are doing it today, and we continue degrading the natural capital and the ecosystem services themselves, at some point the economic activities are not going to have enough ecosystem services to continue growing or at least producing as much as today. So the question is, what is the baseline at the end of the day in terms of country level? So how can, if we think that we are degrading the nature or the natural capital at a very accelerated pace, what this kind of framework can tell us about what is going to happen in 2100?
Does it work? Yes. Max Alfheimer, thank you for a fascinating talk. I really enjoyed it. I think my question is somewhat similar, but like in poker, sometimes you have to double down. So this looks unbelievably complicated compared to what we're trying to do with sort of global climate impacts. Yet I want to figure out whether we can make it even harder. Okay, let's bring it on, right? So even though Jim Stock has declared victory for the social cost of carbon already, I'm going to disagree with Jim here. And one of the big left out things is what happens to ecosystem services under various scenarios of climate change. So I know you're doing sort of an overall estimate, but for the different scenarios that we have, is there any hope to adopt these models in that context? And third, in a way that is compatible with these new systems that people have developed in a sort of open source kind of framework. So is this something that lives in your shop and I have to call Steve and Justin to do this? Or is this something where somebody who writes in Julia or something like this could actually go and build modules to do more work here?
You want to answer? Elias.
So I think my question is also related to the previous two, so we're gonna triple down on this topic. So we've been talking about the climate transition for a while this morning, and tomorrow we will continue on that. And despite the many difficulties, I mean, it's not hard to imagine that if we undertook the right policies, we shouldn't necessarily face a trade-off between long-term growth and stabilizing climate, because it's essentially changing the energy matrix of the world. That's what it is. And that is totally feasible given the technologies we have, if we deploy them correctly and so on. I mean, it has its costs, but on the long run, it shouldn't affect long-run growth that much. Now, when you go and start analyzing other dimensions of nature, like you did in this presentation, that question becomes a lot trickier. And in my opinion, this is the most important question we have in economics, certainly the most important one that we do not devote resources to answer, which is how much can we continue growing given that we have all these multiple dimensions of nature that interact and sort of amplify each other. At least degradation in one dimension amplifies the degradation in other dimensions. So let me narrow down to a very simple question. At our current level of growth, we are expected to double current GDP in about 25 years. In terms of like orders of magnitude, do you think that is feasible, given the violations of the planetary boundaries that we observe already with the current level of GDP? So I see some plots in your presentation that suggest maybe it is, because we are sort of inside the frontier of the efficiency, right? But then going to Gonzalo's question, I mean, there's got to be a limit, right? You mentioned Iceland. Like Iceland, there's no room for optimization. They're kind of there already. So what is the point where the world reaches, when will that point be reached? I mean, I find it appalling that as economists, we not only have not answered the question, that we don't have models, or maybe this is the type of models to answer the question, but it's just like a starting. So I would like to know your views on that. I mean, are we going to hit the Malthus limit at some point, or is this something that we, like you said, we can have it all, and there's no limit, conditional that we do things the right way? Thank you.
Okay, I can't remember anymore, so let's do this. Okay, so I'm going to take them in order. So the first question was about, correct me if I'm not right, but with climate, it's global, and with many ecosystem services, it's much more local. I actually think that makes policy easier. You don't have to have climate clubs or international coordination. If you're polluting your own river, typically you're suffering the consequences. Now, obviously, long rivers like the Nile or the Mekong, you still have international coordination conditions there, but I think it does make it easier. And in fact, there are good examples of the kinds of nature policies in countries. So I'll mention 3 countries. So in China, they have perhaps the largest, which is either called the Grain for Green program or the Sloping Land Conversion program, and they also have others, forestry programs and so forth, which are payments for ecosystem services. So, I think you also said, which is partly right, which is that China has degraded their environment, and that's part of the reason why they're moving on this now. But they have instituted, since some disastrous floods in 1997, 1998 on the Yangtze, they instituted these very large payments for ecosystem services programs. So actually, in the period that we looked at across much of China, many ecosystem services are actually improving. So, and if you've been to Beijing or any other Chinese city, you'll know that air quality is improving. So they have reached that point where it's no longer about strictly maximizing economic growth. It's we need to take care of the environment as well. So they have instituted a number of policies at the national level. Now, your other point there, I think, was that local conditions really matter for these things. So like if you have a blanket policy like we do in the US or China does, frankly, we're going to pay a certain amount like by county, let's say. You really care about some land which is highly erodible, close to streams, maybe has habitat for an endangered species. You don't care so much about others. And so, a really tough practical problem is how do you target these policies which tend to be blanket to where you really need, where they're really generating a lot of benefits. But China has policies, the US has a conservation reserve program and other policies that pay landowners for providing ecosystem services. Perhaps the best known or the earliest was Costa Rica, which had, I won't butcher the Spanish, but basically a payments for ecosystem services program that had a surcharge on fossil fuel use and then would pay landowners to, grow trees or do other things that would increase ecosystem services. So, yeah. Okay. So I wasn't successful in part of my talk with, you said, oh, this looks so complicated, and Max doubled down on it, and then Elias tripled down on it. But I think the thing to think about here is, yes, there are a lot of details, but the overall framework of this is really not that hard or different than climate. It's the ecological production function. We do something to the environment. How does that change the provision of various services? Now, here there are a lot more services than just carbon, but the principle is the same. So, Max, I'm going to answer part of your question now, which is that's part of the reason for developing this Invest software. So it's not just you have to call up Justin or I in order to do this, that we're making this freely available with good technical support so that when something doesn't work on your machine, you can get some help So, to use these well, you do have to know, it's helpful to actually know something about where you're working, what the ecology or the ecological production function is telling you, so you can kind of see, does this make sense? But again, it's really the ecological production functions, and then it's the valuation. Why is this important to people? How do we value it? And that part, of course, is bread and butter for at least environmental economists, but I think for most economists. It is hard in many of the non-market. We have put a lot of time into the ecological production function side of things. We've put, as the Natural Capital Project, less time into the valuation part of this. So I think greater improvement can be done there. But in principle, we know how to do this. You also asked a very good question about baselines and thinking about going through time. As with any dynamic model, things are going to evolve through time. One wouldn't just obviously take a static baseline, but I think about taking baseline trajectories. So you think about a baseline trajectory without the policy, put a baseline, put a trajectory with the policy. Professor Aguillon kind of showed, hey, here's how this evolves through time, with and without. It would be a similar type of exercise here with ecosystem services. Okay, and then there was another part of your question which I think I'll get to with, well, let's see. Max, I think I've addressed your question, but come back to me if I haven't. The last question, of course, is always the hardest, which is, so what is the carrying capacity of the Earth? Like, how big can we grow, if I interpret that question? I don't think we can, I certainly can't answer that. One part of this, I think, that I'm very leery about is, as was mentioned, your talk earlier with tipping points. Where are those tipping points? In principle, we can talk about there being feedbacks and systems undergoing collapse, and we see that in shallow lakes, and we see that with fish populations. For really large and important systems, where are they? So Tim Lenton has talked about feedbacks in the climate system. I don't know where those are. I do know we have done some work on a project that we called Make It Fit, which is like, how much could people want to have a high standard of living? Can you in fact double? Can you get to 2050 where everybody's standard of living is higher? The work that we did in that project, we found that in fact by being smarter, by shifting, like, for example, to renewable energy, you can have more energy without more carbon. Land use is actually on the easier side. There's a lot of things where we can improve the productivity of land and therefore get more food without expanding the land base. So there are things that can be done. Improving water quality is frankly really hard, because improving food production without expanding means you're putting more fertilizers on land, particularly in sub-Saharan Africa, and that's going to lessen water quality. So there are trade-offs, but could you make it fit at least into the immediate future? I think the answer is yes, with the caveat of there are surprises. There may be these really unpleasant thresholds, and that's what I worry about, and that's not adequately captured in the models.
Thank you very much. So now we go to our second presentation of this session. So our presenter is Professor Justin Johnson. He's an assistant professor at the University of Minnesota, where he received his PhD in applied economics. Professor Johnson researches how the economy affects the environment and vice versa on global to local scales, using big data, spatial econometrics, and computable general equilibrium modeling. So, Professor Johnson, the floor is yours.
Thank you so much, and thank you for organizing this, and thank you for having me. This has been already a fascinating series of talks, and so I'm glad to participate. I want to talk today about using Earth economy models to assess global sustainability policy with a recursive dynamic approach. Is there any way I could get the slides also on the screen down there? Thanks. And this is going to be based on a paper that we have recently published in the Proceedings of the National Academy of Sciences titled Investing in Nature Can Improve Equity and Economic Returns. So let's get started. First off, I do want to start with an overview. I think understanding the position of economics with respect to sustainability and these challenges that we're facing is critical and also pretty nuanced. After discussing that, I want to jump into the introduction of a new model that we've created called GTAP Invest. And then I want to actually talk about 4 of the methodological advances that we needed to figure out to make this happen. I guess partially addressing why hasn't it happened before, too. I'll talk about results from the paper shortly after there. And then I want to end on broader conclusions on Earth economy modeling. And you might notice that question mark. That was not supposed to be there. That was my mistake. But I actually like it. It's sort of suggestive of what are these next steps? We have an open playing field here. How can we invest in the right new research at this really critical time? So as Steve and others have said, we are going from the Anthropocene, or the Holocene, into the Anthropocene. And in other words, we're leaving this nice little area, I've circled it here, that's the Holocene. This is temperature over the last 100,000 years. And you can see, might be hard to read, but the second to rightmost line is the beginning of agriculture. All of that has happened in this one narrow little band where there is almost no variation in the temperature. And so that Holocene was very good for us. But we're changing. And you know something is official when The Economist says it. Here we are going into the Anthropocene, where now humans are the driving force of many of the geologic processes that we care about and affect our well-being. I like to think of it in this sort of systems dynamic approach. This is from Stefan et al. But basically, we have different tipping points, and we have different stable positions within this space. You can see the progression of time here. That's a Holocene at the beginning, so that's that stable area that I showed in the line graph. And as we progressed forward, I guess, towards the viewer, we see that we're coming upon a planetary threshold, or planetary boundaries. And that's the dotted line there that is sort of the barrier right before it falls off into some sort of hothouse Earth, or some stable equilibrium that is in a place that we really don't want to go. So our question here in front of us, how do we turn the ship? How do we steer so we don't crash through those planetary boundaries and get to what here they've just called some sort of stabilized Earth equilibrium? And so this one's personal. Economics, I wanted to tout our achievements. Economics has been wildly successful at what it is good at. And maybe I take this one personally because I often find myself talking to ecologists who really don't like economists. And so maybe I'm just overstating this response here. But we did phenomenally well at improving the physical consumption and the well-being that comes from that. And so Steve already mentioned this briefly, but economics provided the navigational tools to make it through the Great Depression. And some of these tools, I'll talk a lot today about general equilibrium modeling, but also just understanding the basics of capital accumulation, creating that economic consensus. And what did this get us? Let's not forget huge poverty reductions worldwide. The statistic that stands out to me is that the life expectancy of somebody born in the US at the turn of at 1900 was 41 years old. That's not too far away, and it is much less than it is now. We have improved our consumption, improved our healthcare systems, all these things that go along with that, and we are, by some pretty easy to define metrics, doing all right at that in some places. Of course, the huge caveat, some places. But the success here in increasing consumption, production, and therefore the consumption of these welfare-producing goods has also raised new challenges. And this is oversimplifying, but I think it is useful to think about the challenge as switching from one of overconsumption now as the problem instead of underconsumption, which was basically the problem of the Great Depression. But as we go towards this change, I think we're increasingly going to see, and I contend that economics has a massive blind spot, and that is that the economy is embedded in the biosphere. Now, I think probably everybody here recognizes this, but still in the workhorse models that we use, the biosphere and the way it supports the economy is not explicitly represented, at least not in the full complexity that we know is there. And this is important because now the challenges we face are increasingly global. We have interconnected markets, and more the questions we're answering are going to be based on common resources. So Steve put up the cost benefit and the profitable, not profitable chart. Increasingly, the ones that we have to solve, the climate crisis, the biodiversity crisis, are in that area that are not profitable but have a huge marginal benefit to do. And so we need to figure out how can we make progress there. But put more simply, and using this term that economists always seem to love so much, I believe that to navigate the Anthropocene, what do we need? We need to create a more general equilibrium, to misuse the terms just a little bit. Okay, so the context here. Going quickly, we know that there are planetary boundaries. We've talked about that in a number of talks, and that we should not surpass the ecological ceiling, which is here defined as that outer green line. The red rays coming out are the different planetary boundaries. This is from Stefan Rockström, others, the whole planetary boundaries framework. But simultaneously, we also know that we need to be above some sort of social foundation. We need to provide sufficient access to foundational goods and services. And this was put forth in a compelling way as donut economics from Kate Raworth in 2017. Although it's making more standard forays into the academic literature very recently with Johan Rockström's safe and just corridor. The idea is this donut, or this corridor, we need to be able to figure out how to navigate through the Anthropocene while staying in that relatively narrow space. And I love this. It's a wonderful framework, but it's really limited. And where is it limited? It doesn't answer the key things that you might care about. It can tell you, are we in the donut or the safe and just corridor? But it becomes less useful when you have to answer specific questions like, what policies should we pursue? And that's really where my interest is. And so I would say that staying within this safe and just corridor requires detailed models, not just frameworks, but detailed models of how the Earth and the economy are linked. And we've done tons of work on this. I think a lot of the prior focus was really on the impacts side. How does some sort of activity in the economy impact on Earth systems like deforestation? But where a lot of the research that Steve talked about, the Natural Capital Project, and others who think about ecosystem services have focused on is where are their dependencies? Where would a change in ecosystems or Earth systems result in a real loss to people's welfare or the economy overall? And so what did we do? For the paper that I'm presenting today, we essentially tried to create that model in a very practicable, implementable way. And so we took two of the most well-known models, in this case GTAP, which I'll talk about, and INVEST, which Steve has already talked about, and glued them together. There's a lot more to that, hence a long paper. And I would say one of the downsides of writing in PNAS is, not focused on the methods. This was a methods-heavy lift. And so check out our supplemental information at 156 pages, I think, at this point. But there is a lot of work that needs to be done there. Our motivation for this paper was asking, could we make an actionable, decision-relevant model that fills out that question of how? How do we stay within the safe and just corridor? So I'll preview first, and then I'll talk about these in turn. But the basic idea is represented here. We're going to start by running our model once, GTAP AEZ, I'll say what that is, but we're going to project into the future. And this gets us, among other things, a critical variable, which is an endogenously determined calculation for how much land use change would we expect. That becomes an input into a land use change model we call SEALS. And this is a necessary step because having land use change at the country or agroecological zone scale is nowhere near high enough resolution to plug into Earth systems models like the sediment retention model that Steve showed from the Natural Capital Project. So the second step then is downscaling it. We do this globally at 300 meters, so a fairly high resolution. Once that map is created, that's then an input into our invest models, which I'll go quickly through, because the final step then is to take the outputs of invest, and what we're going to do is we're going to run GTAP a second time. And this will be for the same time period, so we're not going forward a step yet. It's going to be the same economy, but now with those degraded ecosystem services. And so the differences between step 1 and 4 would be the difference in GDP or welfare, at least in this case as measured by equivalent variation, with and without those ecosystem service-related shocks in the model. It gets really complicated to do all those. So this is just a preview diagram, but we're going to walk all the way around this Earth economy model here in the next few minutes. And in particular, I'm going to start by focusing on what do we have to do to make the econ part of the model work in the context that we needed. And so what we did is worked very closely with the Global Trade Analysis Project, GTAP. And this was founded a long time ago, 1992, but we had the fortunate benefit of working directly with the founder, Tom Hurdle, of that. This is a publicly funded organization with core support from some of the biggest names in international trade, development, statistical offices, et cetera. And it's a big and growing community. To want to highlight, though, it's almost confusing. There's two distinct components that GTAP is known for. The first is just the database that many of us use. And this is a standardized, harmonized, curated data set of regions, sectors, input-output relationships, trade flows, tariffs, all the things you need to know on a practical level to do this type of analysis. The second thing they're known for, though, is the GTAP Computable General Equilibrium, or CGE, model. And so I want to talk about that. This might be common knowledge to many people here in this room, but still I want to focus on it for just a second, because it's important to where the hard work really had to take place to make this all work. So computable, C. These need to be sufficiently detailed and linked to real-world data. This is not a theoretical exercise. In the model version that we run, we have 36 different sectors in 141 different countries, and so that's a lot of production functions in a lot of different locations. And with that constraint, then, it needs to be computable still in finite time. So we're also, here I'm emphasizing, we're going to solve this in numeric terms, not in solving some sort of dynamic programming approach. This is going to solve it numerically. It's general, though, in the sense that all the parts of the economy interact. We have the circular flow. I've got this chart here that is just a particular example of how the variables in GTAP flow among different parts of the economy. And it's equilibrium, where all the basic good stuff of economics, producers maximize profits, consumers maximize utility, and prices adjust until all of our markets clear. So that's a CGE. The one we use is based on the core model, as it's referred to, which models the entire economy, and GDP is endogenous here, so that's not going to be a calibration parameter. And we have exhaustive bilateral trade and transport ties. For better or worse, the origin of GTAP was as a trade analysis tool, and so we have quite a bit of detail there. We use the latest version of it, which was in Kurong et al. 2017. But before going to what we actually did, I want to mention the GTAP community has been successful because it's promoted open science, and they have a wide variety of different spin-off models, if you will. It's almost an alphabet soup of different variants of the GTAP model, like GTAP E for energy, or bio for biofuels, or POV for poverty. The one that we're going to use today is the GTAP AEZ, or Agroecological Zone Model, which has in the past been used for assessing how can we optimally use our global land cover that we have. The way it works is it breaks down the world not just into countries, it does use that, but also splits the world into 18 zones. These are going to be based on just basic climatic aridity, humidity conditions, and growing period information. But what this does is it allows us to identify how land is used as an input into the production functions calibrated to each of those different agroecological zones. And this has been used a whole bunch of times. Most of the time that it's been looking at specific topics like biofuels. Is it a good idea? Or the water-food nexus. And it's been used many times in GHG mitigation, especially with respect to land-based emissions. And a side note, it's also the database and model that is underpinning a lot of our large-scale, especially land-focused integrated assessment models, such as GCAM or AIM, or the FARM and EPA models that we have here in the US. So what's the structure here of this model? Like many of such models in this space, we're going to have a production function, and it's going to be just a constant elasticity of transformation CET function, and is going to be parameterized by a pretty basic equation. So the production Y in sector I is going to be a function of this, where the real lifting goes on in the middle. We're going to iterate over all the different J inputs to production. And being a CGE, this is going to be a lot of different sectors. And so basically that's the three different boxes underneath the output. Based on the elasticity of substitution, the producers are going to be choosing the optimal set of inputs to production, basic econ here. We add a lot of specificity, though, by nesting these equations into each other. And so instead of just saying it's a one-shot choice where, based on the elasticities, the producer chooses how much endowments of value-added inputs versus intermediate goods from other sectors, that value-added input calculation itself is going to be the result of a previous set of equations, also CET functions, where we figure out how much land is being used. The AEZ extension then says, let's not regard land as a dollar value denominated bit of capital, and let's actually even go farther than just saying it's a aerial unit, a hectare of land. Let's actually try to get at the quality of the land. What is the yield there? How in one location does that change the productivity in the production function of this one sector, say agriculture or pasture, differently when you use land in one location versus another. So the point is, we're trying to add a lot of the realism, and this is important because things like agriculture, and also, as I'll get to, ecosystem services, are hugely spatially heterogeneous, and that's been a theme that's come up throughout. So this structure is there so that we can say specific things that still rely on basic econ theory, but give us enough flexibility to parameterize it to match that complexity, that spatial heterogeneity. One of the biggest things we had to do to modify the AEZ model was change how it regarded the stock of land. The standard GTAP AEZ model, as well as basically every other model out there with one exception, regards the amount of land, the amount of, as capital essentially, that is available for production in the economy as fixed. And this is not a great assumption if what you're caring about is things like agricultural expansion into natural land. And so if you're competing over just a fixed stock of land that can't grow or shrink, you can't really say much about agricultural expansion. And so what we did is we created a new version of GTAP AEZ in which the land supply functions are, where we added land supply functions. So rather than just having a fixed amount of land, a stock of land that can be used in production, what if we actually put out a supply function for it? And so in other words, when we're thinking about the producer's problem, maximizing profit subject to the usage of its inputs, instead of taking one of those inputs, x sub I, which would represent land as fixed, we're going to plug in an equation there. And this equation we're going to calculate from spatially explicit GIS data. And so in other words, instead of being something that is fixed and set by the FAO or whomever, we're going to say it's going to be some upward sloping curve looking a little bit like this. And so each AEZ is parameterized with a differently shaped curve representing what stock and quality of land is available in that AEZ for each of the different types of production towards which it might be used. And so, because we do everything at a high resolution, we have a lot of information to leverage here. This isn't going to be looking at a per country arable land statistic. We actually go in and, based on crop suitability models, crop models themselves, and many other spatial variables, we try to get the exact shape of this curve right. But I'll list this as a frontier where I think a lot more research could be done. But the basic idea here, and why this is so important, is that now, not only is the amount of land used in economic production no longer fixed, is part of the optimization. So if you're a landowner and you realize that you could produce more profitably, but you need more land, well, you can bid up the price of land. The sort of basics of economics here now do apply. And that surprisingly simple conclusion, or the feature of a model, has really been absent in much of the application at a global scale for analyzing conservation policy. And so why might that matter? A policy like land protection at a large scale, like for instance, 30% of the earth by 2030, 30 plans out there. These are going to be ones that take a lot of land out of production, and we don't want to say that that is going to have no effect on the economy. This framework allows us to model that. Here you can see just an example. We're going to shift the asymptote in, and this will result in a new land supply curve that is shifted, just like in our basic economic 101, which means that we'll have less use of land, but now at a higher price. The critical methodological point here is that this means that removing land from production is no longer free, which it has been assumed in a lot of global conservation assessments. Okay, that's been the basis for the model that went into the article I talked about, but immediately upon setting down that path, wherein we created a comparative static model, we knew we needed to have a recursive dynamic model, but we just broke it off into chunks. So now I want to talk about the next step of the model. The World Bank, and in particular the Changing Wealth of Nations team that puts out their great reports on inclusive wealth at a regular interval, engaged with us to say, how could we say something about the future of inclusive wealth? And they recognized that to be able to say something that was specific to different policies that might be implemented, you need to have a model that essentially is like the CGE that we created. And so they want to calculate policy contingent estimates of inclusive wealth, and essentially they've given us a block of time to create a new model, which we're cleverly naming GTAP Invest RD for recursive dynamic. But it's going to be leveraging what I described before and doing a sequence of time-based comparative static optimizations, but with myopic expectations. And so that's a big departure from, I think, a lot of the modeling approaches used in this banking type of community. But what that buys us is the ability to have much more detailed economy in terms of the number of sectors and the number of different regions. And basically, then we just take the outputs of one comparative static equilibrium calculation and plug it into the next year, but of course keeping track of how endowments change, technology and preferences, policy, et cetera. The only thing that we've added that is actually a little bit more towards a standard dynamic model is we do have the endogenous capital accumulation effect that is driving capital accumulation, so basic equation of motion, keeping track of how does investment, as is determined by the CGE, get used for creation of capital in the next period. So that was the main step I wanted to talk about. What did we have to do to get the econ model working? I want to quickly, very quickly, talk about 3 of the remaining steps to fully link this system all together. I think the main reason why this type of work hadn't been done before, at a global scale at least, is because the second step here. It's really hard to go from coarse projections of land use change down to something like 300 meters, which is what's needed for all sorts of different Earth systems models. So we used a downscaling algorithm that we call SEALS, and we've now had a couple of publications on it. I won't go into the details, but the basic idea is we need to go from that map above here in panels A and B, which is the endogenously determined number of hectares of, in this case, agricultural expansion that is calculated to happen in each of these country AEZs, and go towards something like this in a sensible way. How do we go and do that step? We rely on a land use change algorithm that is able to do a couple of things, not just say, where does the new crop expansion happen, but we also had this extra criterion that we needed to have it be able to implement grid cell specific different interventions, like for instance, putting riparian vegetation along the edges of streams to hold that sediment in right before it makes it into the stream. We wanted to be able to do our land use change model and have that level of complexity. I'll skip the details of this, but basically we trained a spatial adjacency machine learning algorithm with some cross-validation approaches to come up with an algorithm that takes as an input the amount of land use change at the AEZ level and outputs our land use change maps. The third step then is what Steve has already started talking about, is taking the land use change map and using it as one of the primary inputs to our different ecosystem service models. And so currently, the GTAP Invest framework calculates 6 global ecosystem services, which are sediment retention, climate regulation, pollination of crops, timber production, coastal protection, and marine fisheries. And Steve already presented this, but I just want to put a shout out again to a lot of this has been made possible by the open source software provided by the Natural Capital project. And that is what enables calculations like this to be able to be computed, not just at all, but at very, very large spatial scales. And so the emphasis that I would say here is this sort of calculation, that's for 1 pixel of interest. You need to think about the hydrological routing conditions of how does water in that upslope transport area flow downhill through a pixel of interest and then continue to flow through gullies and other transport across the land all the way to a stream. But you need to do that for each pixel in your area of interest. And so that means using 30-meter resolution digital elevation model results for the whole globe. And so we're talking in the tens of billions of pixels here. And so that's been computationally challenging, I guess. And it's only been very recently that we've been even able to do this. NatCap started off as a very project-by-project, small watershed-based analysis. But now in 2019 in Science, we put out a paper that was sort of our coming out paper of, hey, look, we can do this globally now. And we've had a variety of papers since that have expanded the set of ecosystem services that we can compute at this scale. And so just for pretty map's sake, carbon storage, marine fisheries, coastal protection was a little different because we're breaking the world down into segments of the coastline instead of grid cells, water yield, and wild pollination. You might look at these maps and say, I don't see anything. It's such a high-resolution map, and so we always have to zoom in to see anything of interest. And so here on the left, we have the land use land cover map, which is that primary input from the previous step, and it looks roughly the same, the top and the bottom on the left-hand panel, but when you zoom in, you can see where the provision of pollination services actually happens is actually pretty different, and this just highlights the need to have this high degree of spatial resolution because you'd miss a lot of this at coarser resolutions. The final step in this modeling approach, once you've got your changes in ecosystem services, how do you go to the economic valuation? Traditionally, this has been done by all sorts of contingent valuation, revealed preferences, hedonics. There's a whole very large literature in this area, but we're kind of going to go in a different way. Instead of taking a dollar value or a monetary measure of each unit of provision of ecosystem services, we're going to instead express it as a shock to the macroeconomic model. And so no longer are we saying this is the dollar value of each unit of pollination. This is basically taking what Steve said about using the imputed value, but having a very detailed model, in this case a CGE, to calculate how could we impute that model. So the thing that we actually get from the ecosystem service model is something, all we need is something that is a change in the yield parameter that goes into that production function for the different pollinator-dependent crops. And so I'll go quick for this because we're getting short on time, but there's a lot of spatial heterogeneity here. We calculate where does the sufficiency of pollination fall below a critical threshold, where the scientific literature starts to show there are indeed yield effects. And then ultimately we get this as a gridded estimate of yield changes, which we then need to upscale to be to represent the total, or the average in this case, change within that particular AEZ for that particular crop that we're looking at, calculate what is the shock to the production function from this change in pollination. Once we scale that up, then the rest of it becomes much more straightforward CGE economic analysis. We express it as a shock and solve for equilibrium again that second time. And comparing that equilibrium to the first one without the ecosystem service degradation gets us at an imputed value of the ecosystem service itself. Because I've been going so slow, I want to jump straight to results and say a few of our key findings. Number one, nature matters. But more than mattering, it matters especially for low-income countries. And so what we found is that when we run our model and calculate GDP or equivalent variation, we see significant reductions in that GDP when we do account for ecosystem services compared to when we take the false belief that no ecosystem services matter to the economy. What we also found, though, is that impacts were much greater among low-income countries. And this, in a certain sense, isn't too surprising. We've seen in the literature lots of cases where lower-income countries tend to rely more on both nature but also common goods. And so the modeling that says, well, how does that value into GDP? Well, it's not too surprising. That would say it does matter more in those locations. Although I will just take the moment to say that's a welcome finding, because much of the history of global conservation policy has very much been at odds with local populations. It has not gone over well with people saying, you can't do any agricultural on your land. That would be considered quite the strong statement. And a lot of the proposed environmental policies thereby have had negative impacts on low-income countries. Here, when expressing it in terms of ecosystem services, we sort of have the fortunate finding it the other way around. These policies that are good tend to be best for low-income countries. Side note, and this comes back to what's the underestimate of the infinite value of nature. These are extremely, extremely conservative estimates, and why? Is because, number one, we're only capturing the ecosystem services that we can actually compute globally, and there's tons that we can't, and probably the more valuable ones tend to be the ones that we can't compute. But moreover, we're only considering those ecosystem services for which we can make a linkage between the change in ecosystem service provision and the endogenously calculated effect in the economy. Besides just finding that nature matters, though, we also tried to establish what might policies do and who would they be best for. And so we analyzed 4 policies. The first was repurposing agricultural subsidies as revenue-neutral transfers, or investments in ag R&D, so I was glad to have our plenary talk on that. Or 2 different forms of payments for ecosystem services, where in the first one, the global community is responsible for funding it, and in the second one, the nation itself is responsible for funding it. And not surprisingly, we find the combination of these policies was the best, but this also hits on that really important point, I think, is that where to go? Oops, I missed that point entirely. Is that these policies that we implemented all had the greatest benefit in those low-income countries. So these 2 complementary results are here, is that the nature is especially valuable to those low-income countries, and thereby, if you have policies that are built based on that recognition, you can find policies that will have the greatest benefit in those same countries. So some concluding thoughts and comments. I use this phrase, Earth economy modeling. And why did I use that phrase? Well, I think we're at a threshold in the integrated ecosystem economy modeling space. We've seen increasing computational power with greatly improved data sets from things like satellites, remote sensing. I would also credit the increasing emphasis on open source science. That has been critical to enable the level of cooperation that we need. And I think this leads to a new type of modeling. Within our particular research lab at the University of Minnesota, we've been referring to this as Earth economy modeling to represent the fact that we are trying to close that loop, to not just have the economy maybe loosely connected to the biosphere, but deeply intertwined. And so what is Earth economy modeling, at least in the way that we talk about it? It really is bringing back the general to general equilibrium and making it more general. And so it's a global model that combines what you'd expect, a global economy-wide model, but with global ecosystem-wide models. These are aspirational, of course, we leave out lots of important things, but that's the aim. An important part, though, is that we're going to represent the world, the state variable, if you will, as a very high-resolution depiction of the Earth. And so that's where, methodologically, it differs much from other approaches that have previously linked the economy and the biosphere. But we have to do this all while being detailed enough for specific policy analysis. And so that's the aspirational goal. There's a ton of models out here. The colors are washed out on the screen, but you can see basically this is a trade-off between building models with more economic complexity on the vertical axis versus spatial resolution or biophysical detail on the vertical axis, and there's all sorts of different entrants into this space, and so we've reviewed quite a few of those. But I would contend it's possible to push the frontier, again the frontier, to the upper right and leverage advances in open source software and computing power to create models that have increases in both. And so to end with, who are the new partners to push this frontier, to make those models? Well, central banks, first off, here we are. That's great. Other ones is the financial sector and investors. We're just about to publish an asset management perspective piece with the Norwegian Sovereign Wealth Fund, which says, how does changes in Earth economy results affect our investment decisions? Others, we have a new grant at the University of Minnesota called AI Climate, which is an NF-supported center to basically say, how could we use AI to push that modeling frontier through things like model emulation or better machine learning algorithms. I also want to give a shout out here to GlassNet. This is another NSF grant that funded the global to local analysis of systems sustainability. This is kind of a new discipline, and it intensely involves crossing spatial scales in a systematic and replicable way. But the last one I'll end with, this one also has a question mark, which I should have deleted, but I'm glad I didn't, is NatCap Teams. Teams is the Earth Economy Modelers. And so this is very preliminary, but we're thinking of launching a new consortium. There's a lot of demand, and we are having a hard time keeping up with the demand for this type of modeling. And so what if we organized ourselves into something that was dedicated to mainstreaming the use of this type of Earth economy model for all these different types of partners interested in doing it? So with that, thank you so much, and thank you for inviting me.
Thank you, Professor Johnson. So discussing this paper, we will have online Andrew Platinga. Andrew Platinga is Professor of Resource Economics and Land Use Economics at the UC Santa Barbara Brent School of Environmental Science and Management. His research focuses on the economics of land use, climate change, and forests.
Okay, can everyone hear me?
Yes, I can hear you perfectly.
Okay, great. So I want to first of all just say thanks to the organizers for inviting me. I wish I could have been here in person, but this will have to do. I'm going to give some comments focusing particularly on the paper which I read, Investing in Nature Can Improve Equity and Economic Returns. And so I want to start with just a summary of what I got out of the paper. First of all, as we heard about, this is a very impressive global analysis of investments in ecosystem services that combined a global trade model together with the kind of spatially specific granular invest model. It looked at a number of scenarios, including removing agricultural subsidies and redirecting those funds in various ways, payments for ecosystem services programs, and then combining some of these policies. The new services that make it into the model now are crop pollination, timber from forests, food from marine fisheries, and carbon sequestration. And so the key results that come out of this is, first of all, a finding that including ecosystem services lowers baseline GDP, especially in low-income countries. So if you kind of just leave ecosystem services out of your model, you're really missing something, because when you just include them under BAU conditions, the global GDP will go down. Fortunately, all 5 policies offset this. So all 5 policies raise global GDP relative to that baseline with gross effects in the range of 100 to 200 billion. The biggest effect coming from this policy that redirects ag subsidies into R&D for agriculture, but the combined policy has the largest net benefit when carbon is included, and that's at 325 billion. Okay, so that's a quick summary of the paper. I want to start at like a really high level, kind of the 30,000-foot view, and ask sort of what's the main point, not to like suggest there isn't a point, really what I want to say is I think that different audiences will get different things out of this paper. If this paper was published in a general science journal, PNAS, and I think a general audience will get the following message, the following takeaway, which I'll just quote from the paper. We show that investments in nature result in large improvements relative to a business as usual path. I think an economics audience is going to get a slightly different message. I think that we already know the direction of the effect. If you've got a bunch of goods that are not being priced, and then you price them, it's got to basically make, unless you do that in a really inefficient way, it's got to make things better off relative to not pricing them. And so that effect should be positive, but we don't know what the magnitude of it will be in terms of GDP and welfare changes. And so I think that's what we're really interested in as economists. And then I think the policy audience is going to ask, what's really in it for us? What are the gains or losses to a given jurisdiction, such as a country, if they support this sort of coordinated global investment policy to increase ecosystem services around the world? And so I'm going to come back particularly to these 2 points that I mentioned here, the magnitudes and also the policy policy questions. Before I do that, though, I want to just, for a moment, just sort of highlight just what an incredible achievement this paper is. And you already know that from listening to Steve and to Justin, but I think it's interesting if we, as I was preparing these remarks, I went back and looked at a paper that was published just 15 years ago, also in PNAS, and these authors were simply trying to map ecosystem services at a global scale. Just map them, not do anything else with them. And they concluded that using available data of global extent, we find only 4 ecosystem services for which we could map proxies at a global scale. And even those data are imperfect. And so just 15 years later, we're not only mapping a whole bunch of these services, we're also endogenizing them in a global trade model. So really amazing, like the advances that we've been able to achieve thanks to the great work of Justin and Steve to get us to the point where we are. I think, makes lots of advances on a number of different margins, and I'll just leave it at that to talk about other things. Justin actually went over this example. I was going to highlight sort of how pollination services get brought into the model, but I think we heard something about that already, so I'll skip over that. And I'll get to the question about magnitudes, which I think is what economists would be most interested in. And if I have one sort of bone to pick with the paper, I think it's that they kind of oversell the magnitudes. And so my point is this, that under BAU, we find that if you include ecosystem services, GDP in 2030 goes down by about $75 billion. So that's the model with ecosystem services compared to the model without ecosystem services. BAU goes down by this amount. The policies produce net gains in the on the order of $100 to $200 billion per year. And in various places, these changes are referred to as large. So for example, we find that policies that increase investment in nature can generate large increases in GDP relative to BAU. Like, to me, $100 billion is an awful lot of money, but I think the right comparison here really should be to global GDP, not to like my own wealth. And so currently global GDP is about $100 trillion. So these changes are really small, right? Compared to that benchmark, they're 0.1 to 0.2% of a change. And so I'm not at all suggesting like ecosystem services don't matter or we shouldn't be trying to model them. I think we should, but I don't think like the evidence from that particular exercise leads me to be convinced that these are really huge differences. I expect as the work progresses and more services are brought into the model, that will very, very likely change. Okay. I was a little bit, so one of the things the model can do is to measure GDP, but also to measure welfare and specifically equivalent variation. And if I'm reading it right, it seems like those measures really are different in this framework. And so here, the graph on the right, which we saw before, is a percentage change, again, in that baseline from including ecosystem services, here, though, measured as equivalent variation. And so we get about an 8% decline globally in equivalent variation when you include ecosystem services in the BAU. So if I'm doing the math right, that's an 8% change, which is about 2 orders of magnitude larger than the GDP change. And I'm just wondering, like, why is it that those two different measures, which I realize they're different things, but I was really surprised to see that they diverged so much. So that was one of the questions I had. I also had a question about fisheries. I recently wrote a paper about global fisheries, and where we're asking some of the same kinds of questions and assembled probably a lot of the same data. They have in their baseline really, fishery is declining around the world, and I was curious about what was really driving that trend. If you look at recent data, for the last several decades, you see actually that the harvests from global fisheries have been pretty stable for a number of decades, and if you include aquaculture, they're going up over time. U.S. fisheries have been relatively stable, and that's where we see some of the really big declines in the GTAP Invest version. So it just caught my eye that this seems something that kind of went against what I would have expected. Okay. I want to then conclude with just some comments on future work. Of course, there's always other things you can add to any other model. I'm sure the authors have their own list of things. We heard about some of them, additional services. Climate's an obvious one, like could climate be endogenous in this model too? That seems like a logical next place to go. I also wondered a bit about property rights. When we think about ecosystem services from land, we should really think about, what are are there good property rights? Are there secure property rights, well-defined property rights? And the fact is that around the world, there's a lot of cases where that isn't true. And if you then provide incentives for increasing ecosystem services, that's going to work if you've got good property rights. And I'm not sure that, I think that GTAP assumes sort of perfect property rights, if I'm not mistaken, but that's not really the reality. And so that might be a margin. I think that's particularly important given the focus on land-based ecosystem services. Another question I had is, what's the return on investment? So we see that if you take a bunch of money from one part of the economy and you kind of move it somewhere else and you put it into ecosystem services, you get these gains in GDP. But is there any sort of return on investment measure so we could have a sense of, well, was that the best thing you could have done with that money, or could you have done something else maybe that had a bigger return? I wasn't sure if that's something that could be brought into this framework. And then finally, I want to talk a little bit about the nature of the policies. So by and large, what the analysis looked at were coordinated global policies. So for example, global payments for ecosystem services. And this is, I'm channeling here my colleague Gary Leibkap. He would have said this: if coordinated policies produce net gains, why isn't it being done, right? So in other words, what's the obstacle to their adoption? Is it that actually countries don't really care about equivalent variation, or are there huge transactions costs that stand in the way of adoption? I think another way to put it is, what features in your model are not in your model that maybe should be, that would explain kind of the lack of adoption, right? So maybe you do need costs in there of various kinds that in order to more realistically represent these policies. I think if we move to the unilateral policies, some really interesting questions that we could be asking. If we look around the world, there are payments for ecosystem services programs already. Okay, so like this article by Salzman and all, many of you probably know, documents, you know, a lot of money going into PES already. So I was curious to understand if your model could explain that. So why is it that some countries are already acting unilaterally? And I think a model that integrates ecosystem services with trade and the global economy is really a powerful tool for answering those kinds of questions about sort of that, these sort of positive questions about who benefits really from investing in ecosystem services. And then I think a more normative question is, should countries pursue kind of unilateral policies? You know, should the country of Chile, for example, be investing in ecosystem services if they're the only ones doing it? And so I think that this model could be really useful to policymakers to try to sort of answer those kinds of critical questions. And with that, I'll stop. Thank you.
Thank you, Professor Plantinga. So now we have time for a few questions from the audience. Yes, over there.
Hi, well, first of all, thank you for a great presentation and all the effort you're putting with this project. I wonder, when you showed us the countries, that the poor countries were affected the most, I wonder if you could talk a little bit about the mechanisms behind that, because if you think all the policies were the ones you talked about were more like global policies that could be implemented, but knowing a little bit about the mechanisms in smaller regions could tell us a little bit about what are the local policies that could be implemented, which is also was kind of briefly just mentioned in the discussion of the paper. Yeah, that's my question. Thank you.
Okay, I have one question myself. Yes, so we talked about this during lunch a little bit, but I was wondering about the intertemporal aspect of the model. So you mentioned at a certain point that you had myopic expectations, and I was wondering how that influences the results that you're getting, because I believe that many of the effects may come through anticipation. This is also related to Luigi's presentation, for example, that if you foresee that there's a tipping point in some of the ecosystem services that you are evaluating, you may react beforehand and you may change your behavior. So I was wondering if you introduce this in a certain way in your modeling, and if not, how that would change your analysis. And yes.
Should I start in on answers? Great.
Yes.
Well, thank you so much for these excellent questions. Maybe I'll start with Andrew's discussant questions first. And I'll start with the big one about the magnitudes. Are those big numbers? And compared to my income, also 100 million is a big number, but I totally agree that relative to global GDP, this is a very small number. So you're right to pick out on that. Just some of the internal thinking that we had as a team is we got that criticism early and often, and actually maybe the history of it can even explain it more, is the first project that funded this was from the World Wildlife Fund, and they were setting out to answer the question of how valuable is all of nature to all of the economy. And that question has been asked before, and we get implausibly large and or small numbers depending on if we compare it to infinity or the current GDP. But either way, what was unique about this WWF study is they commissioned economists to ask, how would you answer this in a more defensible way than just adding up infinities or something like that? And so we thought this would be a good project. Our first numbers were too small. They were expecting the numbers to be closer to the Costanza types of numbers of 44 trillion or something like that, and those certainly are bigger. But what I would want to say is the reason ours are small, and we completely recognize that they are, and so I actually really like your point about the overselling. That's maybe the part that we could have changed the most. But just in terms of contextualizing these, it's that point again. We were looking at such a small subset of ecosystem services, intending to be conservative in our choices everywhere along the way, and I think we are systematically undervaluing it. But there's also deeper reasons, is we're only looking at things that we can observe behavior on the margin. A Costanza type of number is looking at a total value, and those are interesting and certainly bigger numbers, but we're limiting to where do we have evidence on elasticities and how markets respond. And so that automatically puts us in the lower numbers. So there's a lot more I could say on that. I think it's a very good point, and that probably is the single biggest thing I would have changed in the paper, just how we express that number. But in terms of the way I would express it in a positive sense is, we are finding that this is a way to start making progress on that type of calculation. And I think, as you point out, as we include more ecosystem services or strengthen our evidence base on what those linkages are, we will expect those numbers to get larger. But just the final point on the size question, when we were talking about this with the members of the GTAP community, they were saying, we got similar types of responses to some of our original work that was asking what would the total value be of total free trade implementation, so get rid of all the trade restrictions in the world. And that was only a little bit bigger than the numbers we found. And so I think this is also just reflecting the very conservative estimate of computable general equilibrium modeling overall. And so really, I would say the answer is a shout out to our previous discussions about what about tipping points? What about other things? So that was maybe more on that point than I should have gone into. Although still one last point is a slide I skipped. We did do one potentially interesting sensitivity analysis that instead of looking at marginal changes in ecosystem services as induced by endogenous land use change, we said, well, let's just try to say what would happen if we had ecosystem collapse. So forget about our endogenous land use change, just implement really big shocks. And so we looked at the Amazon converting, as is worried, from its forest state to a much drier state of shrublands, et cetera. We also looked at marine fisheries collapses and pollination collapse, all of which have been worried about. And there we not surprisingly found the bigger numbers. It was 2.7 trillion instead of the 75 billion. And so a lot of the smallness of the number simply comes from the fact that we were looking at pretty small changes around the margin, and we're really more interested in directionality. A few other questions that stood out, just a clarification on the equivalent variation, the welfare versus GDP. They were different, and it was by about a factor of 2. So I think some units got crossed there. But what it was that was causing this difference is equivalent variation accounts for the transfers between countries, for instance, and among many other things. It's a broader set of metrics. And so because we had a global payments for ecosystem services scheme, that was actually a large amount of money being transferred from rich countries to poor countries, and that does show up in equivalent variation, but doesn't show up in GDP. You're not producing that transfer. There's more to that, but we sort of had an internal debate, and we kind of wanted to talk about it in both terms. More people understand GDP, it's a splashier figure, but equivalent variation we thought was the better metric in terms of being robust. There's a lot more there, but we only have 3 minutes left, so I'll just mention a few other. One more one is on fisheries. It's a very good point. There, a lot of the results were driven by the model results from previously calculated model intercomparison projects. So we relied on FishMIP. We've actually been fortunate enough with this most recent engagement with the World Bank. We've employed William Chung over at UCSB and to use his advanced fishing models. And so I think we'll have a lot more insight on that point. So I'd stay tuned on that one. But for the time being, our effects were mostly driven by how does climate change cause fish populations to move? And in some cases, it was positive because it caused large populations to migrate into new areas that were then subsequently fished. To the audience questions then, so what are the mechanisms behind why our policies and also the impact of nature overall mattered most for low-income countries? I think there's a variety of different pathways. The one I thought was the clearest was for pollination. Number one, they produced, at least as a percentage of their agricultural product, things that were dependent on pollination more. Moreover, they had a very heterogeneous landscape where there was a high mixing of wild pollinator habitat with pollination-dependent crops, and we're measuring that spatial heterogeneity. In the US, essentially you can't lose that much from pollination because we've already lost most of it. We have huge tracts. Okay, that's not quite true from natural habitat. Still lots of dollars are put in towards adding hedgerows or even artificial sources. But what we were looking at was a reduction in wild pollinator habitat, and that is just much more tightly intermingled with the pollinator-dependent crops in the lower-income countries. So that's just one example. I think it's indicative of a broader thing, though, is that low-income countries are more reliant on nature, so that the pollination would be one example, but also just on common and public resources. So that would be another mechanism, is these policies were aimed at protecting things that were largely common goods. And so where those countries rely more on common goods, these policies would be more effective. So I think that's kind of a general take on the mechanisms. I think more work on specific pathways is definitely needed. And then the final question on the intertemporal aspect of this. Indeed, the CGE that we used assumes myopic agents, and sort of the short answer is we come from the CGE world where they have lots of sectors but simplified representations of time, and so that's mostly there just so that we can have those lots of sectors and still be able to solve it. But as soon as this report came out, the first one, we did start engaging with people who were interested in those questions because they're very important. Tipping point ones are all fundamentally time-based, and so that's why I spent a good portion of my slides adding new content that wasn't in the paper on our switch over to recursive dynamic. That's still not fully forward-looking, and so I think there's yet another step to go there. But what I would say is this is a blank slate, a research agenda that has a lot of potential areas to make progress. We sort of handled the cross-sectional sectoral one with the most detail because we were really interested in who are the winners and losers. But I think additional analyses could get at that question of what happens when you have different expectation formation processes and non-myopic agents. So a very great point. But thank you.
Thank you very much. So please join me in thanking our great presenters for this session.
Thank you, Sophia, and thank you to the presenters and discussants in session 2. We'll take a break now, and a 10-minute break, and resume at 5:20.
hace 2 días que vengo tomando pero no creo que voy a andar bien. Pero si me quedo sin voz, haré.
Yo creo que voy a hacer unos rounds.
Todo hablado, ¿no? Che, felicitaciones, excelente el programa, ¿eh? Muy bueno, muy bueno. Los papers excelentes. A guión que personaje. Sí. Yo creo que el tipo cada vez que da una charla tiene que quedar, pero sabe.
Hello. All right. We are heading into the final session of today. We have a wonderful panel titled Central Banks and Macroeconomic Impacts of Climate Change and Ecosystem Degradation. My name is Elias Albagli. I'm the director of the Monetary Policy Division at the Central Bank of Chile. And I am very honored to share the stage with these distinguished speakers. I will introduce them in the order that they will be speaking. And the format will be the following. I will ask each of the speakers different sets of questions related to their areas of expertise, and then also a common question regarding the role of central banks. And then each will have roughly 20 minutes to discuss the questions that were asked. Please feel free to select, pick and choose. Think more as a broad range of questions that you can choose from as you please. Great. So let me start with Marshall. Marshall Berg is the Associate Professor of Global Environmental Policy in the Doerr School of Sustainability and Deputy Director at the Center on Food Security and the Environment, both at Stanford University. He's also a research fellow at the NBR. His research focuses on social and economic impacts of environmental change and on measuring and understanding economic livelihoods across the developing world. His work regularly appears in both economic and scientific journals, including Nature, Science, the QJE, and the Lancet, among others. He holds a PhD in agricultural and resource economics from UC Berkeley. He's also co-founder of Atlas AI, a startup using satellite and machine learning to measure livelihoods. Our second speaker is Douglas Arendt. Doug is the Executive Director of Strategic Public-Private Partnerships at the National Renewable Energy Lab, as well as a Senior Associate with the CSIS Energy Security and Climate Change Program. Previously, he was the Director of the Joint Institute for Strategic Energy Analysis, also at NREL. He has a PhD from Princeton University and an MBA from Regis University. He specializes in strategic planning and financial analysis, clean energy technologies, energy and water issues, and international and governmental policies. And our third speaker will be Eduardo Cavallo, who is an economist from the International Development Bank in Washington. He holds a PhD in public policy from Harvard, and his research focuses on international finance and macroeconomics with an emphasis on Latin America. He has also worked on the Center for International Development at the Federal Reserve in Atlanta and at the John Kennedy School of Government, among others. Great, so let's get down to business. I'll start with Marshall. Many countries worldwide are already facing dire physical impacts associated with climate change. And as we've heard here today, we expect this to intensify in the near future. Given your broad expertise on the physical impacts of climate change, I would like to ask your perspective on a couple of issues. First, what do you think are the main threats that climate change and environmental degradation poses around the world in the short, medium, and long run? So here I'm thinking about the expertise on estimating and understanding damage functions. So what do you see are the main channels through which climate change or other environmental stressor will hurt our economies? And how do you think will be the regional distribution of these effects? Second, what are the channels through which climate change and the loss of ecosystem services will affect relevant macroeconomic variables, such as the one that central banks usually follow: inflationary pressures, investment, interest rates, long-term growth, etc. And what do you expect the macroeconomic consequences of climate change and environmental degradation to be on these variables? Then the common question that I'll ask for all of you, and please only answer if you have time in the end, but I would be very interested, I think all of us will be very interested in hear your thoughts on this. What do you think is the role that central banks can play to contribute to speeding up the transition and to get a better understanding of both the physical and the transition impacts of climate change and environmental degradation? So please, Marshall.
Great. Thanks a lot, Elias. It's great to be here. Thanks again to the Central Bank for hosting this great event. I've already learned a lot. So I am not a central banker. So I'm going to have you answer that question, and folks in the audience answer that question. What I'm able to do and what I study is the impacts of physical risk on a range of socioeconomic outcomes that we care about. And actually don't actually like the term physical risk because I think it doesn't really focus us on what's happening. These are not just physical risks, they are economic risks and social risks, and decades of work have now really demonstrated how deep the risks of a changing climate and a changing environment go for a range of socioeconomic outcomes that we care about. So I think we shouldn't even call them physical risks, I think we should call them economic and social risks just to really bring that home. So what are those risks? We'll hear more about this tomorrow, and I will not use my full 20 minutes today because I have the mic for a little bit tomorrow as well to go through some of my own research. So let me just give a broad overview now, and you'll hear from multiple speakers on this tomorrow. So let me divide the risks into two broad categories. One are, let's call them the TV risks. These are the charismatic, the iconic risks that we see on TV when a TV commentator wants to talk about climate change. These are floods, these are hurricanes, they are increasingly wildfires, both where I live in California, and increasingly here in Chile, I gather. Wildfire activity has accelerated dramatically. And these are charismatic, you can take pictures of them, and they're also important. They cause large impacts. It's important to note that these things exist without climate change, of course. They've been happening for as long as we know of. Climate change is a thumb on the scale of these physical risks, making them more likely and more intense. And these charismatic risks, so again, hurricanes, floods, wildfires, are certainly an important part of the puzzle. And their direct impacts are often what people think about when we think about climate damages or climate risks. But they are actually not what worry me the most. I think what worries me the most is the stuff that's less obvious, the stuff that's harder to put on TV. And these are often, there's some direct losses, but often the indirect lower intensity but much more widespread losses that we get when we get climate change or environmental change. Today, or right now, I'll really focus on the climate part of this. So if you think about extreme heat and what we've learned about extreme heat, and this doesn't even have to be an insane heat wave, even mildly warmer temperatures, we're understanding a lot more about what that does to a range of outcomes that we care about. Agricultural productivity is probably the best studied. We know that agricultural productivity of most crops that we care about declines when it gets hotter and declines substantially the hotter it gets. Mortality, similarly, we see mortality increase, not just at extremely hot temperatures, but at mildly hot temperatures. Morbidity, too, more people show up at the hospital, even if they don't die, on reasonably hot days. And so I think we've understand those sort of broad categories for a while now. Just in the last 5 years, I would say we are learning more about categories where we didn't necessarily expect there to be impacts. So one is very large impacts on labor productivity. So we see both in experimental studies, and this is one setting where you can actually run experiments. We can put people in hot rooms. We can have them do a task. It can be a menial task, sorting things into boxes. It can be a computational task on the computer. Across all of those tasks, if you turn up the heat in the room, people are less productive at those tasks. And not only is their labor less productive, they are cognitively less sharp. And again, you can see this in experiments when you crank up the temperature. You can also see it in test scores. So if you look at kids who take a test on a hot day versus a not hot day, the hot day test takers do substantially worse on the test, right? And so this now is important when we think about broader economic aggregates. If we think cognition is important in the creation of ideas, this could be one channel through which warming temperatures might affect the creation of ideas and thus potentially longer-term growth. And I'll talk more about that in a second. So these sort of smaller, more insidious effects of even mildly warmer temperatures, they affect so many of us, right? So it's not just a flood hits one county or a hurricane hits one state. These are very, very widely shared and shared globally in a way that really amplifies impact. One thing I didn't mention is sea level rise. So a thing you often see on TV or in media coverage of climate change is sea level rise. Sea level rise will be important, but as an economic impact, it's very unlikely to be substantially important relative to these other threats, at least for the next century or two. So we talk a lot about sea level rise. I have a lot of climate science colleagues who spend their entire career thinking about sea level rise. To me, this is not a first-order impact that we should be worried about in most parts of the world for the next century or two. Now there are some low-lying areas where obviously that's not the case, where sea level rise is existential, so this is not a blanket statement around the world, but for most places in the world, sea level rise is not going to be the most important threat. Okay, so it's these insidious indirect effects, which I think research is increasingly showing is likely the dominant economic impacts of a warming climate. And I hope we are attentive to these. So let me then pivot, and I will, as I said, finish quickly and hopefully leave time for more discussion, and try to answer your second question on macroeconomic implications. And let me focus on 4 areas where I think we have parts of a story or sort of emerging evidence, but I think where we need likely a lot more work. So first is inflation, interest rates, asset markets, and then finally growth. And I'll talk more about growth. I'll bore you with some empirical research on growth tomorrow, so I won't spend much time on that today. So on inflation, my best read of the evidence is our biggest worry is on food. So again, there's a very tight link between a warming climate and lower agricultural productivity. And as we get more and more correlated climate shocks where you get droughts or heat waves and bread baskets at the same time around the world, which we have seen in recent years, you're likely to see declining productivity and increasing prices. And again, we've witnessed this in the last decade. Again, these correlated shocks across important global bread baskets. So I think on the inflation side, again, the main worry is going to be on food prices. I think overall we should expect the level to go up and the volatility to increase. I think that's where the signal is strongest. I think for other commodities, we have less evidence, and science right now has less to say on prices or on inflation worries. So that was quickly on inflation. Number two, on interest rates. So again, emerging area of work. I think science is starting to show that at multiple scales, lenders are starting to be more aware of these physical risks and are starting to, I would say, price them more aggressively. We see this at the firm level, and we're starting to see evidence, I think, at a more macro level, at a country level. There's a great paper in the last year by some researchers at the SF-Fed that looked at corporate borrowers following a hurricane, and they found that loan spreads or interest rates for corporate borrowers went up after hurricanes. You might think, okay, that's obvious. Hurricane comes in, destroys capital, firms are in bad shape. It's going to cost them more to borrow. What the researchers looked at was not only the firms that were affected, but nearby firms who were in the area of the hurricane but not actually exposed to the hurricane, right? Who didn't themselves suffer damage. And what they show, I think, pretty convincingly is lenders' awareness about the damage that hurricanes can cause had gone up, and that they were, in a sense, penalizing anyone who was in the area of a hurricane for that event. So again, firm level evidence that climate risk is now being priced into, in this case, loan spreads. We're seeing, I would say, emerging evidence of this at the country level. Again, both on hurricanes, and I have a student actually working on this, tropical cyclones, hurricanes. We call them hurricanes. Elsewhere in the world, they call them tropical cyclones or typhoons in the Pacific. Actually, don't know what you guys call them. Do you guys call them? Doesn't matter. Emerging evidence that you get hit by a large tropical cyclone, it can depress economic activity for years, and this can increase debt to GDP ratios, increase debt stress for countries, and potentially, again, raise interest rates, raise cost of borrowing on international capital markets. I would say, again, emerging evidence on that, but not fully established. My last two, so third on asset markets, and Ton Phan, the discussant, I think put it nicely. The jargon is repricing events. So what happens when an asset market, and here a lot of the focus has been on residential real estate markets. Again, much of the evidence in the US, at least that I know best. So I'll repeat Jim's apology. I'm an American, and so we talk about America all the time. It's embarrassing, but I'm going to do it. So what we've seen in residential markets in the US is that they actually are not that efficiently pricing climate information, but suddenly a hurricane will happen or new information will be revealed and prices can change pretty quickly. So they are not sort of slowly incorporating increasing flood risk into prices, but when given that information, again, they can adjust quickly. And so these repricing events could be, I think, a concern for price stability. Last one is on long-term growth. Again, I will talk about this tomorrow and show some evidence. I think multiple teams of researchers, including mine, has shown that various climatic events, warmer temperatures, hurricanes, can cause persistent impacts on aggregate output around the world. And this is not just in the tropics or in lower income countries. We see this in high income countries as well. So I think there is a substantial output risk, whether it's a level effect or a growth effect is something we can argue about tomorrow, but we see effects in the data. We see persistent effects on output of climate shocks, and that to me sounds like something a central bank might be interested in. So I'll hand it off.
Excellent. Thank you very much for that. I'm sure there will be lots of questions related to it. I have a couple of my own, but I'll wait for the end. Let me turn to Doug. Economies worldwide are accelerating the decarbonization process by implementing mitigation policies, such as carbon taxes and adoption of cleaner technologies. The impact of such transition is expected to be heterogeneous among industries and firms, with potential aggregate effects depending on the role that the targeted firms play in the economy. Given your broad expertise on energy, green technologies, I would like to ask you a couple of questions. First, what do you think are the best current available technologies to enhance the energy transition? What are the new technologies that are most promising to be developed, in other words? Second, could you elaborate a little bit on the just the magnitude of the investment needed in both mitigation, meaning the transformation of the energy matrix worldwide, but also adaptation to increasing physical damages from climate change? Do you see them as macroeconomic meaningful with potential impacts on, say, investment rates, interest rates? And third, what are the opportunities in terms of economic growth that the implementation of such technologies could produce? And particularly here, if you could refer to the heterogeneity in terms of which are the countries best positioned in this energy technological transition. And of course, if you have some time and you want to elaborate on the central bank question, please, welcome.
Okay, thank you very much. So it's really a pleasure to be here. Let me offer a couple other background perspectives of why I might be sitting here. One was I actually gave a talk to the Bank of International Settlements Green Swan policy dialogue earlier this year. That was one. The second one was I was actually a coordinating lead author of Working Group 2 on economic impacts of climate change during AR5. I've also worked in the energy economic ecosystem modeling world for about 25 years or so. So I might sparse in a few comments on modeling and where that might be able to go, particularly in that last session question. So let me go order by order. So I have 4 topics to run through, and I'm going to do them without the benefit of a set of slides, which is a good challenge and also a deep challenge to try to articulate what we know today about energy technologies and the energy transition, and frankly, what we don't know as well in terms of some of the challenges. So energy modeling today in the kind of energy transition world is very explicit, a little bit like the ecosystem services. It is spatially explicit, it is temporally explicit, and it is very data intensive. So we, for example, run a 44 petaflop supercomputer to do energy models, particularly of power systems. We have embedded deep power systems modeling into CGE models and embedded those then into integrated assessment models. And so we are able to actually dive down both spatially and temporally and raise that up either stylistically or otherwise into what I hope are meaningful macroeconomic tools that can be valuable for policymaking. I'd say one other piece on that front, which I think is really important, and it's kind of at the cusp of modeling, and it blends the understanding the impacts of ecosystem services, which today we're looking at historical changes and historical impacts of social and economic risks derived from maybe physical impacts. And we're actually able to now use deep artificial neural network models to actually look at forward climate model projections and downscale those both temporally and spatially so that we can look at future pixels under RCP scenarios, radiative concentrated pathway scenarios, climate change scenarios, and ensembles of those scenarios, because we can run those in literally minutes for the whole world, because they are super smart models and they've been trained very, very well. That has an incredible implication for, I'm going to come back at the last question. But to your point on then technologies. So I would say most folks are probably sitting in their seat thinking, he's going to say wind, he's going to say solar, he's going to say batteries, he's going to say electric vehicles. All great. Yes, those are individual technologies, but the core strategic thing that I would like you to take away is that the energy system is increasingly interconnected system of systems. And as we transition to a decarbonized energy system, whether or not that's here in Chile, South America, Latin America, or the world, it is a clean energy economy based upon a clean power backbone, clean power, and I don't use just renewables there, because it could include carbon capture and storage, which could go back to the natural gas story that was told earlier, that it wasn't exactly 100% of all the story in the United States, but close enough. But it's clean electrons increasingly used throughout the economy for mobility, holding a conference like this in a building, and then secondly, power to chemicals and fuels. So this is the important second part of the transition that has the real opportunity. And okay, so what does that translate to in your language? You hear a lot of hype about hydrogen. And there's even a hydrogen strategy here, there's one in India, et cetera. Okay, hydrogen is the use of clean power to a chemical. Hydrogen may not be the end chemical. It may be hydrogen combined with carbon to make methane, CH4, right? It might be hydrogen combined with nitrogen, which you can get out of the air, to make ammonia, which is the fundamental building block for agricultural fertilizers, et cetera. So that pathway of clean power for use in the economy directly or use through chemicals and fuels is increasingly interconnected. The other way to think about it from an economic perspective, it's increasingly codependency risk across sectors. And so that has two implications. First off, you have to think solution-wide for the economy. Secondly, you have to understand and build in resiliency. And this will come back to the third question where you've asked me about adaptation and mitigation together, and I'll come back to this point at that point in time. The third element of strategy is circularity. I had a conversation at lunch today, basically asking the question, what would be interesting to learn from an energy nerd sitting in a conference for a central bank? And it's really about understanding how will all this infrastructure build out, and frankly, what it would be the role of a central bank in supporting that. And the real point is that there are roadmaps, I use the term, and it's very broadly, to be able to get to this energy transition by putting in the appropriate electric vehicle charging infrastructure, building out industries of the future, which include recycling, repurposing, and reuse industries. And so the question at lunch was about, what about batteries? Aren't they just going to be dead bricks in 20 or 30 years? And the answer is no, because the scientists are already working on recycling, repurposing, et cetera. This is part of the destructive creativity that was talked about just after lunch, which is we must be investing in future industries which are compatible with a sustainable future. And so that's got implications there on the policy front. So let me go to the second question in terms of scale of investment. So roughly new investment in the energy sector last year was give or take $2 trillion, roughly. The International Energy Agency projects in order to get onto and stay on a net zero pathway, that investment must increase to about $4.5 trillion, $5 trillion per year globally. Many countries have their net zero roadmap. There's one produced for Chile. There's an action plan for decarbonization that we helped the Chilean ministry with. That's publicly available. I can send a link around to that, and many others. And so that's the scale of just the energy sector itself and the new investment in just energy. But I want to make another point which I think is not quite as appreciated as it should be, which is in most developed, fully electrified economies like here, the United States, Europe, many, many others, expenditure on energy is actually a very small part of GDP, 3.5%, 5%, maybe 7% or something like that. However, the full economy, 99.9% of that economy, including all of its macroeconomic stability, relies upon reliable, secure delivery of energy, a la Russia's energy war on Ukraine and Europe, et cetera. So I think again, from a central banking perspective, it perhaps is not well captured in the economic models what the full risk profile of disruptions to an energy supply chain mean, and therefore what it means to invest in resilient energy systems. And I would welcome conversation over cocktails and dinner about that one. The third piece that you asked me about was kind of implications. And there are two trends that I'll just mention here very quickly. The first is that there is the opportunity, and frankly, there's a policy orientation, shall I say, developed in the last 3 years predominantly, that the energy transition is an enabler for domestic energy security and domestic energy productivity in a way that it never was. It was believed under the globalization paradigm that free flow of energy and markets would allow economic productivity to take place globally at the opportunity of the ability to pay. And that's no longer the case a la the most recent war and frankly the reset of geopolitical tensions around, I'll call it strategic alliances and strategic allies. And thus there's also the perspective and the opportunity to rethink, particularly I'll call it domestic central banking policy, of how does one support the stability of a clean energy transition and a clean energy supply chain. And so that means, for example, up-leveling or upping the value add of minerals and extractives in every economy, particularly here with the intense minerals mining in the north, or utilizing natural resources within their socio-political acceptability. And I use that latter phrase very carefully because it may be that the bigger challenges to developing or transitioning to a clean energy economy are about the social inclusiveness processes and getting to yes, having people be part of that inclusive transition. So we can talk about energy just transitions and things like that if you'd like to as well. So that's one point. The second point that you asked about in terms of, I'll call it country positioning, is really that every country that I travel to, and I travel to more than 40 or 50 in a given year, are trying to position themselves to be the leader in the low-carbon green energy economy. And with a, if I may use an impolite term, a relatively naive approach toward the geopolitical and competition for clean energy-derived exports. And here I think of energy specifically. That is clean power to hydrogen that may go to methanol or ammonia or natural gas. Thinking about transferring clean derived fuels that are produced here, for example, and competing with any other country to supply Singapore or Taiwan or Japan. Every country that has a big endowment of clean energy resources is on the exact same strategy. And therefore, the real question is there any differentiation? And is there strategic differentiation in an export competitive market versus supporting your domestic economic productivity with less dependence upon exports on that front? And so the point there is really thinking quite deeply about energy interdependencies on all that. And so let me come to the last point, and I apologize, I'm pretty close to time. The role of central banks. I mentioned a couple of them. The first off is to recognize the interdependencies among sectors and particularly for energy and an economy. And then the second piece I believe is very critical, which is to understand that mitigation and adaptation are not two separate sectors. They're not two separate strategies. They must be built together into a resiliency policy, which means that the bank should be considering deeply what is the policy for lending for resilient infrastructure Resilient infrastructure means adjusting for pricing risk, physical, social, economic risk, and therefore pricing resiliency. That's a policy question for a central bank, I believe, but you guys, you can answer that one. The second one, I believe, is really, really important, and you've heard different, slightly different perspectives on different modeling capabilities today. There's the macroeconomic modeling, there's the social economic risk modeling, there's the ecosystem services modeling. We've got very, very deep energy system modeling, energy connected to water, food, and infrastructure, as well as future climate. I believe that there's a very important role for central banks to step up and ask and support the modeling community to come together to help improve the modeling fidelity that can help with policy making at the central banking level, as well as many other banking and financial decisions as well. So I'll stop there and welcome questions.
Thanks so much, Doug, for those insightful comments. Let me turn to Eduardo. We've heard from Marshall about physical impacts. Actually, you use a different term, but socioeconomic impact was it?
Perfect.
Of environmental degradation, and Doug told us about energy technologies or building resilience, will be more appropriate, that are key to achieve the green transition successfully. Given your broad expertise on the economic impact of natural disasters and being part of a multilateral institution, such as the Inter-American Development Bank, I would like to ask you thoughts on the following issues. First, do you expect to see any significant impacts from global warming and the more frequent and intense extreme weather events on the trend of GDP on specific industries and economic sectors, in particular in Latin America? And do you expect to see this, or do you see this issue as a rather long-term problem, say end of the century, as we've seen in many of the graphs and the modeling that we've seen today, or is it more of a short, medium-term problem, say the next 10 years? So that's one question. Second, do you expect the changes in public policy in Latin American countries consistent with the climate transition to have positive or negative effects on key macroeconomic variables with respect to the current levels? And in particular, what do you see as the main challenges to overcome in order to make these changes politically feasible in the short term? What's your view also about the transfer mechanisms between advanced and emerging market economies to accelerate the green transition in the latter? I know there's a lot of questions, but again, you can choose, pick and choose the ones you.
Thank you, Elias. I begin by apologizing. My voice is taken today, so I'll try to make it through the 20 minutes, but bear with me. First and foremost, thank you very much to the Central Bank of Chile for organizing this fantastic conference, not only in terms of the quality of the discussions and the presentations, also in all the informal, we've all talked about the interesting lunch conversations we had and so on. So thank you for the Central Bank for doing this. It's really very interesting. And I thank you for including me in this panel. So I am from Latin America. You can probably tell by my accent, so I'll try to make up for the American perspective so far. So I'll introduce some examples and some issues idiosyncratic to Latin America and the Caribbean. And let me start by saying that when it comes to climate change, few regions in the world are as critical to our shared global future as Latin America and the Caribbean. So let me give you two examples. One is the Amazon rainforest. It spreads across 8 countries and captures about a fourth of all of the carbon dioxide absorbed by the entire planet, helping to mitigate climate change for the whole world. The second issue the second example I want to introduce has already been mentioned, the issue of food security. So Latin America is a leading world exporter of food. We produce enough food to feed about 1.3 billion people in the world. I mean, and if the right reforms are implemented, that number could go up. So, when it comes to climate change, these examples show that we have a role to play. We have a dimension in which it's very important that Latin America becomes a strong player. For example, if we don't protect the Amazon, we will severely reduce the capacity as a whole to meet Paris climate targets and limit warming if we don't tackle climate change, with the increased incidence of disasters, extreme weather events, loss of biodiversity, loss of agricultural productivity, the issue of food security, which I gave as an example, would come to the fore. So Latin America has a role to play here. Let me step back 1 second and talk about the global challenge first. We don't need to motivate this very much in this audience, but it's clear that global temperatures have been on a consistent rise since the early 20th century. So scientists compute this global temperature anomaly, which is basically the difference between the annual mean temperature and the average temperature over the last century. That has been on an upward trajectory, which has accelerated after the mid-70s. And today, we are about 1 degree Celsius. We are already about 1 degree Celsius above the century's average. To come sort of closer to the most recent period, if you take the period between 2015 and 2022, 7 of those years have been the hottest years in recorded history. And this year, again, in 2023, we have already set another record. So, among the so-called natural disasters, which is an area, as Elias was mentioning, in which I have done some research, some of those so-called natural disasters are directly influenced by climate change, while others are not. So, meteorological events, for example, that encompass things like extreme temperatures and storm have seen a 7-fold increase in incidence since the 1970s. Hydrological episodes like landslides and floods have multiplied 6 times since the 1970s. And climatological disasters like wildfires and droughts have also increased by a factor of 6. Some skeptical people say, well, that may just be better recording, no? Well, there are natural disasters that are completely unrelated to climate change. For example, earthquakes, which unfortunately here in Chile you also have experience with. Well, the incidence of those hasn't changed much over time. So it cannot just be just better recording. There's clearly a link over there. Unfortunately, things are likely to get worse before they get better. Elias was mentioning in one of the questions he made earlier today about these shared socioeconomic pathways, which are a set of narratives and quantitative projections developed by a broad collaboration of researchers or as part of the climate change research community that describe different future socioeconomic developments and their implications for climate change mitigation and adaptation. All these narratives differ in terms of the projected population growth, the economic development, technological progress, environmental protection, globalization, among other factors. Now, there are 5 main SSP, shared socioeconomic pathway scenarios or narratives. Only one of them is compatible with the Paris Agreement goals. That's the sustainability scenario. And, under all of the SSP scenarios except scenario 1, which is the one compatible with the Paris Agreement goals, the projected global annual anomalies will continue to rise over time. So that's why I'm saying that things are likely to become worse before they get better. What this suggests to us is that urgent action under the Paris Agreement is needed to avoid the worst effects of climate change. As you all know, the Paris Agreement relies on the so-called national determined contributions, NDCs, as the main vehicle for driving climate action and increasing global ambition over time. Effectively implemented NDCs, therefore, are critical to achieving the agreement's goal. But on this front, we don't have very good news either, because according to the UN's emission gap report, total global greenhouse gas emissions in 2030 are estimated to be around 58 gigatons of carbon equivalent based on the implementation of the current NDCs. This level of emissions is about twice what is needed for the Paris Agreement goals. So there is a large emission gap between where emissions are heading with the current NDCs and where they need to be. So achieving the Paris goals will likely require most countries, including countries in Latin America, to update their NDCs with more ambitious targets and implement policies in that direction. Now, what does this all mean for Latin America and the Caribbean? Let me start by saying that Latin America and the Caribbean is unique on a set of dimensions. It's the region with the highest level of urbanization in the world, or at least among the highest level of urbanization in the world. It's clearly a disaster-prone region. Think, for example, of the vulnerable, particularly the vulnerable countries, particularly, for example, in the Caribbean and the Central American region. It's also the region, as I said at the beginning, which is home to the Amazon and other biodiversity hotspots. It has a relatively clean electricity generating matrix compared to the rest of the world. That's because of the high incidence of hydro in the energy generation, and also solar and wind and so on. So we are starting from a relatively clean electricity generating matrix. But we are a major source of forest carbon emissions. The high rates of deforestation in the Amazon threaten to transform one of the largest global carbon sinks into one of the largest sources of emissions, with many areas in the Amazon already emitting more carbon than what they capture. So while Latin America is unique on many dimensions, Latin America and the Caribbean also faces some specific challenges. We have very high levels of poverty and inequality. Indigenous and Afro-descendants people are highly vulnerable to climate change. We have groups with vested interest in the status quo. Of course, while interest groups are not unique to Latin America, characteristics of the Latin American politics, and going here to address one of Elias' questions, characteristics of the Latin American politics tend to amplify their influence and make reform harder compared to other contexts. For example, regulatory capture and weak institutions in general in the region mean that environmental agencies here are less able to implement climate policies that are opposed by powerful business interests compared to agencies in advanced economies. So overcoming these challenges will require a lot of political will and tailored strategies. Among the challenges that we have as a region, we are a region of low growth. We have been growing very slowly for decades now, and we have very high fiscal vulnerabilities, so that makes the implementation of solutions challenging also from the fiscal standpoint. And of course, we have many competing and urgent development challenges. So it's challenging for the region, given the unique characteristics and also given the unique challenges that the region face. Let me discuss some recent estimates on the impact of climate change and disasters in Latin America and the Caribbean specifically to provide some examples in the region. So a very well-known study by Marshall here and co-authors, they'll probably present some stuff about that tomorrow, shows that the effect of rising temperatures differs for countries with different climates because economic growth rates respond non-linearly to rising temperatures. Well, at the IDB, we have done work extending the Burke et al. Paper in terms of the number of countries in the region that are included in the sample and also in terms of the period covered. The results, I was telling Marshall before, it's very similar to his, and the point I want to make here is that for all the countries that are included for all the Latin American countries that are included in the sample, except for Chile, all of the countries in the region are already located on the declining portion of the curve, meaning that higher temperatures from here on will result, according to these estimates, on lower GDP growth. And that's because we are a region of high average temperatures to begin with. Similarly, estimates show that total annual rainfall has a nonlinear effect on economic growth. So, for example, the increase in the number of wet days and extreme daily rainfall have negative effects on economic growth rates that can be quite persistent over time. There are also changes in the distribution of temperature that go beyond changes to the mean annual temperature. So climate change is expected to increase the mean and also increase the variance of the temperature distribution, leading to greater dispersion in the distribution. Together, these changes will substantially increase the number of days of extreme heat. And for the reasons that Marshall was commenting, this has negative effect it's likely to have negative effects on economic growth for exactly the reasons that he was mentioning. So climate change is also expected to increase the frequency and intensity of climate-related disasters. So at the IDB, we have studied the economic impact of storms. So again, I'm not going to enter into all of the details here, but one interesting thing that we find is that the estimated impact of the most severe storms, think of hurricanes, for example, is about a 2% decline on GDP per capita growth in Latin America. And this sort of headline figure is similar to the one that is found for the global sample. But one interesting feature is that while the severity of the negative impacts of these storms on economic growth generally diminishes as you include less intense storms in the global sample in the world, the same pattern is not true or is not observed in the sample of only Latin American and the Caribbean countries. In Latin America and the Caribbean, the negative impact of storms on economic growth are estimated to remain about the same across varying intensities of storms. So, if we think for a second about that, what this suggests is that in Latin America and the Caribbean, the frequency of occurrence of this type of events, and not just the intensity of the storms, matters for economic outcomes. And in the era of climate change, this is a worrisome development because both the intensity and frequency of storms are expected to increase, and therefore countries in the region could suffer even worse impacts than the rest of the world. Let me say just a couple of more things about the estimates. I'm cognizant of time. I think we're running low, so I'll end, and then we can come back with some things in the Q&A. But what explains the decline in GDP per capita growth that we observe in Latin America and the Caribbean? So we have studied this both from the demand side perspective and the supply side perspective. On the demand side, what we see is that there is usually a fall in consumption. This is important because consumption is tied to welfare, and a decline in exports in the aftermath of these types of events. This is partially offset by a rise in government spending. And an interesting result is that while consumption and export growth eventually revert back to the mean, government spending growth remains positive on average for several years after the storm. So this will have fiscal implications that I'm going to comment in a second, and I'm going to end with that. But before that, on the supply side, we find that the main negative impacts come from negative implications on TFP growth. So on average, the growth rates of capital per worker and labor force participation remain broadly unchanged in the aftermath of this type of disasters on average. But, TFP tends to fall. So this suggests that this time of extreme weather events have estimated negative economic impacts that come mainly through the misallocation of productive resources. The negative impacts of climate change that I have discussed in the region are exacerbated for poorer countries, and within countries for the poor and most vulnerable populations, because they are less prepared to deal with that. So let me stop here because I've already run over 20 minutes and leave some time for the discussion, and I'll come back to some of the other stuff I have prepared if there's time. I apologize for that.
Excellent, don't worry. So before taking the questions from the floor, I would like to ask each of the panelists one very quick question in reaction to the comments you made. And here I'm thinking about setting the stage for tomorrow's first session, which is about financial risks. And I like the distinction you made. I also don't like the way we call climate risks to everything, but for a different reason. My reason is that we call climate risks things that are actually in the baseline. And that the danger of that is that we don't think enough about what the actual risks are, that the things that are not in the baseline. So I would like to ask each of you, related to your comments, a question about what I see as true climate risks. So let me start with you, Marshall. You described trends, climate impacts that are more chronic in nature, perhaps. What is your view on this emerging literature on tipping points? In particular, I read a paper that came in, I think, in Nature, maybe a couple of months ago, that significantly brings forward the possible date of the slowdown or even collapse of the Atlantic Meridional Ocean circulation, which would be a huge tipping point, of course. So in your reading of the literature, are you worried about these tipping points?
I think we can distinguish maybe loosely two types of tipping points. One is the climatic, those tipping points in the climate system, which I think is maybe what you're referring to. The other that people have thought about is tipping points in social systems. So is there some climate threshold that you pass that tips a social system into a different equilibrium? My read of the literature is still that we don't have a good sense of exactly where those tipping points might be. From a risk and uncertainty perspective, they seem really important. And almost surely, the fact that there's a non-zero chance they exist means we should be more aggressive on mitigation, just from an uncertainty perspective. But my view, reading the literature, is on both the climate tipping points and the social tipping points, is the literature does not have much to say in a precise way on if and where those tipping points exist. They could exist, and we should take that seriously, though.
Thank you. Doug, I really enjoyed I thought very interesting the point of building resilience into the energy matrix. And as I was listening to you, I couldn't help remembering this book about Kim Stanley Robinson, The Ministry of the Future, which I'm probably you're familiar with, which starts chapter 1, I think, with a massive heat wave in India, I believe, and everybody turns on the AC at the same time, and the grid collapses, going back to your building resilience. So people have nowhere to run, and they go to the lakes and whatnot, but I think in the end, 20 million people die in one day. So that sets the stage for the rest of the book, which I strongly recommend. It's, it's quite a trip. Given that, in your words, you are an energy nerd that knows about these issues, what is your view on the actual probability of events like that occurring as heat waves become more frequent, in particular in humid countries?
Yeah, let me try to do a quick answer. So they already occur. Maybe not that exact one, but for example, I believe Brazil's power system was completely blacked out, or most of the country, for 9 hours in August, if I remember correctly. That was due to, 1, intense demand, and 2, lack of hydro resources. The hydro resources were from long-term drought. If that long-term drought is in your baseline, then I think we need to rethink what normalization of baselines is. That's one thing. The second thing is there are at least 2 good examples from the United States, actually, in cold weather climates, or the cold of a hot weather climate. So think Texas. The 2 big events there were actually cold weather related, because it both increased demand considerably, this is for heat, but also what happened eventually, when you look at the numbers, was it stopped the production and the delivery of natural gas in the power system, and so gas was unable to produce as the flexible resource there, which not very many people understood, the dependency on natural gas. So having fossil fuel in your system is not a guarantee, let's just put it that way. The third piece, and let me just lay out where there's a solution, which is that in that situation in India, if those air conditioners had been smart, i.e. controllable by the system operator, then one could think of flexibly managing them so they didn't all turn on at once, and the system could actually respond to the increased needs, or the increased need for coolness, not just for turning on an air conditioner, but for coolness, which our body has a temperature range to deal with, right? The air conditioner might be set at 18 Celsius, but our body can comfortably deal up to 24. And so if we had smart thermostats and smart controls, we could likely avoid that. That is an investment policy decision that is very similar to electric vehicle charging and other things. So is it a possibility? Yes. Is it avoidable? Yes.
Excellent. Eduardo, coming from Latin America, we cannot finish this talk without talking about debt, I think.
Yes.
And I also thought that you set yourself on this course, my friend, because you made a lot of emphasis on the increase in the frequency of weather events in an already disaster-prone region. And each time one of these events come, they leave quite a tally for the government. So do you see a significant risk, financial risk, coming from an increase in debt in Latin American countries that maybe is not yet accounted for in the official projections?
Yes. So let me start answering your question, taking the opportunity to make a little bit of shameless propaganda about something we are doing at the IDB, which is next year. As the IDB, the flagship publication of the IDB it's a series called Development in the Americas. Every year is on a different topic. The reason I'm sitting here is because I'm co-editing the one that's going to come out next year, which will focus on climate change and disasters, of course, taking a view of the region. And in that context, some of the results I discussed are going to be presented in this report. And we have also looked at the issue of debt. So your question is perfect in the sense that it allows me to go back to something I said during the presentation, and I didn't fully wrap, which is the fact that we observe in the aftermath of these extreme weather events an increase in government spending. We usually also increase a decline. We also typically see a decline in government revenues, by the way, which in the end translate into an increase in indebtedness. So we have looked, for example, at the experience of countries in the Caribbean basin, and we have done some counterfactual analysis of where in the, well, we have looked at what has happened to indebtedness in the region in the aftermath of the impact of, say, very severe hurricanes. And we have sort of seen where that ended and what it would have been based on a counterfactual analysis in the absence of disasters. And this is important because not only does the level of indebtedness go up, I'm going to share the results in a second, but also financial conditions usually worsen when these disasters strike. So we do not live in the kind of frictionless financial markets in which when you are hit by a negative shock, you can go out and borrow to smooth consumption. I mean, the cost of borrowing usually goes up in the aftermath of these severe negative storms. So we have an increase in the deficit and a higher financing cost. So, well, in the Caribbean basin, what we observe is that when you look at the trajectory of debt accumulation in the aftermath of disasters, there's an increase in the trend level of indebtedness that's on average about 10%. And 3 years after the onset of significant storms, debt levels are on average about 20% higher than what they would have been in the absence of some of these. So yes, I think that we are not taking into account the fiscal implications of these type of episodes, and many of the projections that we have are too optimistic in terms of assuming that these things are not going to happen. Well, the experience of the Caribbean, at least in the way we have studied it, shows that this will have very strong negative implications, and this is something that we should worry about. I mean, if we have more time later on, we can discuss what we can do about that. I think that in Latin America, one issue that we have is that insurance markets are not well developed, so we need to find ways to strengthen catastrophic risk insurance markets to try to improve the ability of governments to insure for some of these risks. But that's for a longer answer than the time I have, so I'll leave it here.
Excellent. So we have some time for questions from the audience. I see Gonzalo.
Hi. Sorry. So I think this is going to be related to what we are going to talk tomorrow in tomorrow's sessions. So I'm thinking about the social cost of carbon, and we want to, and all these damage functions and the modeling that we do. A good part of that is to try to calculate the social cost of carbon, right? The EMs, the ultimate goal of EMs is to get a number of how much we are willing to pay in order to reduce 1 ton of CO2 from the atmosphere, right? But there is a lot of heterogeneity behind the social cost of carbon, right? So this morning we talk about a spatial heterogeneity. So there are going to be countries that are going to be even benefited from the global warming, right? Cold countries that today are rich countries, while we are also going to see maybe tropical countries that are going to be or are going to face huge damages. And at the same time, also, Eduardo just did a very good summary of the temporal evolution in terms of not only CO2 accumulation, but also the damages that we are seeing, especially in countries here in Latin America. I don't know, 20 years ago, we saw much less extreme weather events as we are seeing today. And in the last COP, we saw as one of the main results the loss and damage fund, right, where rich countries should pay or finance poor countries or help poor countries to implement some mitigation and adaptation actions. But this temporal heterogeneity makes that the countries that are rich today, they are already rich, and the poor countries like China or India, they say that they are not willing to pay the current social cost of carbon to mitigate their CO2 emissions, because the other countries, the ones who are rich now, they are guilty of those accumulated emissions, right? And the social cost of carbon was much smaller 10, 20 years ago or 50 years ago when they achieved that development. And also the spatial heterogeneity means that the countries that are facing the damages today are not exactly the ones that are able to pay for the mitigation actions. So the willingness to pay doesn't match with the countries that have money. And that is the problem in the negotiations that we see at the COP, because it's very hard for countries to get a deal on how we can put the money for implement mitigation and adaptation actions in the poorest countries, which are the ones that are more in need of that. So what mechanisms do you see as feasible, maybe in financial markets or even in these kind of conferences among countries, to achieve this huge fund that we need in order to meet the investment requirements in terms of mitigation and adaptation that the world is demanding today? And this question is open for, or maybe Eduardo, you could.
Working in a multilateral development bank.
I'll help you by gathering a few more questions.
Yeah.
Any other questions from the audience? Yep, Ernesto.
So thank you very much for a great conference. I like to look at the bright side if there is one. So I would like to ask whether there is something good coming out of climate change that we also should expect beside all the worries and that we need to take care of.
Sure. Anyone else? Please, Max.
So when we think about financing things, we usually think of this as a fiscal kind of problem. Take tax revenues and do what the federal government does. But I've been trying to think about the central bank's challenge here, right? Usually we sit here talking about inflation. So when we're thinking about global supply chain disruptions that lead to significant increases in prices throughout the world, is that where modeling at the central bank level becomes increasingly interesting? So I'm thinking the folks in Berlin, for example, have this huge web of you take out manufacturing somewhere in Japan and they trickle what happens to prices throughout the world. So it's not a well-phrased question, but I'm just trying to think about what's the specific modeling thing that central banks should be doing given their mandates.
Okay. All right. So, anyone?
I can do the bright side. for a change. I'm not going to do the bright side tomorrow. That's going to be more gloom and doom. But to me, I think there's a few bright points. Maybe highlighting one is the amount we've learned about the benefits of rapid climate action. So doing something about climate change yields much larger benefits than we thought before. These are both sort of direct benefits that we've been talking about. If we reduce CO2, we reduce warming. That has a cascade of benefits. But additionally, the co-benefits, so the quote-unquote co-benefits, we should just call them benefits, but we don't for some reason. We call them co-benefits. Things like changes in air pollution that you also get when you mitigate CO2, those benefits are massive, and they occur right away. We don't have to wait decades. They show up almost immediately in terms of improved health outcomes. And so I think everything we've learned is the things that we need to do for mitigation generate massive, immediate benefits literally for all of us, and to me that's a real bright side of the whole decarbonization effort.
Maybe I'll just throw in a couple of quick ideas. So on the modeling front, I think it's modeling black swan events, whether or not that's supply chains or energy supply or other pieces, or more extreme events by using future RCP climate data, et cetera, is all very important, both for the inflation side, but also for the macroeconomic stability side, right? I think those are the two key things on that front. I think on the good side, there are many locations which will actually benefit from slightly warming climate. I think the global geospatial work that's been done on that is actually also a positive side. I think the other positive piece is that if we look at the cost today of changing out our energy infrastructure versus what it was 10 years ago, it's actually a net positive economic impact versus a cost, i.e. the clean technologies are actually almost in every country the cheaper alternatives to develop. They're also more aligned with, I'll call it, domestic resource utilization, increased domestic economic productivity, et cetera. So there's a very positive story within that when all the policies come into play positively on that front. I think on the, just very quickly on, can one get the social cost of carbon right? I think the answer is no. Thanks, Max, for shaking your head. I think the real question is what's the spread on it? What's the range? All the IAMs are, representative of their structures. They're not perfect by any means. And by the way, it may beg the question, should one be thinking about market mechanisms that effectively set the price rather than thinking of a centrally planned pricing structure, i.e. cap and trade system that actually has a lowered cap and no credits given to it, i.e. what the European Union didn't do appropriately 10 or 15 years ago, but is now moving toward.
So let me be very, very brief and try to address two of the questions that were made here. So echoing a little bit on what Marshall was saying, which I fully agree with, I think one important message on the positive side is that, it's very clear now that it's no longer true, it's not true that there is kind of a trade-off between sort of climate change goals and development goals, right? I mean, we are at a stage where good climate policy is also good development policy. So think, for example, of investing in sustainable infrastructure. That's clearly a good adaptation measure for economies that face sort of the challenge of climate change. But it's also good development policy because you want good infrastructure anyway, and sustainable infrastructure, it's proven to be better. So there's no really trade-off. Of course, there are winners and losers. We have to learn the lessons from, say, trade liberalization, and we have to find ways of compensating the losers in ways that make the transition equitable and reduces the political tensions and the opposition to the move towards more resilient economies. On the issue of financing, I think we will have to become very creative in terms of financing mechanisms. And one issue that when we were asked to discuss about the role of central banks that I thought I would say here, and I have the opportunity to mention it now here, is that one example is, for example, this increasing the opportunities for what's called blended finance. So at the IDB, for example, we provide support for green investments via these blended finance mechanisms. That's basically the strategic use of development finance from multiple sources, such as public and private sector entities, to mobilize additional capital towards achieving the sustainable development goals. So this involves combining, for example, concessional funds, which are typically provided by governments in rich countries or international organizations, with commercial financing from private investors, financial institutions, philanthropic organizations, or other donors. So central banks, for example, can think about how to incentivize, I say central banks because this is a conference about central banks, but central banks, international organizations, so on. We can think about how to mobilize and incentivize blended finance towards climate-friendly projects and initiatives in their jurisdictions. So, this is not going to be able to be done with just public money. I think we have a very tight fiscal constraint. We need to find ways of mobilizing financing mechanisms, and these blended finance mechanisms can take various forms, including guarantees, concessional loans, equity investment, technical assistance, risk-sharing arrangements, and so on. We need to be very creative from here on and tap on all these opportunities. That's as much as I can say about that specific topic now.
All right, we are a bit out of time, but I think the conversation has been worth it. And with that, we close today's event, and we resume tomorrow at 9 a.m.
Thank you, everyone, for participating today. We hope to see you tomorrow at 9 a.m. We have a dinner today by invitation. If you RSVP'd, we'll see you there later. If you also RSVP'd for the bus that we have arranged from the hotel to the restaurant, you should be at the lobby at 7:30. Okay? Thank you.
The accelerated pace of economic and human development of the last 50 years has imposed unprecedented pressure on the balance of the planet, which has resulted in accelerated environmental degradation. The current climate crises and the loss of ecosystem services confront us with the crossroads of whether the current development trajectory can be sustainable in the future. The latest report from the Intergovernmental Panel on Climate Change ensures that the most likely scenario for the coming years is that the planet's temperature exceeds the objective of a maximum increase of 1.5 degrees Celsius. The Intergovernmental Platform on Biodiversity and Ecosystem Services reports that 75% of the land surface and 66% of the ocean surface have already suffered significant alterations due to human actions. At the same time, the World Economic Forum warns that more than half of the world's gross domestic product depends moderately or largely on the services provided by nature. Therefore, if current trends continue, the negative impacts we experience today are projected to intensify and become widespread around the world. Scientists estimate that the window of time we have to act and limit this damage does not exceed this decade. Countries must implement mitigation and adaptation measures rapidly. This context of urgency has put on the radar of the academic, governmental, and private world the need to develop a better understanding of the potential impacts of environmental degradation on macroeconomic and financial stability. With the idea of contributing to developing this knowledge, the Central Bank of Chile invites you to the 26th Annual Conference, where we will focus on understanding the implications of climate change and ecosystem services degradation for macroeconomic and financial stability. In this meeting, we will address issues related to the physical impacts caused by climate change and the loss of ecosystem services, the transition impacts associated with implementation of mitigation and adaptation measures, and we will also see methodologies and instruments that allow incorporating the climate change and nature in general within economic analysis. This November the 27th and 28th in Santiago de Chile. 26th Annual Conference of the Central Bank of Chile.